Stonepeak for about $6 billion. BP will keep a 35% stake in the new joint venture with Stonepeak. They'll be allowed to sell that after 2 years. And here's a check on precious metals. Gold prices hitting a new high, crossing the $4,500 mark for the first time. It did it yesterday. And silver and platinum also hitting new highs. Silver's up more than 140% year to date, 25% just in the month of December. Platinum's been rising for 10 straight sessions. It's up about 36% since the start of December. That's the best month since February of 1974.
Okay, take a look at the futures right now. We are off about 34 points, 35 points on the Dow. NASDAQ looking to open down about 18 points. The S&P 500 off about 4 points. Want to get straight over to Frank Holland. He's got a look at this morning's pre-market movers. Frank.
Hey, good morning, Andrew and Joe. We're going to start things off with shares of Nike. Take a look here at the chart. Higher by about 2% right now. This is after Apple CEO Tim Cook bought 50,000 new shares of the sneaker giant, according to a new filing. Cook, who is Nike's lead independent director and a member of its board since 2005, now owns about 105,000 shares of the company, so basically doubling his holdings. The stock is up right now, as we just mentioned, well, 1.75% right now, but year-to-date pulling back just about 23%. All right, next up, shares of Tesla. Slightly higher this morning after hitting a record intraday high on Monday. You can see shares are up just very fractionally right now. The real number to watch here for a record close is $4.90 per share. The stock's climbed about 20% this year as investors focus more on the company's plans to build AI-powered robo-taxis and humanoid robots. Shares up fractionally right now in the pre-market. We're going to finish things off with a check of shares of Intel and NVIDIA. Now take a look here. You see Intel sliding about 4%, NVIDIA also pulling back nearly 0.5%. This is on a Reuters report that NVIDIA, it halted its test using Intel's production process known as 18A. Reuters also reporting that sources close to Intel question whether CEO Lip Bhutan has the right technical expertise to restore Intel's lead in chip manufacturing. Again, shares of both companies pulling back and in the red right now. Intel pulling back about 4.5%. You can see here the move since Lip Bhutan took the helm of the company. Shares are up about 35%. That also includes the government investment in the company. All right, back over to you, Andrew.
Okay, Frank, I want to thank you. Appreciate it. Merry Christmas.
Merry Christmas.
Coming up, the S&P 500 is on track for a 17% gain for the year. We'll take a closer look at some technical levels with Katie Stockton. That's next. And then next hour, Republican Congressman Brian Stile joins us on the push for a congressional stock trading ban. Clock Box, be right back. The S&P closed at a record high with just 5 trading days left in the year. Joining us now to talk technicals, Katie Stockton, Fairlead Strategies founder and a CNBC contributor. I think, Katie, you were looking for some tough advances, but not as even and easy as we had following the April sell-off. But the market has continued to grind higher.
Yeah, I wouldn't call it a grind higher, but it certainly is very close to new highs. Since October, mid-October, we've seen a loss of momentum, and you feel it, right? You feel the ups and downs. It's more volatile. It does feel like it's taken on a different character than it had in the earlier stages off the April low. That's not necessarily bearish, but what we have seen is a loss of intermediate-term momentum that puts us on watch for a deeper corrective phase. We're always believers in breakouts, so if we do see the S&P breakout to new highs, that would mean for us a couple of good solid closes above final resistance, that's 69.11. That would be a short-term positive catalyst, but otherwise we're going to assume that we're still in this kind of corrective mode and wait for a better entry point, and that can be triggered by things like oversold upturns. So there are positive catalysts that we would certainly adhere to if we see them. Just noting that, of course, the uptrend is still very much alive and well.
Why doesn't a new high count as a breakout? We've already gotten that. What do you mean if we get a breakout?
Yeah, so it's really important to see confirmation. We found that new highs, just incremental new highs, or if you hit it intraday, if you're not holding up there, it can very easily be a whipsaw, especially right now. Of course, the market has low volume. Especially in environments that emotions are running high. I don't know if I would argue that this is one of them, but you just want to make sure that it holds for, if it's a short-term breakout, a couple of days to prevent any kind of whipsaws to the upside, and the same would go for the downside. So it's more of a confirmation that we're looking for versus just an incremental new high.
So you can have a resistance that is above the level where the market has ever traded. How do you come up with a number?
Yeah.
If the market's never been? Yeah.
If you recall in the breakout that occurred in the springtime, we assigned a measured move projection of about 68.80, and that's why in part we think that we're seeing some of this consolidation. That 68.80 was just assuming the trajectory of the uptrend, the longer term uptrend, would maintain itself. If we were to see another breakout here very short term, you could get to maybe 7,100 off that. It's not a very impressive breakout, especially since the support is about 3% below as well. So risk reward isn't great in terms of those measured move projections. You had said before the break, 7%, it's really an 8 or 9% upside to a longer term objective that's more aggressive. With the best we can get to is about 7,500, and these measured moves are essentially, they become resistance just by the nature of the uptrend. It's kind of the character of the uptrend. It's not an actual area that we've seen selling pressure before.
If you were purely basing things on fundamentals, you would think that the bond market, you would think that a move lower in yields because of the weak labor market on the 10-year would be forthcoming, maybe down below 4, maybe a 3 handle. But with the number yesterday with the GDP, we saw, a couple of basis points added to the yield. What do the charts say about, and we've had the Fed cutting, so there's a lot of reasons to think, that doesn't always hold with the long end, if the Fed cuts, obviously. But is it more likely that we go to 4.5 or go down into the 3s, Katie?
I'm more in the 3s camp, but whenever a chart is confusing, where you have indications from different time frames that are different, which is what we have right now, it's usually a trading range. So, of course, we've seen 10-year Treasury yields pretty much range-bound for a long time, even short-term range-bound. So until we see some meaningful move out of that range to the upside or downside, we're just going to assume more of a neutral bias. If you look at the monthly indicators, they do mostly point lower for yield, so that's where my sort of 3s bias comes from, but not until we see a more decisive breakdown from what you could call a longer term triangle would we make that call more aggressively? So just in terms of the next support level, which is around 367.
What was your support level on Bitcoin? Was it 78 or what? Where I don't remember last time around, but you said it could get down in the 70s.
80,600 was the bottom boundary of our cloud model, which has been really relevant for Bitcoin. It's since risen to about 84, 85,000, so that is where there's support. We have a more constructive near-term bias on Bitcoin, just given some indications that it's responding to oversold conditions. However, if you look at the monthly chart of Bitcoin, there's been some real deterioration for those that track the momentum gauges. They've mostly rolled over to suggest that maybe it's not going to be the cyclical uptrend that we would hope. Maybe it's more of a trading range or a down cycle for cryptocurrencies as we come into 26.
Is there any reason to think that volatility is less than it was 2 years ago in Bitcoin? We had someone say that, there used to be a possibility of there were several 80% drawdowns on the price of Bitcoin. This is Anthony Pompliano said maybe you get maybe it's half as hot, maybe you get 40% drawdowns, which is what we've already had. Is there any reason to think that, or is 80% still possible?
I think it's still possible, frankly, but I don't think it necessarily is imminent or something people should worry about. You would suspect that with more institutional involvement, that the volatility would go down. But as it stands, I don't think we're quite there yet. And volatility is cyclical. Even just looking at something like the VIX, you can see the cycles in volatility. You kind of move from a high volatility regime to a lower volatility one. And I would argue that this probably is not going to be necessarily a low volatility cycle. Usually when you see that loss of long-term momentum, it is a more volatile environment. And it doesn't mean we can't take advantage of that. We can simply use shorter-term indicators to sort of leverage those moves in Bitcoin. And that volatility can be a gift for traders.
We're showing stock market volatility index now, but let's talk about that anyway. Because it's at a yearly low. Yeah. And I think you just said that we're in for maybe some choppiness. Would you put a buyout on the VIX right now at $14? That seems like it's only going up from here.
Yeah, it's right at 14 support, the VIX is. So I think, we reference both the S&P 500 and the VIX in terms of our short-term biases. And if the S&P were to break out and the VIX were to break down, well, that would naturally be positive for the market. It would just suggest that we can see more volatility or sort of more compression and volatility in the near term. But as mentioned, there is support there for the VIX, and it would be a very natural place for a rebound. So as long as that resistance is intact for the S&P 500, we're going to remain somewhat cautious in the short term, just with this, sort of suspecting that intermediate term momentum weakening is still an issue for the market as we come into the new year. Of course, we do have positive seasonal influences. It is Christmas Eve day, and we do have the Santa Claus rally is actually technically starting today. It's the last 5 days of the trading year and the first 2 of the new year. So we don't rely on these seasonal influences. In fact, that would have really hurt us this year with the whole sell in May thing. But it is something that could keep a little bit of a bid under the market here through year end, and then maybe the market's released to pull back in early 26.
Yeah, that's what I was saying. The VIX looks like a screaming buy, except you'd be crazy to do it at the first day of the Santa Claus rally. So
exactly.
Where could the VIX? What's the support on the VIX?
So it's almost exactly in line. So we have it at 14.1.
After that, what is it?
It's more closer to 12, and so we've been in this sort of mode where we assume that we've moved into a higher volatility regime to honor those cycles, with the low volatility regime having begun, of course, sort of April, May. If that support broken, then that would suggest otherwise. So we're watching it really closely as a risk metric.
And resistance is where on the VIX? Did you say
we don't adhere to resistance quite as much. It's more like an EKG. It doesn't trend in the same way that equities do. But if I had to put a level where it's topped out, we're maybe mid-20s.
Yeah, and that'd be a 10% break in the market, probably at least.
Oh yeah. And we would just be wary of any buy signals in the VIX. We use the DeMark indicators to that end for one. And when we see those signs of downside exhaustion, we start to say, okay, well, this is the time to get hedged. We don't have any strong buy signals in the VIX now, but we do have that supported line.
We didn't ask you about that. Probably, I mean, commodities and precious metals. I mean, you know it, an old Katie bar the door. My parents used to say that, and your name's Katie. Katie bar the door. What's going on? I mean, $70 silver.
It's wild, isn't it? Yeah, and I mean, listen, these breakouts have been so actionable for precious metals. So as much as they might appear overextended, we've generally been believers in those breakouts. The last breakout for gold could get it close to 5,000 per ounce, which is really impressive. Silver, to me, it would be hard to add right here. It does have some signs of exhaustion per those DeMark indicators, but I wouldn't be necessarily reducing my position because it does have such strong momentum. Conversely, of course, crude oil prices they're worth watching, I think, because they've come up against their 50-day moving average again. And if we see crude get above about $59 per barrel, that might mark a shift that we haven't seen the likes of for months. So that's something that we're watching.
All right, Katie Stockton, Merry Christmas. Thanks. Good to have you on.
Merry Christmas.
Okay, see you.
Okay, coming up, Steve Leisman's got a new survey on, with some new data on Americans' favorite Christmas movies and how much time is spent watching those movies versus sports on Christmas Day. You don't want to miss this. We'll come right back.
Time now for today's Aflac trivia question. According to NORAD, how long is Santa's sleigh? The answer when Squawk Box returns. And now the answer to today's Aflac trivia question. According to NORAD, how long is Santa's sleigh? The answer, 75 candy canes or 150 lollipops. This whimsical measurement is part of NORAD's playful specifications for Santa's sleigh used in their annual NORAD Tracks Santa program.
Now to the great Christmas Day viewing debate. Christmas movies or sports? Senior economics reporter Steve Leisman is at the table this morning. The result of the CNBC All-America Economic Survey and what Americans watch on the holidays, sir.
Yeah, we threw this question in with our survey, decided to save it until now, have a little fun. Whether you have a wonderful life and spend Christmas with family or you're home alone, everyone has a favorite Christmas movie, unless, of course, you're a Grinch. We asked 1,000 Americans, tell us your favorite Christmas movie. And the winner is Home Alone, number one, chosen by about 15% of people have made that the number one Christmas movie, followed by Elf. And then Grinch, which, by the way, I think Grinch gets 2 entries there, right? Because there's the cartoon Grinch and there's the movie Grinch. I think most people are probably picking the movie Grinch, followed by my personal favorite, It's a Wonderful Life, and then Die Hard, which came out in July. So there's a debate about whether it is a Christmas movie. We'll talk about that in a second. A Christmas Story and A Christmas Vacation are honorable mentions here. Worth pointing out, no movie that got any substantial votes was made more recently than 2003, so we can empirically say the public thinks they don't make them like they used to. We also ask more generally, how do you entertain yourself on Christmas? And here are the results. 66% watch or stream a movie at home. 37% are watching live sports. 29% go to the movies. 23% attend a play, musical, or concert. This is during the holiday season, I suspect. Honorable mentions are going to a sporting event and traveling out of the country for 8% of the public. The NFL seems to have figured out that people like sports on Christmas. This is the 3rd year in a row that there are 3 NFL games. I think a couple of them are streamed. I think one of them is on regular network. And they tend to rate more highly than the average game, though it might have eaten into the NBA game audience, which used to own the day for sports. We also picked up, by the way, a bit of the K-shaped economy with how people spend their Christmas. When it comes to will you see a movie in a theater, 38% of the financial elite say they will. And by the way, that's people with higher salaries and more money in the market. So those are the gaps between the higher and lower income on the issue of attending a play or a concert, as well as attending a sporting event. More people with money tend to do those things on Christmas Day. So guys, I know what you want to talk about. We could talk about the GDP numbers yesterday and this K-shaped stuff that was in there.
I have one
or
movie.
the Die Hard Christmas
I
debate.
have one movie question for you, which is I am finding, because I have children, that they are less interested in watching movies than they used to be. That they're more interested, unfortunately, in the doom scroll on the phone. Harder to get them to watch a 2 or 3 hour, or, like a real movie, because of just the length of it. By the way, we were trying to watch. Have you seen F1?
Oh, the Formula One.
Which is now on Apple. I thought, that's like an action-packed thing. Can't really hold their attention for as long as they used to. Whereas I feel like sports continue to hold people's attention.
Maybe Joe and I think have kids more in similar age than yours.
Right.
One thing I found was that things that I thought were great movies and you want to turn the kids onto them.
Yeah, they're not interested.
They're like, Dad, this is really boring. The cutting, that kind of stuff. And I don't know, you have younger kids, so they're even more attuned to the short attention span.
Yes, and I just wonder what that's going to do longer term.
I think that's what's going on with the whole media right now, right? Which is the idea. I mean, sometimes you're like, well, you want these quick video things that are out there.
But then it raises a question about the value of the libraries of all these streaming services. If you don't think the next generation is going to care about movies the same way or TV shows the same way because of the attention.
Definitely changing a little.
My 25-year-old son now is in a process right now of watching old movies.
Okay.
So he came back to a bunch of stuff. I was like, Johnny, what's this? He's like, no, he doesn't.
A lot of references to Christmas in Die Hard. I mean, it's a Christmas party at
What a great movie.
Nakatomi Plaza. They kill the one guy, and he comes down in his Santa Claus outfit, and then Han says, now there are only 6 of you. Oh. Remember, Han says that?
The only thing I remember from that movie is yippee-ki-yay, you know what.
Yeah. You don't remember when the guy comes in, he snaps his neck, he comes down, they send him down on the elevator, and the elevator doors open, and someone screams, and he's got, oh.
But the debate is that you could do that whole movie without any Christmas reference.
You could. What's Hans's name?
Bruce Willis apparently said it's a Bruce Willis movie, not a
Hans Gruber. Hans Gruber, who really didn't have any political ideology.
I thought the more interesting debate might be one about, Potter versus Bailey from It's a Wonderful Life. I mean, we sit here and where do we stand as capitalists here on Potter taking over a failed savings and loan Bailey running a risky book, right?
Even back then, we know where Hollywood.
There was no
Hollywood
FDIC
said.
insurance at that point.
What's that?
There was no FDIC
No FDIC
insurance.
insurance, and he tried to cajole people to keep your money in the bank.
Right.
Because there's a lot of interesting economic stuff that's been written about this Potter versus Bailey. One thing that is for sure.
What year was A Wonderful Life supposed to have taken place in? Do we know?
It was current in 1939.
Was it? Yeah.
Well, no, because there was FDIC, having now written 1929.
There was in 39?
FDIC insurance
you would know.
was put in place in 1933 as part of the Glass-Steagall
I think
Act.
then they would have had it. Because I think it was
I don't
1939.
remember if they did.
No,
One thing that is for sure, though,
Pre the Bank Act of 1940.
our lending system is totally anonymous. Right? The idea that you would know the person you're borrowing from.
Right.
And when George Bailey gives that famous speech of, I don't have your money is in, so-and-so's house. That does it. Every single debt market we have is
Martini.
completely anonymous.
the Martini. And then that horrible guy took over the bar, remember, when George had lived?
That's right.
His name is terrible.
Get your kids to watch that.
What about Christmas vacation? Why is
Because you
Christmas
can get it working.
vacation? I thought that would be higher.
I could see if it's on the list.
No, you said it was an honorable mention.
Well, here's the thing. We've done these in two different ways. I'm using your thought. Sometimes we create the list and ask people about it, or we just take their answer and we catalog it. And we did the latter with this one. So I don't know if we had that on the list, if that would have rated higher. You read them. I don't know. That's Chevy Chase, right?
And Randy Quaid and Beverly D'Angelo and I think there was a different Russell.
Why do you think they haven't made a movie since then, 03? Why has it been so long since
To make it
one has come on and been part of the whole
Are
firmament?
there any good new songs? Mariah Carey's the last song that took off, right? George
Yeah,
Michael. Remember George Michael?
yeah. So we're just locked in. That's it. Christmas now and forever.
When the boomers are gone, the world's going to look a lot different, Dave. Not as good.
Better?
No. Like if George had never been born.
Don't you worry though that you sit there and say, this is how things were and they were better. And then you kind of foreclose that kind of stuff. It's like, they may have good ideas.
No, it's true.
These millennials and these Gen Zers.
No.
That's your kids you're talking about.
I know.
No faith.
They're different.
They're different, right.
Coming up.
Have a great holiday. I'll see you for a jobless claims.
We have all the money. Borrowers who are in default on their student loans may soon have their wages garnished. Details next and later. Closely watch jobless claims due at 8:30 a.m. Eastern. Will bring you the numbers and the reaction in the market. Spark Boss will be right back.
Welcome back to Squawk Box. The Trump administration is going to start garnishing wages of student loan borrowers in default. That's going to start in early January. It'll be the first time the U.S. has taken that step since the beginning of the COVID pandemic. The Education Department saying it expects around 1,000 borrowers in default to receive notice of wage garnishment. That begins the week of January 7th. After that, the number of notified borrowers will continue to increase. More than 5 million student loan borrowers are currently in default. And the Education Department has said that number could soon double. So in this sort of larger context and conversation around affordability, there's 5 million people in default. That's unbelievable. And then to think about how that's all going to play out.
Yeah.
Where are you going?
You remember the cop and the other guy and the taxi driver in It's a Wonderful Life? Remember their name?
I don't. I mean, I remember the film.
Remember them? They were at the wedding.
Yeah, what's the...
Bert and Ernie.
Oh.
Did that now, so did Sesame Street come from?
I don't know, but I love Bert and Ernie.
I love the original Bert and Ernie. You like the...
Sesame Street Bert and Ernie. Yeah, love them. Okay, coming up, we're going to talk about the traditional NBA Christmas Day games and the new tradition of NFL games with sports guru Rich Kleiman. That is next. And later, Republican Congressman Brian Stiles is going to join us on the push for a congressional stock trading ban. We're coming right back. Welcome back to Squawk Box. You are looking at a live shot of the Christmas village in Finland, supposedly the official hometown of Santa Claus. Maybe we should go there next year and broadcast from there.
I think it's like nighttime. Do you like to tango?
You want to tango together?
Big and fit. We would have to if we went there.
Let's tango with Rich Kleiman right now. Tomorrow, sports fans can watch 5 basketball matchups during the annual Christmas games. It's a tradition nearly as old as the NBA itself. Joining us right now is Rich Kleiman. He is co-founder and CEO of Boardroom. Let's Tango. Rich, it's nice to see you, sir.
Nice to see you. How are you guys?
We're good. Merry Christmas. So tomorrow we have a lot of NBA, but we also have a lot of NFL going on. So I'm curious how you think this is all gonna play out.
Yeah, I actually think the NBA's got a great opportunity tomorrow. I was interested to see how all things would unfold when the NFL started playing on Christmas Day, but tomorrow the NBA has 5 incredible games, and unfortunately for the NFL, they have 3 games that don't mean as much as they probably thought it would mean when the schedule came out.
Right.
You have Chiefs, Broncos, the Chiefs are not in it. You have Vikings, Lions, Vikings are not in it, and then Cowboys, Commanders, both those guys are not in it. So the NBA has 5 incredible games, a good mix of the old stars and these young stars. So I think it's a great day tomorrow for the NBA.
Like someone pointed out, all third string quarterbacks in 3 of the games. But you can still bet. I mean, you can still bet, but it's even hard to bet when you don't know, whether anybody's going to complete a pass.
Where are you going to be, Rich, tomorrow?
I am going to be in the Bahamas, my friends, but I will be glued to the NBA games. And Joe, it is not hard to bet. There will still be tons of gambling happening, but
Yeah.
From the stakes of the games, you won't have Mahomes playing tomorrow. So that's obviously big with the Chiefs Broncos game at night. And I don't know if you saw the NBA lineup, but they have Oklahoma City and San Antonio. So you have Wemby, and then obviously Shea. You have Anthony Edwards versus Jokic. You have KD versus LeBron. You have the Knicks at the Garden, and then you have Steph versus the Mavericks. I mean, these are 5 incredible games. It's like 13 hours of NBA. Well,
That's true. That's true. I'm transitioning. I'm transitioning into NBA. I'm not quite there. It's still early, isn't it, Rich? It's still. It's sort of getting out of the College Bowl and the NFL. It's time. I gotta move in. I didn't know what you just described is really good, and it makes me happy for tomorrow.
yeah, and you should get into it. I mean, I think the NBA did a great job of making the early games matter with the NBA Cup. And obviously the Spurs just won it last week, beating the Knicks. Or the Knicks won it. Sorry, the Knicks beat the Spurs. But right now, with the West being so competitive, you have like 6 teams that are 4 or 5 games apart. The NBA is just like filled with incredible young stars right now. And then you still have LeBron, Steph, and Kevin, and James Harden, some of these older guys that are still performing at a high level. But Wemby and Shea and Anthony Edwards, this is like the best young crop of stars that the league's seen since these older guys were young.
What do you make, Rich? This is maybe taking off of Christmas for a second, but starting in January, there's this plan for the NBA to try to expand in Europe, try to do this collaboration with FIBA. What do you think that means for the league long term?
I think it's incredible. I mean, obviously, the game has grown so much globally. So many of the top players in the league are from outside of America. You know, with the All-Star game format this year is going to be the USA versus the world. But I think the ability to tap into some of these existing fan bases, these like deep-rooted communities around some of these international football teams, these soccer teams, the PSGs and Real Madrids of the world, you don't get the opportunity to bring a built-in fan base like that. And I think these cities are ready for basketball. I mean, it's as popular around the world now as it's ever been. And I think from the NBA standpoint, to be able to like build that brand and cement that brand around the world, since some of those players are playing in their league in America, is an incredible opportunity. And I think down the road, you'll have the ability for some of these guys, some of these college players that you got to know that become like familiar names to go play over there. And I think there'll be like a real demand for it. I'm excited for it. I think it's an incredible opportunity for the league.
Do you see a moment where there really is transatlantic playing? I mean, people have been waiting for these new planes to get faster. But do you ever see a moment? I mean, people, obviously there's different exhibition games and other things that go on. But do you ever see 5-10 years from now a completely different sort of setup?
Yeah, I think it will happen slowly. Like, I think, you already have games in the preseason where teams go over to the Middle East, they go over to Asia. Listen, if you're flying from New York to LA or New York to Portland, you're talking about a 6-hour flight, 6.5-hour flight. So the idea of flying to go play in London or Paris, I don't think is so crazy. And I think that there'll be the ability to have like some fun in mid-season tournaments the way they do with the NBA Cup. But I don't think travel ultimately becomes the issue. I think that league will probably run and stand on its own. But as the league evolves and the town continue to evolve, I think there'll be great synergy with the two leagues.
You want to pick the NBA Finals this year right now? Too early?
It's not, I mean, it's not too early. You know, I think in the East, you have like a surprising Detroit team right now who's been first place most of the season. I think the Knicks clearly are in contention. Philly, when healthy, can compete with anybody. You know, I think Miami's surprising people. But in the West, Oklahoma City, who got off to an incredible start and everyone thought would run away with it, they've now lost a few games. The Spurs are incredible. I mean, the Spurs have such a great young nucleus in Wemby. Obviously is like a once-in-a-lifetime player. So if I had to guess, I'm obviously going to go with my man KD and the Houston Rockets versus the Knicks.
And then final question, hot new sport that's going to come on the scene in 2026. Is there anything out there that we got to keep our eyes on? I know we're talking about a sports bubble, but there's, you know, here we are in this moment.
Yeah, I mean, you know how I feel about that. I mean, I think it's not a sports bubble. There's demand for all these sports. There may not be a demand for this model for all these sports, especially if they try to replicate the model of traditional leagues. But you know, Padel has just grown in popularity and exploded in popularity. There's some great new brands around Padel. Everywhere you travel now, these hotels are building Padel courts. There's clubs opening. There's some great new clubs in the city that have opened. My friend Ronnie Feek from Kith just opened Kith Ivy. There's the Reserve Padel Club. So I think that the Padel League is starting to gain a little bit of traction. The sport is so big in Europe. I do see Padel having an opportunity, but again, you have to build these brands with a unique business. You can't think of this as trying to replicate the NBA or the NFL or the MLB.
Okay. Rich, I want to thank you. I want to wish you a Merry Christmas and look forward to seeing you a lot more in 2026. Thank you.
Same here. Thanks, guys. Merry Christmas.
Thanks, Rich. Yeah, so it was Christmas Eve 1945. It's a wonderful day.
Oh, so that's even after the Bank Act.
Even after the bank
We had capital requirements.
And there are quite a few people on Twitter saying that Mr. Potter was absolutely justified in what he did. That you're sending $8,000 with a guy who has a drinking problem, Uncle Billy. He's got the threads on. You're giving him the responsibility to take all the bank's money, and he loses it. That bank was ripe for someone to buy it and clean up. It was released in 1946. Did not win Best Picture. Coming up, deal news for an American vaccine maker. Details after the break. Squawk Boss will be right back. French pharmaceutical company Sanofi is buying U.S. vaccine maker Dynavax Technologies for $2.2 billion. It's going to pay $15.50 a share in cash, and that is a 39% premium over yesterday's closing price. And the deal gives Sanofi access to an approved hepatitis B vaccine. It expects the deal to close in the first quarter of next year.
Okay, coming up when we return, Bitcoin on track for a year-to-date decline of more than 5%. We're going to talk about the expectations for crypto in the new year. We'll do that straight ahead. Then the closely watched jobless claims due at 8:30 a.m. Eastern Time. We'll bring you those numbers and the reaction in the markets. You do not want to go anywhere on this special Christmas Eve edition of Squawk Box. Joining us right now with a look at crypto in the year ahead is Rob Haddock. He's the general partner, Dragonfly, a crypto-focused investment firm. We've been talking about Bitcoin and crypto all morning. Crypto's not had a great year at the moment. I don't know if you think we're in a crypto winter. I don't know where you think we go from here.
Yeah, so it hasn't had a great year, but I think it's important to zoom out, right? So if you look at the returns for Bitcoin relative to the day before the election in 24, Bitcoin's up about 26%, Nasdaq's up about 28%. If you look out, even further than that, 2 years, Bitcoin's doubled, Nasdaq's up 50%. So I think it's a little bit too myopic and a little bit too, call it, zoomed in to just talk about this year on an asset that's kind of run up that much over that period of time.
So if that's the case, where do you think we go? We have some folks on the technical side who say we can go lower from here.
Yeah.
Others who think there's a floor. Others who think we're going to the moon.
So I'm not a technical investor. I'm a long-term investor. We're a VC fund, but I continue to see a strong and constructive 2026.
When you are you a Bitcoin guy? Are you an Ethereum guy? Are you a Solana guy? What's your
flavor? Across the ecosystem. So we're venture capital. We invest in everybody that's doing anything that's interesting in tokenized digital assets, crypto. We are large investors in Polymarket. We're large investors in a lot of stablecoin companies, but we're also investors in everything across DeFi, the Ethereum ecosystem, Quantum ecosystem. We're not what I would say ideological about crypto. What we are is investing in the future of innovation and financial markets.
Well, but what does that mean? I mean, in the context of where crypto itself goes.
Yeah, so I expect a good 2026, right? So for the token prices themselves, Bitcoin, Ethereum, there's likely to be continued momentum, I think, from a macroeconomic perspective. I think we'll have better monetary policy. And then we're going to have more and more adoption of tokenized assets. We're starting to hear it from the biggest asset managers in the world. McKinsey just said that they think 3% of all cross-border payments is happening in stablecoins right now. That's up from basically 0% a year ago. I expect another tenfold increase in that.
So within the world of crypto, if you could only do one thing, you'd invest in which part of it?
I'd invest in VC funds that invest in the,
That's not a fair answer. I'm saying in the specific side of, would you say to yourself, stable coins are the future? If that's true, for the public investor out there, would you invest in Circle? Do you think there's more competition coming? Therefore, you wouldn't invest in. I mean, so what's?
Yeah, so stablecoins I think is here to stay. I think it's going to grow tenfold. I think prediction markets here to stay. I think they're going to grow tenfold. When you look at how you get exposure to that in the public markets, it's either call it the base layers, the Ethereums, the Bitcoins, or it's Circle or something like that.
You mentioned prediction markets.
Yep.
There is a question. By the way, it very well may grow tenfold. The question is whether there's going to ultimately be a lot of consolidation in this space, and whether you see a sort of confluence of the quote-unquote prediction markets and the sports betting books basically merge together, given the audience size that some of the sports betting books already have, and whether that makes more sense, or whether you think the prediction markets effectively overtake the success of the sports betting books. I don't think that's true just yet in terms of just the sheer number of people that are betting in the prediction markets is still small.
That's true. Right.
And so the question is whether you think that there is a sort of mass market where everybody's going to be betting as much as the sports books or more. Sort of what does the TAM of that market look like? Total addressable market.
So I think it's humongous, right? So if you look
humongous meaning more than sports?
I think it's more than sports. Absolutely.
You do?
Right. So if you look at Polymarket volume today, they've gone from 50 million a month in early 24. They're now going to do probably about 4 billion of volume this month, right? Only about 35% of that is sports. Kalshi is a little bit different. It's more of a sports platform, so their infrastructure for Robinhood. But for Polymarket, it's about 35-40%.
Okay.
If you talk to Jeff Sprecher over at ICE, right, he'll tell you he believes in the tokenization of all markets. Like, he believes that is the future. I talked to him before he did the investment in Polymarket, and I can tell you that his perspective is that this is going to be as big as ICE itself, probably, right? I think when you start thinking about what are the use cases, okay? I talked to an insurance company maybe a month ago that was thinking about how they can hedge out risk in weather-related activities, right? That's just one use case in every single thing in every single market and just an outcome that can be put in a prediction market, or really just a binary option, which is what it is.
So I don't even know enough about this to be dangerous, but we had the Mooch on, and you wrote a book about Solana.
Yeah.
So I had a study for that, and I found it very interesting that there is a debate between Ethereum and Solana as to who will eventually be the ecosystem for, I don't know, even trading securities instantaneously through tokenization. Does one have an advantage? One's more secure, one's faster, one takes more nodes, one less nodes. You own both?
So we definitely own both. We're exposed to all ecosystems.
Do you think, can you pick one as being more advantageous? Will both of them survive and flourish?
Yes, absolutely. There's a lot of demand, and I see a lot of demand coming in the future for block space, or essentially, the blockchains themselves, right? Most stablecoins today are on Ethereum. Ethereum is where a large amount of, call it, the economic activity exists, what they call value locked, right? But if you look at the trading volume, it's happening more on Solana, which is more optimized for that type of transaction flow and for low cost transactions. And so I think we're going to see different use cases on different blockchains, and they're all going to
see. I want you to tell me which is Betamax and which is what was it? VC. I want to know which is.
I think they're
which is
both
MySpace and which is Facebook.
No, they're both Facebook, right? So
they're both.
Yeah. there's a lot of room in this market, right? If you believe that most assets are going to be tokenized, if you believe that there's going to be significant amount of economic activity on chain,
By both Ethereum and Solana?
no, but if you just believe in that
Yeah.
thesis, right? Like you can't just have one blockchain. Like one blockchain is not going to be able to scale large enough to be able to have that
And
economic
why don't
activity.
you believe some other technology emerges that's better?
I mean, right now we've seen people do things like call it like basically databases that are so okay, we're blockchains, but it's within our closed loop ecosystem. But if you want to say, okay, well, I'm JP Morgan and I'm going to have a tokenized deposit, right, which they do, right? But I want to interact with Goldman and I want to interact with Citi, but I want to do so in a manner where, like, I want to bring them into my ecosystem. Goldman doesn't want to do that, right? They want to meet you somewhere in the middle of some other service
No, I
provider.
get it. I'm just wondering why we don't believe in the same way that people thought that Bitcoin was actually going to be the blockchain mechanism for a while.
Yeah.
And then Ethereum came along and people said, that's a much more efficient, better version of this. And then all of a sudden people said, oh, there's this thing called Solana. That's actually even more efficient and a better version of this. I mean,
And you
over
point
the
out,
year-
and Kathy Wood lowered her eventual target based on Bitcoin not being as important and these other things displacing.
And so that's my question. Hopefully technology gets better. So to believe for some reason that these guys and this particular blockchain has somehow cornered the market is something I don't really understand.
I agree with you. We're going to continue to see innovation at the blockchain level, right? So there's a new blockchain that just launched called Monad, which we're invested in, which is it's called Monad,
Okay.
Which we're invested in, which is trying to be a Solana killer,
What's
right?
exactly, what's the symbol?
It's MON.
And what's it trading?
It's about a $2 billion valuation today.
No, but what's it cost for one?
What's it cost for one? It's like 0.002. So
Sounds like
That's
another
right over here. That's in your price range.
Okay, what could go wrong there?
well,
Everything.
yeah, with early, I mean, this is early stage technology, right? So the one thing that happens in crypto is people launch these tokens when they're still basically early stage companies, right? It's technology. We're going to continue to see more innovation. I expect that we're not done in what's going to happen in crypto, and we're going to see more innovation at the blockchain level.
Oh my God, you're right. It's true.
Thank
It's
you.
It's 2 cents.
Appreciate it.
2 cents.
2 cents.
$222 million. Yeah, $222 million. That's 2.2 billion.
Merry
Yes,
Christmas.
2.2 billion. That's
Merry
right.
Christmas. You can put some of those in some stockings. Meantime, it is just after 8 a.m. on the East Coast. You're watching Squawk Box on CNBC, a special edition, a Christmas Eve edition of Squawk Box. I'm Andrew Ross Sorkin, along with Joe Kernan. Becky is off enjoying Christmas Eve. Among our top stories this morning, Reuters now saying that the Coast Guard is tracking another Venezuela-linked oil tanker and waiting for backup before a possible boarding. The U.S. has already seized 2 tankers in recent weeks as pressure mounts on President Maduro. Meanwhile, the Wall Street Journal reporting that the U.S. is moving troops and special operations aircraft into the Caribbean, expanding its military options. Meantime, Apple's CEO, Tim Cook, a member of Nike's board, buying 50,000 new shares. That's according to new filing. The stock is up about 2% this morning. And Britain's BP has agreed to sell a 65% stake in its Castrol lubricants business to Stone Peak for $6 billion. That values that unit at just over $10 billion. Sale coming as BP tries to reset its strategy, including scaling back some of its green plans and aiming to sell $20 billion in assets by 2027.
All right, the futures have been pretty quiet this morning, continuing to see them in a nice red color. S&P closed at a high yesterday. Frank Holland has a look at this morning pre-market movers. Hey, Frank.
Hey, good morning, Joe. Good morning, Andrew. Once again, all right, we're going to kick things off with a check on some key commodities right now. Take a look. Gold trading at a record high, breaking above the 4,500 mark. Right now, up about 1/3 of 1%. We're also looking at silver and copper. Both of them are climbing this morning. Copper's been trading at its highest level since July. Silver just crossing $70 for the first time ever. You can see both are up over 1%. So take a look at these metals. They're all outpacing the S&P so far year to date. Silver is the top performer. You can see it's up just about 140, 150%, but a sharp upside move. Silver's this orange line, just by the way. All right, moving on to the pharmaceutical space, looking at the company Dynavax. It's soaring this morning. You can see it's up over 40%. This is after Sanofi agreed to buy the company in a $2.2 billion all-cash deal. The move will give the French drug maker access to an approved hepatitis B vaccine. Sanofi's made a lot of acquisitions this year. It looks to diversify its portfolio. You can see shares of Sanofi, they're pretty much flat, just fractionally lower right now. And we're going to finish things off with the check on shares of Intel and NVIDIA. Take a look. Intel pulling back about 2 1/3%, NVIDIA down about 1/4%. This is on a Reuters report that NVIDIA has actually halted tests using Intel's production process known as 18A. Reuters also reporting sources close to Intel, they're questioning whether CEO Lip-Bu Tan has the right technical expertise to restore Intel's lead in chip manufacturing. But take a look at this chart. Shares are up over 35% since Lip-Bu Tan took over as CEO, technically over 38%. But again, shares of Intel pulling back more than 2% right now. Joe, back over to you.
Okay, Frank. Very good. Thank you. Merry Christmas.
Merry Christmas.
Okay, coming up next, legislation banning members of Congress from owning or trading stocks could get a vote in the new year. House Administration Chair Brian Stiles is going to be joining us next to talk about that. And then a read on the nation's labor market. We'll get jobless claims, get that data, those numbers, and reaction less than 30 minutes away. Don't go anywhere.
House Speaker Mike Johnson has committed to voting in the new year on that legislation that would ban members of Congress from trading or owning individual stocks. Joining us now with the details of the legislation, Republican Congressman Brian Stiles. He's the chairman of the House Administration Committee, also on the digital subcommittee on digital assets, so we can talk about that too, because you share that, Congressman. Welcome. Merry Christmas. Happy holidays. Good to see you.
Good to see you. Merry Christmas. Thanks for having me on.
What was that in 2012? The Stock Act of 2012 prohibits public officials from using non-public information for their own financial benefit. We've already got a law. No one would ever do that. Some of the returns I've seen are kind of interesting that we've seen from certain members. Isn't it already prohibited, Congressman?
The law in 2012, the Stock Act, is a little bit like Elf on the Shelf. It's watching, providing information. But I'd like an adult law in the new year that actually prevents members from profiting off of insider information. It's about making sure the American people don't even have to wonder what their member of Congress is doing. If you're interested in day trading, there's a place for that. It's where you are. It's Wall Street. If you want to come to Washington, D.C., to Capitol Hill, that's where we want to make policy. And so we have an opportunity going into the new year to rewrite the rules, to prevent members from profiting off of insider information, to prevent them from buying individual stocks. I think it'll be one step forward in regaining America's trust in the institution that is Congress.
It is a little disheartening, though, if that law has been on the books. And you can you name specific instances where members were working on a certain whatever, chips, whatever you want to talk about. Can you think there have been specific times where they had non-public information, acted on it, and had ill-gotten gains? Has that happened again and again and again with members of Congress?
Well, as we know, prosecuting insider information charges is incredibly difficult, but we could look back to before the pandemic when the then head of the Senate Intelligence Committee made a call to their broker and sold all but one stock in their entire portfolio at a period of time where individuals, and by definition, if you're on the Senate Intelligence Committee, you do have sensitive information, is making these types of bold and big transactions. Ultimately, that senator would go on to lose their job. But we should have a blanket prohibition about this type of trading. The disclosure regime as set forward in 2012 is woefully insufficient, in my opinion. And we have a big opportunity as we come back to Congress to right this wrong, to make sure that the rules on the books are actually prohibiting individuals from profiting off of insider information, doing more than the underlying disclosure regime that was passed in 2012.
The honor system didn't work. It's just that simple. So did Speaker Johnson will bring this to a vote early next year, and what you're allowed to, the stocks you already own, you're allowed to keep, but you just can't buy new ones, or so? How does it work?
We're finalizing the legislative text. What I want to do with this legislation is not simply introduce a piece of legislation, which has been done time and again on Capitol Hill. I want to actually make sure that we get this all the way across the finish line and signed into law. So I'm sitting and working with my colleagues, making sure we understand what each and every one of them needs to make sure we get this done. What I mean by that is this strict enough? Do we have the rules, the penalties in place that are needed to make sure that we can get this piece of legislation done and across the line? We're continuing those conversations. I hope in the new year, and it's a commitment, I think, from Speaker Johnson as well, that we're going to be in a position to move this forward.
The argument, and you've heard it, you can respond to it, is that we really don't want a bunch of total investing or business neophytes making laws in Congress. Therefore, having some financial acumen, watching Squawk Box, watching CNBC, knowing about stocks and bonds, et cetera, that's a good thing. Having some experience is a good thing. I mean, we've had administrations in recent years, not one person in the entire administration ever had a job in the private sector. And we see the results when things like that happen. Do you worry about that you're precluding a lot of talented people from being able to serve?
Well, I think we can walk and chew gum. I'm an individual that came from the private sector. I was never in elected office until I ran for Congress. And I'm of the view, like you, it sounds like, that I believe we need more people in Congress that understands how businesses work and operate. I work for a large publicly traded company. You learn internally that there are processes and controls in place, in particular for C-suite executives that work well to not only make sure that it's obviously illegal to insider trade, but they provide additional rules and regulations on C-suite executives to make sure that there's not even an appearance of impropriety. And so I'm of the belief that we can get legislation at the end of the day here that actually removes the appearance of impropriety, provides additional rules and regulations, but still allows individuals who had successful business sector careers to come to Washington, because you're absolutely right. In committees like Financial Services, where I serve, where we oversee the Securities and Exchange Commission or other sophisticated regulators, it's essential that we have members that understand how these markets operate and have business background coming to Congress.
We still don't have the legislation in crypto that people in the industry want. I don't know when that comes. And I'm just wondering, if a person in Congress knows that there's going to be crypto legislation, can they buy Ethereum and Bitcoin? And isn't that the same thing? Would those assets be covered under this other rule? They're not securities necessarily.
Well, hopefully the Senate moves forward the House legislation of clarity and provides the legal structure we need for crypto. It passed the House. We're looking to the Senate to move forward on that in the new year. But what you're asking is exactly right. There is a series of rules and regulations that puts forward a disclosure regime, making sure that members aren't engaged in this type of insider information. What I think we have is the opportunity to provide additional rules and regulations that prevent members from gaining off of any insider information, pre-disclosure, prevention of making future purchases. There's a lot of things that we're in dialogue and discussing because, again, my commitment is not to simply introduce legislation, it's to ultimately get it through my committee and across the House floor and signed into law.
You love this subject, so don't you?
I do. I don't know how it's ultimately going to get settled. The one thing I always thought, and I don't know where you land on this, I actually always wanted the SEC to create a monitoring system effectively of Congress, Senate, government broadly, to actually create a division inside the SEC that does this. They never wanted to do it because, of course, the SEC gets funded by Congress, so there's been this sort of push-pull that prevents them from actually doing what I would argue is their job. But I think you could easily actually have a regulatory regime where you could say, here are what are, quote, politically exposed people. You could actually put the onus on the brokerage houses and others that actually people trade through, which is to say that there are instances where a brokerage actually does have to regulate people who are considered politically exposed or otherwise, where they actually think that there's a higher risk, and that could actually be the best way to ultimately look at this. I know people are going to say, "Oh, more regulation, more red tape. It's going to make the banks they're going to be very restrictive." But maybe that is actually the way to do this. What do you think of that?
I think it's absolutely worth exploring. A lot of what we're doing right now is going back to the private sector and saying, how does the private sector do this? You're the CFO of a large global publicly traded company. There's additional rules and regulations that are in place on you to prevent a C-suite executive from profiting off of insider information beyond just the laws and the risk of prosecution. I think we can look to a lot of the regulations that are already taking place under New York Stock Exchange rules or other exchange rules and apply them to Congress. I think looking at making sure the Securities and Exchange Commission or other regulators are not asleep at the switch, that they're engaged, that they're preventing this, is absolutely worth exploring.
How are the midterms shaping up? How's it looking in Wisconsin? You're close to Minnesota up there, right? What the heck is happening in Minnesota? You ever look what would you be doing? Looking to your right? I don't know. I'm terrible with geography a bit.
As we say, don't Minnesota mind Wisconsin. But if we look at what happened in Minnesota, I think it's a perfect example of what happens when a far left liberal philosophy takes root. Minnesota and other far left states are measuring their social programs by how much money they're spending. They're not measuring the programs by how successful they are. And that's what allows this type of corruption to find itself to the level that it did. If you're simply measuring how successful was this welfare program in any category, and you say, well, last year we spent $100 million, and this upcoming year we're spending $200 million, so we're doing twice as well. Conservatives want to measure programs by how successful they are, and you would immediately identify the fraud if you did that. If instead you looked and determined, are students learning better? Are more children being fed? Is our housing situation improving? What Minnesota would have seen almost immediately is that it wasn't. And then when they pulled back the curtain, what they would have seen was a massive fraud ring underlying this. But instead, the liberals in Minnesota simply were measuring the programs by how much money they were spending. And it is that intellectual flaw that allowed this level of corruption to take place. And it should be a calling to every single state in the country and to our federal government that we need to begin measuring our social safety net programs by their output, by how successful they are, and not by how much money we're spending. If we do that, we have an opportunity here to take a horrific illegal situation in Minnesota, individuals that should be prosecuted, and learn a lesson and make dramatic improvements in our social safety net programs across the country.
Great people from there. The Minnesota Nice, you know, real good. Minnesota Nice. You know, the president's sending an envoy out to Greenland. We're still thinking about Greenland, apparently, the Louisiana. Are we still thinking about Canada? Because I had an idea. What about a one-for-one trade? We get all of Western Canada, and they get Minnesota. Would you? Is that? Is anyone? You got any legislation for that? Would that fly? I'm only kidding.
My fiance is from Minnesota and her family's there, so I got to be careful here. But you know, there are a lot of great people obviously in Minnesota. But
That's what I mean. They deserve better. They deserve better.
Really sold them out. And this is a real opportunity for the state of Minnesota to make a dramatic shift. Like Wisconsin, they're almost a purple state. This is their chance to actually get rid of the radical leftists that are running their state and return them to a normal, productive state in this country.
Think about that. Almost a heartbeat away from the presidency. Think about that, Congressman. Anyway, Merry Christmas. Good to have you on. You probably didn't. You didn't know we were going to go all these places when you came on to talk about stock trading, but you never know. That's the thing with this show. We'll see you later. Thank you.
That's what makes your show so great. Merry Christmas.
Oh, thank you. Merry Christmas.
Still to come, jobless claims data, and later, from Venezuela's crude seized by the U.S. to disruption fears caused by the war in Ukraine. We're going to drill down on oil and where prices may be headed with William Croft. We're coming right back after this.
Trump administration will start garnishing wages of student loan borrowers that are in default. It's going to happen in early January. It'll be the first time the U.S. has taken that step since the beginning of the pandemic. The Education Department said it expects around 1,000 borrowers in default to receive notice of wage garnishment beginning the week of January 7th. After that, the number of notified borrowers will continue to increase.
Jake Paul would have not had a broken jaw if he would have just sat
The
here
Education Department
and
has said that
hung out with Jim for a small little brawl.
All right, coming up next, we do have.
But he had to go into the ring to prove his ding-a-ling.
Try to figure out the labor market.
And he got his ass whipped.
Pin trading, not a lot going on, at least in that.
Woo!
Just a shortened trading session, day before Christmas. We'll be right back.
Truck's going wild tonight. Do-do-do. That's a good question. Oh boy. Ding-a-ling. Ding-a-ling. Ding-a-ling.
Welcome back to Squawk Box. We are seconds away from weekly jobless claims. Take a look at futures right now before we get those numbers. 28 points off on the Dow, Nasdaq off about a point. The S&P
I'm here.
2 points. But we got Rick Santelli standing by to CME with the news and the number.
All right.
Yes, jobless claims for the week of December 20th, and that's ending December 20th on initial claims, 214,000, well below the 225,000 we were expecting.
Oh.
214,000 would be the lowest since, well, the last week in
Who's right?
December when it was 192,000, and that was the lowest going back to 22 at 189, which was the lowest since the
You're expecting could be right.
We are definitely under 225-ish, are considered ultra low. And if we look at continuing claims, after a couple of weeks of being under 1.9 million, they pop back over 1,923,000.
Ooh.
Last time we were above that would be third week in November. But what is interesting is
What is interesting?
two weekly numbers under 1.9 million. The first time we've done under 1.9 million since April. And the reason I find all of this so curious is because we are now all questioning in a significant way some of the seasonality issues to make adjustments to these numbers. And it takes a while to get the GPS back, and that is a bit disturbing. It's not like Thanksgiving and holidays don't occur every year, but the process is a bit cumbersome, and we even learned during COVID that seasonality and seasonal adjustments can really kind of play havoc with the numbers. Many now believe, the Wall Street Journal did an article about this, Andrew and Joe, about a week ago, that some of the generous welfare programs might be kind of distorting the jobless claims figures.
Exactly.
More depressed. On interest rate side, here we hover at 416. That's down a basis point for 10s. The notable trade of late has been in foreign exchange. Dollar index on pace for the worst year since 2017. Much of that, though, was the premium put in.
Don't believe him.
But nonetheless, if it closed at levels it's
Steve,
trading at right now, it'd be a
don't believe him.
Low close. Andrew, Joe, the whole gang, back to you, and Merry Christmas.
And Merry Christmas
Oh,
to you,
God.
Santelli. Thank you for bringing us. I don't know. Are we considering this good news or Grinchy news, or what are you thinking, Steve Leisman?
I think Rick and I are in agreement here.
Uh-oh.
And I'm going to make an assumption here about what Rick is. 214.8.
The Russian.
250 is where you start to say, I got to pay attention. Up to say 275, where I'm still not worried. And if I started getting closer to 300, I'd be like, we have real weakness in the job market. Back to 214 ain't nothing. But then you get to the 19 number on continuing claims.
Yes.
It's up there towards the top of the range that we've had.
Right.
But it's not necessarily a worrisome number in and of itself. I think it still says to me, low fire.
The Russian doesn't know what to do.
Low fire, the low fire. I get no information from this necessarily about hiring.
I'll be right back and get my coffee made.
It's a good number. I don't look at this number and see particulars. Rick is right. I don't want to contradict him on that score. That this is a time to be very careful of seasonal numbers out there, and seasonal adjustments, because things get weird. You could have companies, for example, if they don't see customers coming in the door, they could be reducing their employees earlier. And sometimes you get these seasonal surges that doesn't look to me like where we're at right now. So low fire, by the way, and I don't know if we have the chart available, but if you look at the ADP employment data,
who hired this guy?
It's been improving. It's up. Look if they have the chart. So you remember that time we went through all that negative stuff? We had the
You did, not me.
And we were reporting the weekly data was all bad. It's come back a little bit. So this is a 4-week moving average of the ADP change in payroll. So multiply that by 4. It's not terrific. It's still a little higher, but it's not this weakening. And you, Joe, have been excited about the possibility of an out-of-sample surge in the job market.
I guess I'm thinking about Mike Wilson and others who said it's behind.
Not me.
But then there's still people saying if we hit 4.7 or 4.8, that with a really strong GDP, that's just some weird world we're living in where productivity is gaining.
It's a big number, and we were talking about this yesterday. The productivity story would be a cleaner story without the immigration story. Because the possibility that you have a wage surge that happens in certain industries because you're getting rid of the immigrant population, you're ejecting them from the country, and they did some essential jobs in this country. So that's maybe a tail story for next year. Rick, I don't want to exclude you from the conversation, but I do want to say it's been an honor debating and trying to get closer to the truth on the economy and the markets with you this year.
Yeah, no, I completely agree. We don't always see eye to eye, and many times it's that process of us bickering a little bit that maybe America could learn from, Congress could learn from. You know what? It's okay to have a dialogue with people that you don't agree with. Even if the emotions get a little high, it's okay. It's certainly better than shutting down or pulling out different cards and saying no conversation over. Steve Leisman, I look forward to more debates in the future.
Keep talking, folks. Keep talking. Right, Joe?
I'm getting, how you feeling? How you feeling, Andrew? It's the holidays. I'm already vulnerable to emotion, and then he says something. You know who I'll feel a lot.
Exactly.
I'll feel like Bubba.
Let's bring in another.
Think of that young stripper. Go ahead.
You know,
So he immediately gets to a Clinton
it
joke.
always just it takes the wrong
It
turn.
goes boom, like this, off to the left.
Every time.
Working too
We're having a
Brett Ryan is
kumbaya
here.
moment, and it becomes a Clinton moment.
Brett Ryan is here. Yeah, I don't
He's
know.
back in the news.
I don't know what kind of voices you
He's
do.
back in the news.
Senior U.S. economist at Deutsche
The
Bank.
blue dress.
Joe Kernan, I apologize.
Please weigh in on the number, if you could, not all of the other part of it.
Sure. First, happy holidays all, and thank you for having me on the program. On the jobless claims numbers, I think you have to look at the 4-week average, obviously, given the volatility. And on that note, on initial, you're down about a percentage point, or almost 2 percentage points year over year. And continuing claims are up a little bit, about 1.5%. But those aren't very concerning numbers, and they're in line with where I think the unemployment rate roughly is. The unemployment rate may be a little bit overstated at the moment, but it's been gradually rising. And the question, I think, is to what degree, as Steve pointed out, is the slowdown in the labor market demand-driven versus supply-driven? And that's really what's been driving the Fed debate, and that's a healthy debate, as Fed Chair Powell has talked about with the recent dissents. They want a healthy debate. That's the sign of a healthy institution.
But what do you think is really happening? Because you look at the GDP numbers and you think, okay, things are great.
Yeah.
You look at the jobs numbers, you might say not so great. And if you're the Fed, there's not much you can do about that, because that'll just squeeze you right in the middle.
Right. I think you have a lot of policy changes happening at the same time, a lot of dials being turned, and that's kind of creating a little bit of confusion. I think it's a little bit of both. You have a decent trend in GDP growth in CapEx investment, especially. Yes, it is driven by AI, but it's being driven by something, and that's important. And number two, you have a labor market that, yes, hiring has been low, but firing is also low. And so what happens with the ADP numbers, for example, over the summer when the seasonal factors are predicting stronger hiring and you don't get it, you get weak numbers. But then during the months where you're expecting large layoffs and you don't get it, you get larger numbers.
Brett, I talked to Austin Goolsby a couple weeks ago, or maybe 10 days ago. He said, low hire is not normal. You get low fire, and it means you have an expansion. Low hire means you have a contracting or weakening economy. He says it's uncertainty, and it's economic policy that is keeping employers from hiring people, but also keeping them from firing people. I don't know if this is a tail risk or it's an issue for next year. Let's posit that economic policy becomes more certain. Could you see an acceleration in the job market as a result of that?
Well, yes, and you're going to see an acceleration in GDP on the fiscal policy alone. I mean, tax refunds this year are going to be huge. We estimate roughly 50 to 60 billion in extra tax refunds. That acts like a stimulus. That should fuel solid growth in the first half of next year. We're at 2.8% annualized in the first half of next year. The second half of next year becomes a little bit of a question. But I think the other part of this is the policies in place that are encouraging business investment. Other parts of the economy, aside from AI, should start to pick up, and you should start to see investment there. And the question is, are you going to have enough workers to meet that demand? Because you're seeing little telltale signs in certain sectors, construction being one, where employment's down, but wage growth looks like it's inflecting. The NFIB survey that asks, what's your biggest problem?
Right.
Quality of labor is starting to pick up. It was falling for 2 years. Now quality of labor is starting to rise. The percentage of respondents pointing to quality of labor. So the tail risk here is that you could actually have somewhat tightening of the labor market at some point next year.
This is one of the problems with trying to figure out the economy in a Trump administration. There are so many different things that are being changed right now, and they all sort of interact in a way that, like, for example, you could say it's a clean productivity increase, Fed can cut rates and go down, but you have the immigration thing which interacts with it in a way that makes it a little bit more uncertain. What does the Fed do in this situation? Do they cut, or do they wait to see whether or not how these two things interact, or all the other things interact as well?
You have two camps right now, right? You have those that think they need to cut further to address downside risks, and those that are of a higher neutral rate saying, well, wait a minute, let's take a step back here. We're still above target inflation here, and it's not unfeasible to think that the labor market could tighten if these policies actually work and generate growth, strong growth that causes a labor demand to pick up again.
Is there a wage growth number or real wage growth number high enough to where you'd accept 3% inflation?
I mean, you'd want to have wage growth above that.
No, right, but I mean, if you could do 4% GDP, are you willing to accept higher, or is 2%, is that just locked? Because we have people like Alarians say that we got 2% from Denmark or something. He made the point.
I think it was New Zealand from the 1990s, but the 2% number was kind of, it's someone picked out of a hat, but in a way it was something that was matching population growth. Close to population.
Long term on the dollar is bad.
I think where the trend is going to go is, and other central banks do this, is a range. Right, 2.5 to 1.5, something along those lines, where you're not so strict about it.
Joe, you get to bad places much more quickly at 3 than you do at 2.
Right.
Just do the compounding math, right?
It's horrible.
Didn't Einstein say that compounding?
Let's focus on hitting 2 first before we start to.
Forces in the universe.
No, that was Yogi Berra.
I thought Einstein said that. But listen, if you do that, the trouble is that people start to think and plan inflation. That's one of the reasons why 2 is thought to be better than 3, is the idea, I think Greenspan said this, that
3?
The right inflation number is the one where
That's better than 3?
Thinking and planning.
And that's for the Hawks on the committee that are going to be voting next year, that have been dissenting.
What dare you?
Is 5 years of above target inflation, and central bank credibility being
2 is better than 3.
And if that happens, and inflation expectations become unanchored, you have a much bigger problem.
Can oil stay at 58, and can we still be worried about? Doesn't eventually that become a great tailwind for inflationary expectations?
Energy prices falling is always a good tailwind in terms of inflation falling. Really, right now, what you have is a situation where you have housing CPI rents that are falling, which is a positive. That's been checking the growth in goods inflation. Goods inflation has been picking up because of the tariffs. The other component, core services ex rents, however, the progress there hasn't been great. And that's really what's linked to wage growth, which we want, which you want, but it's above target right now. And so those other pieces.
I'll argue against, by the way, the other side of this without much conviction, but it's the Waller idea that the labor market will not be the source of inflation.
Right.
That has animated the Fed, that is adopted by Powell, and it's why he should probably be one of the leading contenders for being Fed chair, but, that's the Waller.
Why he rightfully so is one of them.
That's
I'm
correct.
not sure where he ranks though.
Yeah.
Not in the Cal sheet.
Not in the.
Where's the
His first name's not Kevin.
He's like.
Is Warsh above Waller?
Warsh
Oh,
above
yeah.
Waller. Yeah. Jim Kevin's at the top.
57, 23, 12.
Assets 57.
Yeah, something like that.
It's interesting, if you wanted to stack the board, Waller
Okay.
would be the best choice.
Well.
2 seats.
What to think?
And a Powell seat. To put 2 more of guys whoever you want.
58, not bad from memory right
There
there.
you go. I want to thank you. Steve, want to thank you. Rick, want to thank you. Merry Christmas, everybody.
You're welcome.
Up next, Halima, prop, on what's impacting oil prices. We were just talking about that. And our outlook for next year. Squawk Box will be right back.
I don't see a problem at all. I like the music. I like the music. We were talking about that backstage the other day. Somebody really doing it on, man. It's unbelievable. Yeah. Crazy. It's way early today. And Santa Claus. Santa Claus has been good to me.
We're just talking about crude and how positive a 5 handle is maybe for inflationary expectations. Halima Croft, RBC Capital Markets, Global Head of Commodity Strategy, is with us, also a CNBC contributor. So much to talk about, Halima. Merry Christmas. Good to see you. I like that red.
Merry Christmas, Joe.
Yeah. Yesterday we were talking about whether we're at a level where the producers are not feeling that great about the holidays.
I mean, if you look at the Dallas Fed surveys, the U.S. producers do complain about the pricing environment, some of the issues around, tariffs, limited steel prices, but they do like President Trump's deregulatory agenda. They do like the permitting reform.
It's Miss Smiley.
Like the aggressive efforts to assist in terms of everything they want on the deregulation front. So the question is, U.S. production has remained high. Will it plateau in the current price environment for 2026? I mean, a lot of things broke President Trump's way this year. Not only was U.S. production high, OPEC, particularly Saudi Arabia, gave him, significant amount of additional production. You also had production Brazil, Guyana. So it's a very strong oil growth story for 2025.
You're right.
Do you, I know you got a great job. I see you get sent all over the place by RBC or, in Vienna, and then, you're in the Middle East. I mean, it's all domestic now. Is that hurting your travel? We're the sweet producer now, aren't we?
I was just in Europe. I have been in Houston, so I do spend a lot of time in Houston. I like it a lot. I do think the question for President Trump is, if you have prices move a leg lower from here, it's not our expectation. We do expect WTI prices to hang out sort of in the mid to high 50s this year, barring a major political disruption. We should talk about that as well. Is that a growth number for U.S. producers? It is not an optimal number for U.S. producers. Can they weather this price for about a year? Yes, but it's not what they want in terms of a medium or long-term oil price, to be sure.
So where is it? Is it Venezuela? Is it Iran? Is it Ukraine? Is it the Middle East?
We have so much to talk about, Joe. First story would be pay attention on the Venezuela story. Now, you could say Venezuela is not producing that much anymore. I mean, when I used to cover Venezuela back in D.C., they were producing about 3 million barrels, and that was like the early 2000s. The question is, if we do get some type of regime change in Venezuela, is that key to unlocking future Venezuelan oil production? Can you turn around the story quickly? It's going to require, Joe, about $10 billion a year in investment. We will need a very stable security environment in that country. It has been run as a narco state. There's a lot of arms in circulation. The military essentially runs an oil company. Are we going to go in and stabilize Venezuela? And if we don't, is there some risk on the current production levels in the near term? So pay attention to that story. Pay attention to the latest in terms of Israel, Iran. We have news out of Israel that Prime Minister Netanyahu is going to try to lobby for more aggressive action against Iran because of the ballistic missile program there. The 12-day war over the summer did not produce a major supply disruption. Again, something that broke President Trump's way. If we do get another Israel, Iran, U.S., conflict conflict. Is that going to remain the same? Is regional supply at risk? Again, it worked out well for Trump. But then there's a Russia story. There has been expectations in the market. Part of the reasons I think prices have been soft, that President Trump will be able to deliver a deal to end this war. Not clear yet if that's going to happen. And Ukraine has upped their tax on Russian energy supply. So pay attention to the trajectory of Russian production.
All right, good. Wow. 4 minutes, and we spamming the globe.
Spamming the globe.
Yeah, all right. Merry Christmas. Wow. Yeah, I think Christmas. Yeah, happy holidays. Yeah, you too.
Thank you.
All right, we'll have you back. We got lots of talk. We'll just talk about all that other stuff next time we're on. Thanks.
Thanks, Jeff.
Coming up next, will Santa Claus be arriving on Wall Street? We're going to get an outlook for equities right after this. Squawk Box coming right back on this Christmas Eve edition of Squawk Box.
Okie dokie.
We're just a little over half an hour now into the opening bell on Wall Street. A shortened day on the street, ending at 1 p.m. today. Alex Morris, FM Investments CEO and CIO. Good morning to you, Alex. It's going to be kind of light volume today, and I imagine maybe light volume for the rest of the week and next week as well. But let's not even talk about that. Let's focus, if we could, a little bit maybe on this number that we just heard and what you think it portends for 2026.
Sure. Well, it was light volume also here in D.C. as an unexpected federal holiday, and everyone stayed home. So traffic into the Bureau is pretty simple. I think that's what we're going to see in the markets. And I think, you know, if you wanted muddled data for Christmas, you got it. And we're going to continue to get more of it as we go through the end of the year. And
Muddled, yeah, it's muddled.
You know, if we look at just Fed policy, we see muddled data creating a more divided Fed, which is only going to be more complicated when we get a Kevin in the seat in short order that sort of hardens the political view of the Fed, if nothing else.
So if you were picking stocks, what are you picking?
I think we like the trade that we saw last year, which is barbell with AI and tech stocks, and then T-bills on the back end. That was a good trade. Simple things like NVIDIA, but don't count on AMD. AMD is the sort of silver to NVIDIA's gold, and I think there's a lot of upside there. We also like names like Vertiv that are going to be pushing out cooling and other technologies that are on the back end of that AI infrastructure build. And then, let's not count out defense stocks, something like Raytheon, where you've got this defense play as part of the core, but this really great civil aviation background that kind of balances them out through all of the other lulls that happen in defense appropriation spending.
What did you touch right about now?
Sorry, where do we see what?
I said, what did you touch right about now?
Well, I think we see there's a lot of uncertainty happening in the market. As a result, it's really hard for us to kind of pick a good number. And I think we're going to look at a lot of mixed economic data. So it's going to be pretty hard to see all stocks moving forward. But I do think we are going to see that AI trend continue. We're going to see it broadening out across all markets. And above all, I think you're going to see a lot of uncertainty around come mid-April when we now know who's going to be in the chair, and the markets have to decide, are rates going much further down, or are they staying where they are?
So you think that's the uncertain moment? I mean, there's another view that comes sometime even in January, we may get word from the Supreme Court about tariffs, and I don't know how much uncertainty you think there will be surrounding whatever that verdict ultimately is.
Well, I think that it's looking like it's going to go against tariffs being upheld. I mean, just listen to that commentary. That wasn't a SCOTUS that was in favor of preserving executive authority to create tariffs. But I do think we are going to see the Supreme Court do what they're pretty good at. Find a way for the administration to reinvigorate tariffs, right? The president still has the power of embargo. We are seeing that in the Caribbean today. What is a tariff if not a release of embargo tax? So I wouldn't be surprised if a very narrow reading may technically throw the tariffs out, but give them a way to reinvigorate themselves shortly thereafter.
Okay. Alex, I want to wish you a Merry Christmas. I want to thank you for your perspective on all this, and we look forward to talking again soon.
Oh,
thank you.
We're breaking on Squawk Box this morning that I guess we have to fix. No, it's breaking news. Initial jobless claims came in at 214,000, below the expected 245,000. French pharmaceutical company Sanofi is buying U.S. vaccine maker Dynavax Technologies for $2.2 billion. Shares of Nike
very offended about that.
After Apple CEO Tim Cook, who was on Nike's board, bought 50,000 shares. Nike is down 25%.
They've got to be wrong.
It's the second worst Dow component next to United Health, and its all-time high wasn't last year. Nike's been having a tough go of it for a while.
What?
40 seconds, Andrew. We want 40 long seconds to wish everyone a very happy holiday,
Merry Christmas.
Merry Christmas, and thank you. Thanks for the viewership, putting up with us, and right?
It's true.
Leisman and they got teary. I guess
even the Russian.
We want to. No,
you know I can cry at a car commercial.
I know you can.
So I can start crying.
We like the bicker too. No, we like to discuss too. And we cover we cover
all the sides.
You're Mr. Yin, I'm Mr. Yang. We cover the whole universe.
I'm Mr. Yang.
You might be Mr. Yang, I might be Mr. Yang. We gotta go. Make sure you join us Friday. Squawk Box.
You're talking about the Russian? Okay, here we go.
Welcome to the street. I'm Carl Keaton here with Melissa Lee here at Post 9 of the New York Stock Exchange. Kramer in favor, half the morning off. Coming off Tuesday's record close, it's Christmas Eve, of course. Shortened session for stocks. Market closes at 1 Eastern. Bonds an hour later. Plenty to work with, though, if you haven't checked out already. News on Novo, Nike, Tesla, Costco. Jobless claims do come in light, 214K. Our roadmap begins with the state of stocks. Today marks the official start of the so-called Santa Claus rally.
Ho, ho, ho. A strong growth, but a weak labor market. We'll discuss what is going on with the American economy and what it means for Fed rate cuts. And Intel shares, as Carl mentioned, sliding on a report. NVIDIA halted testing of Intel's chip manufacturing process. We'll get into a little bit more, but sort of a question mark about that Intel story, turnaround story.
Meantime, this morning, covering the state of stocks, as we said, as we await to see whether Santa does in fact arrive. Hopes for a Santa Claus rally. The tendency for markets to rise in the last trading week of December and the first 2 trading days of the new year. We haven't really had one in the last couple of years. Generally, it portends portends good outperformance for the entire following year. But we're certainly going out these last two sessions with the VIX no longer old enough to drive, low volatility,
Exactly.
spreads near record lows.
Yeah, the macro backdrop has been good, as we've seen in the data. So far, we also have, Marvell did a lot to affirm the AI trade, which has really been having trouble since the fall or so. And so with that sort of, the wind at our backs in terms of the AI trade, that really enables that bull narrative to continue to hold on to the hopes for that Santa Claus rally, because we will have the biggest component in the markets participating in theory, thanks to those reports that we saw earlier this month.
And you guys do a great job of sort of establishing the landscape of consensus among strategists, right? Well, they're pretty bullish.
They're very bullish.
There's an 8K in there. What's the low end? Maybe B of A at 7,100, something like that?
Yeah, there's some question marks as to how much Fed is priced in, how much Fed will actually hit the consumer. But if you take a look at next year, we've got fiscal stimulus at the beginning of the year with tax refunds and changes in tax policy really helping corporations. And we have that sort of baton to be passed on to a dovish Fed in the back half of the year when the regime changes. And so the setup for 2026 is fairly bullish from that standpoint. The question is, do we have too much Fed priced in? If it is an entirely back half of the year story, that's sort of the question. How much can the Fed actually develop consensus given sort of divisions of the Fed surrounding rate cuts at this point?
Right. Actually, pretty, I would argue, very constructive house view out of Goldman today, looking at not just income growth, but job growth, maybe rebounding to 70K by the summer. Real wage growth, they think, stays positive through 26. Tax cuts, in their words, a major tailwind, to your point, mostly, obviously, a front half of the year story. And then a lot has been chewed on over GDP yesterday, which kind of implies labor productivity somewhere north of 4, which might, Renmac today out today saying maybe unit labor costs actually decline, which would be an amazing sign for inflation.
Yeah, which would be tremendous. And we saw President Trump yesterday post on Truth Social saying, you know what, let's not kill these rallies. So you have a president who is explicitly saying, if you're a Fed chair, you've got to agree with me on where rates will go. So you have that sort of backstop in the market.
Although we're going to get to the Greg Ip piece in the Journal today, who basically argues the next Fed chair, whoever it is not going to be independent in Greg's view. But we'll get to whether or not and how that applies to Hassett and some others. For more on where the markets go this morning, though, we're joined this morning by Bill Nygren, portfolio manager at Oakmark Funds. Bill, really a pleasure, as always, to talk to you, but especially to round out the year. Good to see you again.
Thanks for having me.
Your general view of 26, and what kind of grade would you give 25?
Well, I think first, 25 was a great year. Tough year for active managers to keep up, especially if you weren't heavily weighted in the growth stocks that really led the market. And the other big issue for 2025 was just how strong a factor momentum was. I think in the past 2 years, momentum's been almost as strong as it was back in 98 and 99 in the dot-com led market, where all you had to do was look backwards and just buy the stocks that had been performing the best, and they continued to outperform. That's really unusual for that to last more than a couple years. So our belief and hope, because it would benefit how we invest, is that the names that have been left behind are kind of catching up in 26.
Yeah, I was looking at a Barron's piece this morning on Salesforce. The headline is "Ready to Emerge as an AI Winner," and they quote you, where you say maybe 8 to 10 times sales for a software company is not too crazy.
Well, that's certainly the price, the ballpark price you get to in the acquisition market, and Salesforce is much more dominant than the companies that are getting acquired at 8 to 10 times. And even Morningstar now classifies Salesforce not as a growth stock. So it's been left behind enough that value investors like us have to take a look at it.
Are financials still valuable? You hold a lot in your portfolio, but you do say that you hold less than you did before, given the run, I assume.
Right. At Oakmark, one of the things we almost always do is trim into strength. We don't want a strong market to be increasing the weightings that we thought were appropriate. So we went into the year with financials by far our most heavily invested industry. The theory was, like, if we just take banks as an example, they were selling at small premiums to book value. We think they're better businesses than electric utilities, and the electric utilities are selling at twice book. As they've closed that gap, they aren't quite as attractive as we thought they were at the first of the year. But when you look at low teens multiples and how much the risk levels have been reduced in those businesses, I think that's still pretty attractive compared to mid-20s for the S&P multiple.
Is there a case, Bill, to re-rate financials? Some are saying, you know, the new age of AI and all the productivity financials in particular will reap in the investments they've made. Make it so that they will reap those benefits, and that should be factored into their valuation on top of all the other things like deregulation, as well as increased capital markets activity.
I mean, Oakmark is probably going to be your worst source for guessing where AI benefits are going to go. But we've been arguing that the financials deserve a re-rating since 2008 because the risk levels have been reduced so much because most of these companies have now like twice the capital that they used to have, the banks specifically. And having twice the capital really reduces risk. The other thing that we think has brought risk way down is that all the major bank management teams are comfortable measuring their success on a per share basis. It used to be everybody was pursuing top line growth, but now they're happy to reinvest in their own shares, and with relatively slow net income growth, they can get unusually good EPS growth.
I want to get you on some energy, Bill, because gas prices are near a 4-year low. Goldman's average expectation for 26 WTI is 52. And we're watching Ukraine talks in Venezuela. But you like some midstream stuff, right?
Yes, we do like midstream. We also like the E&Ps. But again, as is typical for Oakmark, we're not looking at what we think these companies will earn next year. We're looking 5 to 7 years in the future. And you can't find any of the major E&P companies that want to invest heavily if they're only going to get $52 a barrel for oil. We think a market clearing price is more likely in the 60 to 70 range, and if we're right on that, then these are low PE stocks. In the midstream space, those companies are much less risky. They sell at about 10 times free cash flow, and again, those companies are very comfortable returning excess capital to shareholders.
Bill, I want to get your thoughts on Warner Brothers Discovery as of your latest filing. You're the largest active shareholder. So where do you stand in this battle for WBD?
I almost thought we were going to get through the whole interview and not talk about it.
Nope. Not that easy.
I think for some context, Melissa, Warner has been a name that we've held at Oakmark for several years. Back when it was selling around $10 a share, we thought there was tremendous value in the studio, especially the library that Warner had, that wasn't being monetized because the earnings were hidden from the expenses of trying to establish a direct-to-consumer business. So we have always liked the potential of another owner to monetize those assets. We're not arbitrageurs. But I think there are a couple things that are interesting to note here. One being, I think the P-Sky investors are making a pretty strong statement that they want this deal to happen. The stock goes up almost any day that the odds of them winning this battle go up. And I think the reason is because they share management's excitement about the transformational nature of an acquisition of Warner. I think the last bid they put out at $30 did a lot to close the concerns of the Warner board about the ability of them to actually close the deal, but they didn't step up the price they're willing to pay. And I think it's almost funny or disingenuous to see the P-Sky people come on your show and try to convince us that the networks business isn't worth much of anything. But then they desperately want that to be part of the company that they purchase. So I think if they want to win, and I think they should win, they could either get a superior proposal to Netflix by offering to, as Netflix is doing, let the current Warner shareholders keep the networks business, or they can raise the price it has to be substantially higher. Those are the terms the board set out in accepting the Netflix proposal. I think if they want to keep this bidding war going, they probably have to go to $32 or $33. If they want to close out bid, it probably has to be more like 35.
Yeah, funny, Kramer yesterday said 34 probably gets it done. You have no problem with that?
No, we're very pleased with the job the Warner board is doing in this. I think they're great representatives of us as shareholders.
How active has this fight been in terms of, as the largest active shareholder, are you being lobbied? Are you lobbying others? Give us sort of a behind-the-scenes look, if there is one.
Well, again, as we always do at Oakmark, we are very anxious to share our thoughts on business value with management and the board, and we have done that for several years with both the Warner management team and the board, and that continues. They obviously can't say much to us right now, but we do share our thoughts and they listen.
Finally, Bill, we mentioned GDP at the top. Spending on some durable goods did slow. I mean, it's a late number, Q3, but it did slow to 1.6 from a prior 2.3 annual rate. At the same time, some of these travel names are going out close to the highs of the year. Southwest, I was looking at Delta this morning as well. That's going to be awfully close to a fresh high for 25. Are you sensing that the consumer will feel robust enough to at least boost spending on services going into Q1?
Again, we're not spending any time trying to outguess the market on Q1. We think travel will grow over the next 5 to 7 years. A large holding for us like Delta, yes, it's almost at a new high, but it's still not even at a double-digit PE ratio. So we think the long-term outlook is positive.
Bill, always good to chat with you. Appreciate the time. Have a great holiday.
Thank you. Happy holidays.
All right, same to you. See you soon. Bill Niger. Still to come this morning, crypto's big push on Capitol Hill with an interesting twist as we take another look here at the pre-market. Again, a shortened session, not a ton of data. The claims 214, not too bad. We were expecting 224, and we will get a 7-year note auction at 11:30 a.m. Eastern Time. Stay with us.
Yeah. Okay. Well, I'm not too worried. Oh. Yep. 14 minutes. Oh gosh.
Welcome back. The crypto industry taking a unique approach to lobbying capital
That's interesting.
lawmakers. Emily Wilkins joins us with the details. Hey, Em. Hey, Melissa.
It is.
Crypto made a splash in D.C. with millions in campaign donations, a huge lobbying effort on the Hill. Now they're trying something new, a dive bar. PubKey might look like your average tavern at first glance, but little Easter eggs like a Bitcoin ticker on the wall, a cocktail on the menu called the Orange Pill Whale, and most importantly, the ability to pay with Bitcoin. This is a crypto bar. For co-founder Thomas Pakia, the space is less about the food and more about the community around Bitcoin.
The idea of PubKey is really more of a media company with a hospitality wrapper, and we build the culture and community through physical locations.
PubKey also has a podcast studio and plans to hold weekly events helping explain digital assets to the crypto curious. Assisting with that effort is crypto think tank the Bitcoin Policy Institute, which has their offices inside the space. Connor Brown, the group's head of strategy, said he hopes the place will allow for more dialogue with policymakers, experts, and academics.
This is a long-standing problem with Bitcoin, is that sometimes people see it as being too intangible. It is a virtual asset, and so it's difficult for people to get their arms around it sometimes. But with PubKey, we now have a physical location where people can come to and really see Bitcoin in person.
PubKey officially opened last Friday, but it's already welcomed folks including Treasury Secretary Scott Bessent and lawmakers from both parties. The groups say they want the space to remain nonpartisan and open to all. Even if you don't have crypto, you are still welcome to come, grab a beer and a burger.
Okie dokie.
Emily, I wonder how you gauge sort of momentum of crypto policy on the Hill, especially with the announced retirement of Senator Loomis, and whether or not there'll be enough champions to push some of these things over the Hill.
Carl, it's a really good question. I think, Senator Loomis means that a huge heavyweight on crypto is leaving the Hill. That said, there are a number of other senators on both sides of the aisle who are really committed to trying to get something done. And there's been a lot of action. We've seen a lot of meetings.
That's a lie.
From bankers to major crypto companies. But the fact of the matter is that the issues they were grappling with on this market structure bill a couple months ago remain the kind of main sticking points that they're trying to figure out now. And of course, as you know, next year you have a midterm, which means you can kind of do some legislating in the first few months of the year, but after that, it really kind of runs down the clock on the ability to get something done.
You gotta wonder if this is gonna be like Bitcoin pizza. I mean, if you're gonna look back and think I paid this much for a beer, and now that Bitcoin is worth, 10,000 beers.
Yeah. Well, the interesting thing is, in a year where there was so much volatility, it's going out. I think there's an article today on Barron's going out with barely a stir amid this Christmas, and on days where the Nasdaq's up 1.5%, can't manage to ride any momentum.
It's really decoupled. And take a look at all the digital asset treasury companies, like a strategy, I should say, not MicroStrategy. They really they can't get out of their own ways. I mean, the charts look terrible. And, you got to wonder, is there going to be a test of Bitcoin to the average holding price of MicroStrategy, which is about 75,000? Are they going to push it to that level to see what happens? I don't know. It's an interesting dynamic.
Yeah, and I think the Barron's piece points out the 1-year moving average is about 105, which had acted as pretty decent support there for a while, and now has flipped to some resistance. I really appreciate it, and great setup, and a great point about the midterms and how that's going to complicate some lawmaking in the months ahead. Emily will this morning. When we come back today, taking the pulse of retail and the consumer in the holiday shopping home stretch. Take a look at the pre-market here. We'll get to some other news, got to get to Nike and some of this insider buying, including lead independent director Tim Cook in a minute. Take a look at the 10-year. Bond market's been asked to absorb a lot of news from the president and the Treasury Secretary, Commerce Secretary in the last 48 hours. The president has said he made clear he wants a new Fed chair to be in agreement with him, but bond market's not moving around so much, still in that range between 4.1 and 4.2. We will chat jobs in the economy and the Fed with Steve Leisman after a break.
Breakies! Pillow!
Donald Trump's economy grew the United States of America, the biggest economy in the world, 4.3%. What that means is that Americans overall, all of us, are going to earn 4.3% more money. We're making a raise. It's a simple way to do it. We've got more jobs, lower energy costs, and lower interest rates coming. This is the golden age coming. 4.3% this quarter means Americans on average are making more money in their pocketbooks. That makes for a great Christmas.
That was the Commerce Secretary last night on Fox with his take on yesterday's GDP report. Still trying to get our arms around some of that math, since GDP is...
Not even the math, it's just the concept of what GDP is and how Americans earn their money, and that there's not really a direct correlation there. GDP growth does not equal a raise for Americans. As I understand it, granted, I'm not the Commerce Secretary.
Yep.
You may have a far deeper understanding of this, but I did take economics in college.
Yeah. Some of the internals, though, on GDP were pretty interesting. Trade added about 1.5 points. Consumption was definitely strong at 2+. What's interesting is overall investment was kind of flattish, and that'll be an interesting trend to watch if it continues.
And of course, we're going to have to see, there's some skepticism around some of the data that we're getting still. So in order to get clean data, we might still have to wait. So we have that sort of dynamic, the asterisk with all of the economic data that we are getting. But so far, it does provide the glide path for the Santa Claus rally into year-end, no doubt about it. There is no reason on the economic front to say there is not a reason to continue with the S&P at all-time highs at this point. The seasonality behind this.
What's the general consensus on FAST about whether international repeats an outperforming year?
Definitely international next
Really?
year. Yeah, that there's a lot more. That there's a lot of international money also, domestic international money that will be reinvested now into their own countries. Money that had previously come to the United States being pulled out and going back into their own countries, and also fund managers here still even after this year's outperformance, being underweight international, and will feel the need to go international again. But there's definitely a bias towards developed markets like Europe, as well as some of the emerging markets that have heavy resource components, exposure to copper, exposure to gold.
Big jump on Apple.
Like a Brazil.
Really interesting. And of course, we'll get to the dollar in a minute, but second
Google
worst
drop.
G10 currency of the year. Let's get the opening bell here on this shortened Christmas Eve.
PLTR up.
The NYSE trading floor and trade operations teams doing the honors. The guys and
PLTR. Man, he's here. This is named Washboardjim. He talks about chart patterns, moving averages, and being in the now. Yay, Washboardjim's here.
The bull market narrative that are unable to sort of come to light towards the end of the year with the macro backdrop, the belief that there's fiscal stimulus coming in the second half.
I love you.
Earnings growth will continue, and all these things.
And Asian women. I've seen you grow and have children.
We'll see.
Well, that's right. We still got some shutdown risk.
And I moved on.
Tariff risk.
Yep. Bunch of binary outcomes.
Schwab.
2.5%. That is the notable story. The tech.
Okay, the crowd's going wild here at the sports arena.
Seem to be. I'm sorry. The small cap is down just fractionally.
Looks like Nvidia's going down.
Okay, sometimes we get a blip. So there you go. So now
And
everything
AM SMIM.
lower, waiting from some key direction. Lighter trading day today, most likely. Oil
We got
and gold
Google.
are higher. The VIX is at 14, closing at the lowest that we've seen in months and months, maybe for the whole year. I have to double check that. But the big picture here is that we have a very calm market this morning. But you know what they say, never short a dull market. Okay? Joining me right now for some of the first of the opening moves this morning, Diane
boy.
host of Morning Movers, is with me taking a look at this morning's action. And first up here, Diane, you're looking at KB Home. Tell me more.
Yeah, KB Home under some pressure today. This is off of Raymond James. Sliding their rating down to market perform from outperform. There's no price target on this, so this signals lower conviction around this. They cited their fourth quarter report. They called it disappointing. This is the reason why they're downgrading this one. The near-term risk they see for KB Home is a pivot back to a primarily built-to-order model. They say this shift is coming at a tough time because affordability is still an issue within housing space. And they talked about how entry-level competitors are aggressively clearing inventory. So they think that this just doesn't bode well for KB Home. And they also talked about how rivals are leaning into mortgage rate buy-downs. We know that's been a big part of how some of these home builders have been moving housing with the incentives, meaning lower monthly payments for buyers and then just turning around inventory more quickly. They think that KB Home is unilaterally just causing their own challenges, self-inflicted challenges, by stepping away from those tools that had been a key part of the toolkit for home builders throughout this year. Now, KB Home is not the biggest home builder within the sector, but it has, like other home builders, it's underperformed the broader market year to date. So, the move today is not a big move, but down about Certainly doesn't help this stock, which is already down double digits year to date, year over year. It has been a difficult time, and they even called out, you recall, Nicole, on their earnings call about how they expect 2026 to still have some challenges, which echoes what we heard from other home builders as well.
All right. Well, look, I mean, we have to wait and see on what happens with the world of housing next year. Jenny and Dolly Lenz were talking about mortgage rates coming down to 6%, so we will see. Okay, let's get to Lockheed Martin and Boeing. Big news there.
Yeah.
So look, we've seen a lot in the defense sector this week in contracts from the government. So the Pentagon boosting Lockheed Martin's aircraft contract by $10 billion. That takes it from 15 to 25 billion. So it's a meaningful increase. It's not a brand new deal. What's being sold here are these military transport planes. They cargo troops, humanitarian aid, and disaster relief. In terms of the reaction in Lockheed Martin, those shares are up 1% right now. Lockheed Martin certainly needed this vote of confidence because those shares have been little change year to date. It comes at a time when the company is, the country is leaning into increase in defense spending. Pentagon also awarded a new contract to Boeing as well. And Boeing shares little change this morning, but that stock has been a big outperformer year to date. It's had such a strong recovery year, up more than 20% this year for Boeing. So it's been making significant strides in its recovery this year, whether we're talking about the aircraft or the defense sector. They've been on this contract winning run recently. They've had a successful trial as well of some of their digital comm systems as well. So, again, we're seeing an increase in the Lockheed Martin contract value and the new Boeing order as well. So it signals, we talked about this yesterday with Huntington Ingalls, which I'm sure you're jumping on that one as well, where an increase in defense spending, whether we're talking about the Navy, now ships to aircraft. That's what I was looking up. I remember you saw me flip the book. You knew I was thinking about the warships yesterday that we were talking about, and that really has been the mantra of this administration overall. And Huntington and Ingalls, which Diane brought you yesterday, that chart's incredible. That stock went from $100 up to $360 this week to new highs, up almost 90%. Last but not least, let's take a look at Nike. We saw some insider.
Nike again.
Yeah, Nike taking a step forward off the back of news that Tim Cook is, Apple CEO Tim Cook is putting some fresh money to work in that company. There's a regulatory filing showing that he bought nearly $3 billion worth of shares of Nike, 50,000 shares, average price just under $59 a share. So that brings his total stake to just over 105,000 shares. Nike certainly needed this win. That stock before today had been down about 25% on a year-over-year basis. It's trading below levels and it hasn't seen in 10 years, Nicole. So it certainly needed a step forward today.
Yeah, we talked so much about on the speakers on, and that's been something really interesting. What happens with the battle of these athletic apparel and footwear sneakers? Diane Hallway to see you. Folks will still talk about the holiday shopping season. So far, we've seen some good numbers. How do the retailers fare? Are they having to do a lot of discounts or not? Which ones are better positioned than others? Opening the bell. We'll be right back.
Ooh, more Google drama.
While others recap the news, I help you read between the lines from what's moving markets to what's next. With sharp takes and market know-how. Follow me on all social media platforms at Diane King Hall and connect with me on LinkedIn for more.
Hey Bob. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. It makes a huge difference when you have someone that actually cares.
That's correct.
Actionable data and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at schwabnetwork.com.
Well, maybe a short trading week, but it's been a successful one. Charlie O'Shea Advisors is with me, and we're seeing stocks higher. We're almost at records. The holiday shopping season, from what I've seen from Visa and also MasterCard thus far, seems to be going well. What metrics are you looking at about the shopping season so far?
A lot of it has to be anecdotal, and I've been doing this, as you know, for an awfully long time. And one of the things I often premise is, I'm in the stores, but I'm in the stores. It's not even it's barely an anecdotal sample when you're in a store for an hour or whatever. So I look at traffic, I look at what people are buying, and I'm seeing people are buying. People are not just kind of roaming the aisles. They have a purpose.
What are they buying?
Where you can go to the website, see what they have. Many of the retailers, the savvier and better positioned retailers, will tell you exactly what aisle it's in the store. So,
How about T-bone steak?
You're basically doing a search and destroy mission in the store, so you don't have to spend a whole lot of time there.
I'm getting ready to go have a hamburger.
And I'm seeing a lot of that activity so far this year. I was up at Woodbury in upstate New York on the 23rd of November, which is the Sunday before Thanksgiving, and I try to get there every year around that time. Never been more crowded. Lines, and it was cold. I mean, it was really cold. And
That's
there were
not good.
lines outside the top end retailers, the products, the Gucci's, etc. So I think that the high-end consumer is going to drive the spend this holiday, and the wild card will be what happens at the lower end and maybe the lower middle end, and see how they do. But I think we're looking. I think we're going to see a really good year.
What retailers are doing promotions, and is that good for a retailer? I need some names.
Well, Macy's and Bloomingdale's. I was just thinking about that before we went live. I've been in their stores several times over the last month or so, and when you see their private label cashmere 50% off ahead of Christmas, that's normal. I'm going to be more focused on what happens on Friday and this weekend, much like the Black Friday promotions. If somebody is really heavily discounting this coming weekend, that's the problem. That means they didn't clear the inventory at higher prices before and during the Christmas holiday. So that's something to pay a lot of attention to. The department stores are always promotional. They have to be. I mean, they're in a tough spot right now. And I think that the Walmarts, Targets, Costco's, Best Buys of the world, they don't necessarily quote unquote promote. They'll get you another way. They'll get you with quicker shipping. That sort of thing. Maybe some couponing if you're part of the loyalty programs, etc. So I look at promotions through, I think, a broader lens and maybe a lot do. I view the shipping promotions are exactly that. They are promotions. And that's one of the things I'm also focused on is the arms race between Amazon and everybody else for free shipping, because the 25 years I've been involved with Amazon, they have literally done everything possible to avoid brick and mortar. They bought Whole Foods, but that really was just maybe a toenail in the water. They want to focus on their delivery speed, and they have thrown up billions and billions of dollars to this to compete with the Walmarts and Targets and Costco's of the world with buy online, pick up in store.
I'm asking the question, and I just feel like it's not even a question, because you need fast delivery to work, period. No one's waiting 7 days for gift anymore. So how much does it cost these retailers, or which retailers are better at the omni-channel of getting your gift to you the fastest? Because they're all battling in this area, right?
Yeah, I mean, I might get burned at the stake for this comment from a heretical perspective, but I've always thought Target did a great job. During the pandemic, they expanded. They used their stores as shipping points. Their back rooms are basically mini fulfillment centers. I think they've done a terrific job over the years. And I know they've had some bumps in the road lately. The sales are holding up, but they've had some bumps in the road. I think Walmart's done a nice job. What we saw during the pandemic were retailers like Best Buy able to hang on to almost 90% of their sales when the stores were closed. So I think you look at the big guys, the ones that had the money to invest online, the ones that didn't close a million stores because the equity market said they should close them, and use those stores advantageously. And I think you've seen that with the Walmarts, Targets, Costco's, Best Buy. BJ's did a terrific job. Dick's Sporting Goods did a terrific job. Some of the department stores were a little later to the game, and I think they're feeling that pain right now. I think that's one of the fundamental problems that they still have.
Yeah, I understand. I mean, why would you get in trouble for saying that Target's doing a good job? I mean, when they do these investments, I mean, people want, during COVID, people expected curbside and e-commerce, and we actually saw that with some of the prints yesterday, that, Visa and MasterCard, Visa said up 3.9% holiday spend, Visa said 4.2%, MasterCard said 3.9%. They talked about apparel, they talked about jewelry, they talked about eating out and dining out. Those were some of the things. And also that people were shopping online. That was up at 27% of the shopping was being done online, and that was up nearly 8% year over year. I mean, these are the things that have to continue to happen. A final thought here about the online versus, the in-store. Most people are still in-store.
Mm-hmm. Absolutely, and I've been preaching this for an awfully long time that stores are precious. They're on the asset side of the balance sheet for a reason, and you have to unlock the value. And unlocking that value means being able to use them for online pickup, but almost more importantly, keeping them fresh, keeping them well stocked, keeping employees happy, keeping the customer experience positive. If someone's going to invest the time to get up off their couch and come to your store, it has to be an almost flawless experience from top to bottom. Because if it isn't, they may not come back, and they may not even hit your website. So you have to ensure that those stores are fresh. And, I go back a long way in this sector, and I can remember walking into some of the old Sears stores, and they looked like, the old Soviet Union. They were so tired and so beat up. I couldn't imagine why anyone would shop there. And we've got some retailers now with some stores that are in that mix that maybe they're going to close them, maybe they're not. But until they make that hard decision, they're not assets anymore. They're liabilities, and you almost wish the customers did not come to those stores because they're going to walk away disappointed. You cannot have that. Retail's too competitive now.
Super Saturday had nearly 160 million shoppers. That was a record. Many folks are still talking about the inflation that they're seeing when they go to shop. That's another topic, I guess, that people are still concerned about. Charlie O'Shea, Advisors, great to see you. Thank you so much. I hope you got some good bargains. I was always told that if you don't get 40% off, you're not really getting a bargain. I don't know, 40% off. Key levels to watch on the charts as we're almost near records. We'll be right back.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com. Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Opening Bell. Right now we're seeing the markets that have turned into the green start off slightly in the red. But as we take a look at some of the sectors, some of the strength is coming from real estate, healthcare, and financials. Just to name a few, joining me right now is the pro, and that's our senior markets correspondent, Kevin Green, taking a look at the key levels to watch. We were saying we weren't too far off from the records. Take a look, please, for us.
Good morning, Nicole. Obviously, we have a shortened trading day today, so we might see some range-bound action, but you are correct. We are seeing maybe a little bit more of a defensive trade in nature, a little bit more of a rotation taking place right now, at least for this morning. If you look at a longer-term time frame, or the 6-month daily chart, if you will, we actually have this setup of this inverse head and shoulders pattern. It's been on the radar for about a week and a half or so, and now we're pretty much at that neckline at 6,900 level. It's been a key area of resistance, and we are above it at this point in time, potentially going to be breaking out over the next couple of weeks here. If you're kind of looking at MACD is actually about to cross in a bullish formation with that 12 EMA above the 26 EMA actually did cross this morning there. You are seeing that RSI trying to once again kind of test this key area of resistance. So if we do get some broad-based participation, and you do also see a little bit of a catch-up trade within the technology space, as well as communication services, you can actually continue to see it break out higher here over the next week and a half or so. I would get a little bit more concerned about the first and second week of January. That generally is a little bit more volatile, but right now, this looks like a bullish setup for the remainder of this year.
Yeah, I understand. I mean, we think about the morning levels, how we started off in the red, but right now, look, I'm seeing us at the highest point of the day on the Dow as I look at that chart.
Yeah, once again, I think this is going to be a compression type of gain. Not a lot of volume, low liquidity in the market, so the ranges that we are looking at for today is actually going to be relatively very small here. To the upside, 69.20, to the downside, 6,900, your first area of support, and then looking at 68.85. Barring any news to the negative news, it seems like the market's trying to probably trade in this range. I would say the outperformance is not going to be on the large indexes like the NASDAQ or even the S&P 500. Keep your eye on mid-cap stocks as well as small-cap stocks. In an environment like this, those stocks tend to kind of outperform as it's easier to push prices to the upside or downside.
All right, it's great to see you, Kevin Green. Thank you so much. Our market panel is ready as we talked about some of the big movers tonight. For example, the 4%, Micron up 3.5%, Citigroup leader, and Lockheed Martin too, which we covered Lockheed Martin for you earlier. Jenny Horn, George Solis are back. We can start off with some of the thoughts on jobless claims here. I saw that 214 number. George, some of your thoughts on some of the economic data.
Well, I think the jobless claims number pretty much in balance. We're over 200,000 in terms of claims, but I think seasonal hiring is still intact. I think the challenges for the labor market are just in general going forward is the pace of hiring will probably be slow because of the adoption of artificial intelligence. So you got to keep that in mind going forward, but it doesn't necessarily mean that it's going to potentially impact GDP significantly. I mean, if you look at GDP's, the Q3 print over 4.3%, that's a pretty good number. I mean, overall, showing some growth. And what's important, I think, is the constitution of the labor market. We're seeing still manufacturing jobs or natural resources jobs pick to the upside. There's some challenges in the construction markets and the residential space overall, but nonetheless, I think if you look at the net exports, they're improving in the United States. So the trade deficit is shrinking slowly. I think that's quite meaningful because that will help alleviate some of the concerns over the weaker dollar and the money printing regime that we've been going through in the debt conditions. So for what it's worth, again, the weekly jobless claims seem to be in balance at around the 200,000 print. Seasonal hiring seems to be relatively robust, and going forward, like I said, we can certainly see an increase in productivity as well. That helps offset some of the challenging labor demand markets we may end up seeing in 2026.
Yeah, and Jenny, what are you watching closely here?
Well, I will say that not always the most interesting metric, but mortgage applications actually decreasing about 5% from a week earlier, according to the MBA. I think it's interesting because right now, on an unadjusted basis, the index actually decreased at 6% compared to, of course, the prior week, but that refinance index decreased at 6%, but still was 110% higher than the same week 1 year ago. And so that does show right now, well, seasonally adjusted, because right now a lot of these trends I don't think necessarily hold as much weight as, say, the first few weeks of the year. But I do think that this all things to say that this data really points to more optimism for Fed action, as right now markets are increasingly around pricing and rate cuts early next year. And it does seem like this dovish shift has also been able to boost sectors and really fuel what we've seen so far. Not so much today, but what has been so far a pretty nice December and a pretty nice start to this Santa Claus rally, which historically actually really interesting. Santa Claus rally has been able to lift markets, at least the S&P 500, since 1950 by about 1.7%. Nasdaq's gains have been historically a bit smaller, but does go to show that there's real credit to what we call the Santa Claus rally.
Nah.
And I just wanted to bring metals up. I mean, what an interesting year. We haven't had a year like this since 1979. We see all metals at new all-time highs. I mean, I know you focus on gold and silver a lot, but you
You were there when I won that fishing contest?
Silver, for example, which is up around 140%, has only peaked 3 times in 50 years. This year, January 1980, when the Hunt brothers actually tried to corner the market and inflated silver 700%, some people remember that, and 2011 following the U.S. debt ceiling crisis. So gold and silver are often safe havens, but maybe without the metals, George.
1979 when I caught that 5-pound bass out of Table Rock Lake in that jacked salmon. That day we were fishing for crappie. That was back in 1978. Don't know if you remember that.
I think it also speaks to what I mentioned earlier, which is sort of this aspect of reindustrialization in the United States. I think that's part of this. The other part of it could be going forward.
For a new high, maybe?
But it could speak to some inflation going forward. So that's something to keep in mind. But generally speaking, the inflationary concerns would manifest from crude oil, which below 60 is still relatively.
We kind of got a triple top.
You got to keep in mind there also could be a shift back into
the new high. New high.
Like gold and silver as we move into the next year. But nonetheless, it could be inflation, but it also could be a share shift from crypto. But nonetheless,
yeah, and they say inflation this year.
I'll share something with you. I mean, I've been here at the stock exchange for decades, and
they were wrong.
love it here. Do you know that we used to have gold bullion and silver bullion in the vaults downstairs? The ceilings are painted with a 24-karat gold leaf that was painted in 1903. And I did a report
I remember that.
on Bob Network over the holidays, standing in front of the Fabergé urn that was a gift from a Russian czar, Nicholas II, to the New York Stock Exchange. It's all silver. It's priceless. You can't have it, you guys. But I did do a piece in front of it so people can check that out. It's tarnished, so it doesn't really look so silver, but it's cool. All right, that's a little inside NYC baseball for you. Jen Horn, George Sills, great to see you. Thank you, folks, for being here.
Also remember when I painted the outhouse with I think it was with front porch, leftover front porch paint. Okay, like we said.
Investor checking. The checking account built for investors, named highest in client
Satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered. Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales. I'm not saying a rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time. with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are.
Short day today. We're gonna have a real short show.
Welcome to Morning Trade Live. I'm Tom White in for Sam Vaz.
Tom White. Tom Bald White.
Over the next hour, here's a look at what's coming up on today's show. We'll dive into what investors can expect on both the equity and energy markets with Barry Knapp and Carly Gardner joining us this morning. And over the next hour, we're going to bring you sample trades on Intel and Walmart. Intel.
Do you see what I see here, Mr. White?
Chip-making process.
The triple top that I just called out and pulled back with the triple bottom.
5% off of its all-time highs that we hit
Rising wedge.
about a week ago.
Say yes or
Where
no.
markets are a half an hour into the trading day. We got the S&P 500.
Yeah, I saw that, James.
Still at a record close yesterday. The Nasdaq 100 fractionally lower. Over 100 points, 0.2%. And the Russell 2000 small caps after falling yesterday, down about 0.1% in today's session. Let's take a look at the foreign markets here. The FTSE down at nearly 0.2%. DAX, I think, was closed today. The Nikkei 100 out of Japan down 0.14%, and the Hang Seng up 0.17% in today's markets. Now let's take a look at some of the other asset classes that should be on your radar. We've got the 10-year yield continuing to consolidate at 4.16%. U.S. dollar fractionally higher. And the dollar hit 2-month lows yesterday. Gold coming off of another record overnight high.
Not again.
Down a little bit here today. Crude oil up nearly 0.4%. Back above $58.50 a barrel, and Bitcoin under pressure, down about 0.7%, hovering around that 87,000 level. All right, let's bring in our first guest. It's going to be Kevin Green.
Yeah.
Senior market correspondent here on the network. Kevin, let's get your takeaways from today's trading. We're on a 4-session win streak for the 3 major indices here. Santa Claus might have come in a little bit early, but you know this Santa Claus rally we talk about the last 5 trading days. It starts today, first 2 of January. The last 2 years, we haven't had that Santa Claus rally. We always talk about it every year. Could this be the year that we break this?
Let's talk about it, Kevin.
I hope it is, Tom, because we've actually never had a situation where we've had 3 years in a row where the Santa Claus rally did not come to fruition. So you would think that we should see a little bit of a rally to the upside here. For today, obviously, we have a shortened trading session, so I'm not expecting any massive moves to the upside and downside. You're really looking at maybe a 30-point, maybe a 30 35-point range for the S&P 500, and you are seeing volatility still coming in, sitting at around 13.7. I get a little bit concerned about that, Tom, but maybe if we're able to kind of hold these levels for the next week and a half or so, once we get to January, first week, second week of January, I would get a little bit more concerned that volatility could actually re-rate a little bit higher, especially leading into
you think so?
The Federal Reserve meeting in January as well. But this is actually a pretty decent session. We are seeing actually a rotation, a little bit more defensive in nature.
Okay.
Maybe some stocks that actually are also interest rate sensitive as well, as consumer staples, real estate, as well as financials are actually leading the way. So overall, pretty decent session. Once again, I'm not expecting any big fireworks, barring any news headlines that might hit the tape.
Yeah, muted trading, I like to call it, when the holidays come around. We closed early today at 1 p.m. Eastern time, off tomorrow, so maybe that VIX at about 13.7, basically 12-month lows here, not unexpected at this point, especially after a 4-session rally. KG, we got some data this morning. Mortgage apps down about 5%. That 30-year mortgage rate continues to hover around 6.3%, so no activity there. But then jobless claims coming in lower than anticipated here, and it's kind of reflective. Maybe we see this on a week-to-week basis with jobless claims, KG, where they're pretty good numbers, right? They're low numbers, but then you've got that unemployment rate at 4.6%, and that's been ticking higher. It's almost like we've got a bifurcation between the week-to-week data versus what we're seeing in the jobs market. And I know a lot of those numbers are clouded because of the government shutdown. But what was your takeaway here from jobless claims today?
Yeah, they were better than expected. Once again, coming in at around 214,000. She was looking for 224,000. Tom, I would say the unemployment rate, just be mindful too. A lot of the government jobs that were a part of the DOGE layoffs, those severance packages have also expired, so that's actually adding to the unemployment rate in general. And then you are also seeing the participation rate inch up here a tad bit, which does kind of signify the fact that those that have been out of the workforce voluntarily are starting to get back in. Maybe they're trying to earn some income because of pressure when it comes to bills and things of that nature. But the unemployment claims, once again, came in better than the street's expectation. A lot of volatility within this number. About 2 weeks ago, we did see an outlier report. We saw a significant drop in unemployment claims or initial claims. And that was because of some issues when it came to California as well as Texas. We are starting to see that kind of normalize out. And now you're seeing the 4-week moving average for initial claims sitting at around 216,000 jobs. I kind of want to go back to the mortgage applications. We did see a drop with 5% on a week-over-week basis. Not concerned about that. This is the holiday season, so a lot of individuals kind of stop with the housing purchases, at least for now. You also see inventory coming out of the market and will be put back into the market, second week of January, third week of January. That is kind of normal from a seasonal basis. So the economic data this week has actually been a lot better than the street's expectations. Once again, kind of fueling some of this equity gains that we've seen over the last 2 sessions.
Gee, that's another point I wanted to kind of hit on with that GDP number coming in 1% above expectations at this point. We've got some weakening jobs data. It seems like that CPI inflation, there might have been some trickery in there just due to the government shutdown and the lack of data that we got. But it seems like the data is kind of supporting the rally. We're up 17.5% in the S&P 500 after a couple years of 20% gains. There's nothing out there to say that, hey, we're going to get into a recession next year. There's more trouble coming down. There's going to be headwinds in 2026 because with deregulation coming, maybe the consumer flips a little bit. Maybe that K-shaped rally that we had kind of tightens up a little bit. There's some good things on the horizon, and maybe the optimism in the equity markets is warranted at this point, right?
The case, Tom, I think also just the question mark of where are we at when it comes to this cycle. Are we in the 1993 phase where we see this expansion, cycle when it comes to the Fed, monetary policy, also kind of supporting asset values, housing market kind of rebounding? I would actually expect probably the administration to announce some fiscal policies around housing in 2026, given that it is an election year and midterms obviously are going to be very key, especially for the Republicans here. So there's a lot of tailwinds that are being priced into the market market already. We have the tax adjustments that are going to be made. You have the immediate depreciation of asset values for a lot of these manufacturing companies, industrial companies, as well as those building out data centers. So there's a lot of tailwinds. The big question is how much is that already being priced in? And usually when we see kind of these recessionary signals hitting the market, it's because of an event that may not be on the horizon. And I think credit availability is going to be a big thing to kind of focus on, at least for now. And we'll see how the data actually kind of comes in. I still find it very hard if you're going to run the economy at 4% and have CPI sitting around 2.8, let's say 3%. Find it hard for the Fed to really aggressively cut for next year. I'm not sure how the market's going to be able to respond to that. Right now, it's still pricing in 2 cuts. You can see that backed out. That might provide a little bit more volatility for the equity market.
Yeah, first cut not priced in until about June now at this point. And hey, we don't maybe need Fed rate cuts in 2026 if we continue to see GDP numbers like this, the unemployment rate stays pretty firm, and that inflation coming down. CPI at 2.7% on the headline, 2.6% on core. Kenny G, let's flip it to your specialty here, the commodity space. Gold, silver hitting more fresh all-time highs overnight. I mean, this is just like, a repetitive commentary that we have on a daily basis here recently.
Yeah, it has been. Everybody's turning into commodity traders, and I love that. If you're kind of looking at the outperformance for a lot of these metals, gold, silver, or even if you're starting to look at the industrial metals, I think the writing has been on the wall that there's concerns out there from a geopolitical risk standpoint, Fed policy, central bank policy around the world also being priced in, fiscal policy also being priced in as well. And that's it's not a negative sign. It's just something that we have to just be mindful of, that if we do see inflation still remaining sticky, and we have this overheating of the economy, that's good for asset values. We just need to have that outpace inflation. This chart here is the silver-gold ratio, the gold-silver ratio. That orange line moving to the upside just means that gold is outperforming silver. That orange line moving to the downside means that silver is outperforming gold. And I also have the Russell on there as well. That's that blue line. If we continue to see this trend where silver outperforms gold, that really does give you a sense that the market is actually pricing in economic growth and risk-on sentiment in the market. And that's actually going to be conducive for the Russell 2000, small caps, mid cap stocks. Keep your eye out on this. Now, one thing to note, it has been actually a little bit stretched here, Tom, as you can see that line moving to the downside. Does this actually continue through 2026, or do we actually see that stalling out? We can see in the past, over the last 20 years, when it does stall out and we start seeing gold actually outperform silver once again, it makes it a little bit harder for these small cap stocks. So this one is actually kind of confirming the bullishness in the market. Any type of sharp reversal, though, I would get a little bit more cautious as to the direction of equities.
Getting a little bit toppy, but that's not stopping people from getting into these markets. Gold up 70% so far in 2025. All right, great discussion here. Thanks to Kevin Green. Happy Christmas there, Kevin. Have a great couple of days off here. Now, coming up after the break, we're going to take a look at the bigger picture for the Fed and rates moving into 2026. Barry Knapp from Ironside's Macroeconomics will join us next. Morning Trade Live coming right back after the short break.
Oak.
here. Also, it's going to be the rally that we get from here unless geopolitical risk picks up.
No, I think you're exactly right. And we should note that the rallies over the last handful of years in oil have not been for the right reasons. They've been for the wrong reasons. This geopolitical tension, it's not for expectations of growth or growth in demand. So until that changes, and maybe it will, we'll have to see, time will tell, but until that changes, the path of least resistance is lower, and you're right. If you chart out the lows from financial crisis through the 2016 bear market, through 2020 and then through today, it would actually put crude oil at about $15 on a capitulation low. I'm not saying that this is absolutely going to happen, but I'm just saying history doesn't always repeat, but it often rhymes. And if we get the same playbook that we did last 3 times, that's exactly what would happen. So we need to really be prepared for some sort of washout. The good news is the COT report, Commitment to Traders report, tells us that speculators are holding the smallest net long position almost ever in crude oil. So if we do get down to those levels, there's going to be a lot of reasons for people to buy, and there's going to be a lot of ammo on the sidelines ready to come in and buy.
Yeah.
You think so?
Maybe those traders have actually been using.
I think so. You better pay attention.
For the gold and the silver markets at this point. Carly, I wanted to just get your thoughts here on this rally that we've seen.
Yeah.
Demand here, and now it's retail traders and central banks. I mean, do you see a topping here anytime soon for at least gold?
Yeah.
You're exactly right. Thank you for bringing that up. I actually was going to mention that, and I almost forgot. Speculators in 2022 were all focused on oil, and they've switched to metals. I haven't been exactly right in the metals markets. I did not expect to see these types of prices on the upside in gold. So you can take my opinion with a grain of salt. But what I will say is I've seen this type of thing in commodities before. There's a lot of reasons to be long gold. I don't think there are really any good reasons to be long gold at these prices. It doesn't produce income. It doesn't produce anything, really. And it's a lot of price risk. The last time we've seen metals behave in this fashion, the corrections were not small. They were very large, and they were very vast, decades, not weeks or months. So I just warn people, if your time horizon is 50 years, this is probably a really great time to buy gold. If your time horizon is a couple years, this is probably a really dangerous bet. And I will also add, there's a lot of discount brokerages out there that really only offer futures trading in a handful of products, crude oil, gold, S&P, and maybe the euro. And so what you get is speculators really piling into these handful of assets because they really don't have anywhere else to go. There's a lot of money sloshing around in the system. So in my humble opinion, and I've been wrong in metals, I believe this is just a wild speculative bandwagon trade, and I think it's, I don't know when and where it ends, but I know how it ends. And I'll just leave it at that.
Yeah. Tread carefully, investors out there speculating in gold and silver maybe at these levels. All right, great discussion, Carly. Have a great holiday. Thanks for joining us. That's Carly Garner, Senior Commodity Strategist and Broker at DeCarly Trading. But coming up, it's time for the morning trade. We're going to take a look at Intel. Shares are under pressure today ahead of the early close. Morning trade live coming right back.
Trading Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides. Live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right where it counts.
Back here on Morning Trade Live, let's focus on Intel. The stock's up About 78% so far in 2025, has gained more than 35% since announcing a partnership with NVIDIA in September. But shares are under pressure today after Reuters reported that NVIDIA has stopped moving forward on testing Intel's chip manufacturing process for its NVIDIA chips. Let's focus on that with our next guest. And that's going to be Marley Hayden, host of Trading 360. You know, this story, it's denting the shares a little bit, but the stock's bounced off of its lows. I mean, it's up 78% this year. It's had a great run, but this story putting a little bit of dent in it.
Yeah, certainly not going to change that momentum into year end, but it has some bigger implications here, Tom. You know, Intel has been picking up momentum on the deals front. You said we've seen that performance being rewarded, but its manufacturing unit may be struggling to produce quality in-house chips. Now, Reuters is reporting what you just mentioned, that NVIDIA is abandoning prospective plans to use the company's chip production process after recently testing out Intel's 18A process. Designers like NVIDIA and Broadcom had run manufacturing tests with Intel earlier in March with that 18A technology, but Reuters is reporting that it's faced challenges here. Initial customer tests have led to some dissatisfaction and reduced demand. That, of course, all from Reuters reporting from their own sources. Now, we are seeing that weakness. You mentioned that small dent in Intel down about 1.5% today, and this is likely to blame for that. You know, shares of the company had previously gotten a boost from this NVIDIA deal, as well as the Broadcom commentary that they were testing this production process out, but NVIDIA and Intel not commenting so far right now. We are seeing a drop-off in NVIDIA today as well, trading down about 1% after being up about 7.5% in the last 5 days. Intel flat on the month, though, but important, if we're going to have a Santa Claus rally, Tom, every guest that I've spoken to has said that NVIDIA has to be a part of that for us to maintain it. So we shall see how this plays out in the new year, but this is the latest.
Yeah, and that stock has bounced significantly over the last 4 or 5 sessions also, so maybe Santa Claus came a little bit early for NVIDIA. All right, great stuff. Thanks to Marley Hayden, host of Trading 360 here on the network. But now, let's trade it. Let's bring in our next guest. That's going to be Scott Bauer, CEO of Prosper Trading Academy. Welcome back to the show, Scotty.
Tom, it's been a while. How you doing?
I'm doing great. I hope you're having a happy holiday season. But let's get into this discussion about Intel. Like, pulling back here a little bit. How do you want to look at this one from an example trade?
Yeah, it seems pretty unfazed by this news, actually. And technically, the stock actually looks pretty good with some support here, right at the 50-day moving average. So this is a trade. This is not an investment thesis. I'm selling the January expiration, so about 3 weeks out. The January expiration, 35.
You are.
Collect about $1.25 on
Keep
that.
an eye on this guy.
If I get assigned, I own the stock at $33.75. I am okay with that. Typically, I like spreads, just to have that protection. But if Intel were to go down to $33.75, I want to buy the stock anyway. So I'm going to look at this news and say, yeah,
$33.75, huh?
Gives me an opportunity to buy
Why?
if it goes lower.
Yeah, and this cash secure put type of strategy, Scotty, I always think about it of a twofold type of strategy where, hey, if I'm wrong and the stock doesn't go down, and I
can see it.
Shares lower, hey,
If I was, I'd say more like
and I think this is
33.
Where I always tell people, if you put a $33.75 bid in the shares, you may never get filled on that. But
33.
Strategy, at least you'll profit.
Uh-oh.
Go below 34, you don't get assigned, right?
You know what I see? 33.
That's why I'm doing this here, and
support.
I'm surprised the market is not reacting, heavier to this here, but maybe it is not that big of a deal.
Yeah, it's already bounced a couple % off of those lows. All right, great stuff. Scotty, as usual, have a great holiday. That's
yeah.
Yep, thanks. Scott Bauer, CEO of Prosper Trading.
Scott.
Joining us for coming up. We're going to take a closer look at sectors on the move this morning and what to watch.
Very nice to meet you, man.
Ahead of today's early close. Stick around, Morning Trade Lights coming right back.
Okay. Scott. Mr. We just had 3 black crows on the 1 minute off of the 63.
Morning movers, be the first to find out what's changing early market action.
Diane.
Check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day,
Good morning.
Eastern, only on Schwab Network.
Cheers to you, baby.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
That's correct.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago.
George.
At 11 a.m. Eastern on Schwab Network.
Hey, Bob. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Sorry to hear that.
Stroke? Yes. Now we're in the car together almost daily. I started to realize what can I pick up from my dad. He's been with Schwab for a long time.
Jim, my financial consultant, I programmed that 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Welcome back to Morning Trade Live. I'm Tom White in for Sam Vadas. It's time to take a look at sectors and markets and what's going on this morning. Let's bring in Kevin Hanks, co-host of Fast Market with me. Kev, you take a look at pure holiday trading here in this shortened session today. Not surprising, we're not seeing a lot of volatility, but that VIX continues to fall. But maybe it should be down here, Kevin, with the S&P 500 at record highs.
Yeah, exactly. It's drifting. The market's drifting, and
it is.
As long as there's no news that disrupts it, the drift is probably going to be higher into the year because a lot of the data we're getting is moderate to better, right? The GDP data we got, jobless claims this morning. So
that was a shocker.
Parts of this overall earnings season, economic data, forecasts into next year that are all slightly positive, and what that does is that just takes any reason to sell the market here, and I think you're looking at the big drift, Tom. Half day today, we're not open for very much.
Very interesting.
This market is, in all honesty, let's get it open, let's get it closed, and let's get celebrating.
Yeah, let's get it closed is right, on that note. But Kevin, think about the Goldilocks data that we've gotten recently. GDP, the CPI data.
And it's all over again.
This morning. We always talk about this most hated There's a bunch of skeptics out there. Why are we rallying 17, 18% in the S&P 500 after 2 years and 20% gains? But hey, the data and earnings basically support what's going on in the equity market, right?
Yeah, I just had a speaking engagement in Florida, and I talked about some of the inflation data that we got from CPI and how some people were discounting it or doubting the data. And all I did, Tom, was put up a one-year chart of crude oil. I said, if anyone tells you that inflation is higher or strong, look at that chart of crude oil. It's undeniable what's going on. And crude oil, such a big part of CPI, the energy has come down. We can't deny it. So look at the overall data. The job market is the only real problem right now. And my biggest surprise going into the end of the year, I'm surprised that the probabilities of a January Fed rate cut are higher than they are, Tom.
Yep, and those continue to come down. They're not pricing in a cut now until June at this point, but with data like that, does the economy need a cut? That's going to be the question. But finally, kind of wrapping up here, looking out into next week, into the start of 2026, we're about 3 weeks away from another earnings season. I had Barry Knapp on earlier. He's saying that we're going to maybe get a pullback in that first quarter. But the dip buyers will probably be out if we see any weakness, unless it's maybe a black swan event, right?
Well, certainly, there's always a chance that something could disrupt a market that goes straight up. Even the best markets don't go straight up. It's not a smooth line. Could there be news headlines that shake the market or rattle the market? Of course there is. Now, what does that do to interest rates? If there's some global sell-off, that could take interest rates down really quickly. So these are all the things that would bring in dip buyers, right? If the market sells off and interest rates sell off, dip buyers will show up, Tom.
Yep, we've seen that repeatedly, Kevin. Hard to keep that consumer down and the investor down. All right, great stuff. That's Kevin Hinks, co-host of Fast Market with me. But coming up, it's time for Inside Out. We'll take a look at Walmart and bring you an example trade when Morning Trade Live returns.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock. And that could certainly be short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Back here on Morning Trade Live, last minute shoppers. Now is time to shine. Here's where some of the biggest retail names are trading on Christmas Eve. Better get that shopping done. You got about, not too long. Less than 12 hours till Christmas Day. Or about 12 hours until Christmas Day. Walmart up. Target rallying a little bit. Costco on that upgrade on the North Coast. And then Amazon, all higher expectations for retail sales during the holiday shopping season. Coming in pretty good from MasterCard and Visa, also in the National Retail Federation. All right, let's go inside out on Walmart and the rest of the retail sector. Joining us now is Bert Flickinger, Managing Director of Strategic Resource Group. Bert, when you look at these at Walmart, it seems like it's the winner. It's scale. They're doing things right. They're increasing margins in a K-shaped economy. What's your takeaway from the performance that we've had this year?
Tom, Walmart's service, harvesting the seeds that are planted in the 1960s and the decades ever since. Walmart #1 in CapEx and technology with IBM and major providers. Walmart #1 in e-commerce. Walmart #1 in acquiring and buying the best talent. So Walmart's international e-commerce sales, Tom, are up 27% versus e-commerce being up 5% in the U.S. So now, Tom, you have the situation with Walmart dominating on land as it has for over 65 years, but now dominating in e-tail or internet retail, and Walmart is now Amazon's worst nightmare in addition to being the worst nightmare of every retailer worldwide. Walmart wins. Many others will be part of the casualty count.
Yeah, and you look at this, they're increasing margins where we've had some bifurcation in the retail space at this point, Bert, but at the same time, their execution, their use of technology, their expansion of Walmart Plus is probably the reason that a lot of people are getting more optimistic on this stock, even though valuations really elevated on this name, Bert.
Tom, you're completely correct on Walmart Plus, because it's a great deal for the shoppers. It's a better deal than Costco Prime and Amazon Prime equivalent. And you can get a total shopping center, deeply discounted, delivered very quickly. And for, as you said, we're getting close to Christmas. Walmart and Amazon can still deliver today, and they can deliver everything from food to fashion to pet to general merchandise, to consumer electronics, to hard goods and furniture. So Walmart's replacing the Roman empires of retail power shopping centers, becoming self-contained shopping centers unto itself. Walmart is like it was in the 70s and 80s again, Tom. It's a requiem, it's a renaissance, and no retailer will be able to touch them for decades.
Yeah, and when you look at this name, it seems like even in a recessionary type environment, you've got bull markets where shoppers are going there, the lower income, but now they're starting to get that 100,000 plus retail or consumer at this point. So it's almost like they're recession proof. If you think about it, Bert, moving into 2026, do you expect more gains for this stock?
Tom, very prescient point you're pointing out is that Walmart, even though it's trading at 40 times versus the XRT, the S&P Retail Index, trading about half that rate, Walmart is still a value stock. And the reason it's a value stock is 41 of its top 100 competitors in food, drug, discount, department, and dollar stores have filed for bankruptcy or liquidation. And Walmart, through the brilliance of Sam Walton's investment, has nearly 200 distribution centers where Target only owns 6. So Walmart wins on distribution, order, bill, ship technology, AI, improvement, and as Dr. Edward Demings from Yale in Grand Strategy wrote in his book, and Professor Jim Collins from Stanford wrote in his book, Good to Great and Continual Improvement. Walmart epitomizes continual improvement, and your great point, Tom, greater returns through its size, scale, and skill is unparalleled anywhere nationally and internationally.
Yeah, eating everybody's lunch this year, and you're expecting that next year. All right, great discussion, Bert. Have a great holiday season. That's Bert Flickinger, Managing Director, Strategic Resource Group, breaking down Walmart for us. But now let's trade it. Let's bring in George Tilley, Senior Markets Correspondent here. George, you got an example trade for us in Walmart, and Bert was pretty optimistic on this name. Go ahead and break down your trade for us.
Sure, yeah. I mean, looking at Walmart, we're actually seeing pretty constructive the bull flag pullback off of the most recent highs. You also look at the price action, too. There seems to be a shelf that stock may actually come down to right around the 109 area, which corresponds to price action going back to mid-October. The other thing is I noticed, too, Tom, is we have a rising 50-day moving average, which also, again, corresponds to potential retracement back to that 109 area as well. So we're going to look at price action, and then we're going to line the probabilities up to structure a neutral bullish trade here. We're going to sell a put spread. I'm going to go out to the January monthlies, and this way we can harvest some yield, but also mitigate the theta decay as well as some volatility elements between the two strikes. So I'm going to sell right around that 109 area. So I'm going to sell the 109 put, buy the 106, the $3 wide spread below that. Now altogether, you could earn about 70 cents a share or $70 a contract. So the whole premise behind this trade is, yeah, the stock could continue to pull back just a little bit, back to that shelf that I mentioned at 109, that rising 50-day moving average. If you do structure this trade, your max gain is the 70 cents per share. Then you have to consider the risk. The risk is, of course, on the 70 cent credit earned is $2.30 if the stock hits 106 or lower by expiration. So again, why in a price action with the probabilities? Because the 109 strike put that you're selling in this case, as an example trade, represents about a 32 delta or an implied 68% probability of profits by expiration.
Passive, neutral to bullish, short put vertical, 109, 106 for 70 cent credit, 65% probability that that 109 strike will be out of the money at expiration, which is what you want. And after that rally that we've seen, maybe a little bit more conservative, but you do have risk below that 106 level. All right, great breakdown for us. That's George Tellis, Senior Markets Correspondent here, breaking down Walmart example trade. But that's going to wrap it up for us today here on Morning Trade Live. I'm Tom White. Make sure you download Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. Trading 360 with Marley Haynes up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing up houses, opening up our business, having children, they've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are. Good morning. We're 90 minutes into the trading day on this Christmas Eve, and welcome to Trading 360. I'm Marley Caden, coming to you live from our Chicago headquarters. Here's what we have coming up in today's show for you. In our 360 Spotlight, we'll take a look at the housing market and dig into some recent housing data. Then for our disruptors, we'll take a look at Intel after Reuters reported that NVIDIA will not proceed with using Intel's chip-making process. George Tillis will give us the latest and also an example trade there. Then in our 360 round, we'll take a look at Meta's 2025 performance and also see what the social media giant may have in store in 2026. Before we get to that and more, though, let's see how the markets are faring on this shortened day of trading. We do have the Sea of Christmas Queen here, with the S&P trading up 0.2% at 6923.55. The Nasdaq just marginally unchanged, but still in the green, 25,604. On the Dow, we're 0.4 higher, 48,646. And the Russell 2000 trading up more than 0.1% right now, 25.44. The 10-year slightly lower at 4.16 this morning. The dollar unchanged, 97.64. For gold, we are slightly off those highs we hit yesterday, down 0.5% at 44.8310. Crude oil trading down about 1/3% right now, 58.19 a barrel. And Bitcoin struggling again today, down about 0.8% at 86,990. I do want to bring our first guest into the show this morning, though. Welcome in Kevin Green, our senior markets correspondent here on Schwab Network, to talk about KB Homes. Now, KB Homes got a downgrade from Raymond James today, not showing up in their price action today. You walk us through the note.
Yeah, you're seeing some buyers actually sell in and trying to buy this dip here. We did see KB Homes report earnings, and it did disappoint the street on multiple fronts here. We saw the stock drop about 12.5% to almost 13% to the downside, but we are seeing it consolidate here. And we do have Raymond James downgrading the stock here to market perform from outperform, and it removed its price target on the shares. They're a little bit concerned about not only just the earnings announcement, but the fact that they might be ceding some of their market share to other competitors within this space. It appears that KB Homes might be starting to go back to the model of build to order. So basically, somebody wants to buy a home, that's when they build it. Instead of actually building out spec homes, basically trying to build homes ahead of those that are trying to purchase a home here. And this is a strategy that's been used in the housing market in order to ensure that they do not have outsized costs, that they're able to move inventory, as well as trying to build a backlog of orders. But this is also a situation where other competitors, especially those that have financing arms, may have a leg up on them in the near term. And that's where you are seeing Raymond James having a little bit of a concern. Now, we did also get some mortgage application data here today. We saw that drop by 5% on a week-over-week basis. Not a really big concern when it comes to seasonality, but you're looking for Q1 and Q2 to be very strong for the housing market. And we're going to get a lot of these stocks that are related to home building to try to get them to catch a slight bid here in the market. So that's why we're seeing the downgrade, a little bit of concern, not only from the overall market, but also from an industry standpoint that they, once again, could be losing some market share to other competitors, especially for first-time home buyers.
Yeah, and that market is huge, and we're actually going to talk housing coming up on the show in just a little bit here, KG. But, you know, KB Homes saw a significant drop-off after they reported their earnings here, much like many of the other home builders that we saw. But they did have stronger than expected deliveries. I remember that being one bright spot. I think you were actually on air covering it with us when we were talking about KB Homes. You know, was there any mention of any of the potential positives for KB Homes, or was the note itself just inherently negative and all headwinds?
Well, so the deliveries number really kind of follows what order or the backlog of orders is in the pipeline, and usually that's a 6 to 9 month trend that you see. So it's not actually surprising that you are seeing deliveries actually exceeding the street's expectations, because a year ago we did see orders kind of ramping to the upside, and the concern is that over the next 2 to 3 quarters, because those backlog of orders are actually decelerating, that the delivery number is also going to be decelerating. And the only way for a lot of these home builders to try to get rid of inventory is to try to buy down the rates if they do have a financing arm, or provide other incentives which eats into margin. So it's a little bit of a double-edged sword here. So you're right, deliveries were great, but if you're kind of looking at that backlog of orders, that's really showing you what the future revenue can be for this company. And we are also seeing, from an industry standpoint, a higher percentage of cancellations for purchases, not only for existing homes, but also for new homes, which could also impact the industry as well as the stock.
Katie, we appreciate you being with us to break down that note. Katie Holmes trading about 0.75% higher this morning despite that downgrade. That's Kevin Green, our senior markets correspondent here. I do want to talk more broadly, though, get some insight on news that shaped the markets this year. Take a look at perhaps what we can expect in 2026. For that, we'll welcome in Pete Najarian, the co-owner of Market Rebellion. Pete, great to have you back with us on the show. Let's talk about this rally. You sent over a couple notes in advance of our chat, and you referred to it as one of the most hated rallies you've ever seen. Why do you feel that way?
I've been doing this since 1992, 1993. I think I started as a trader on the floors of the Chicago Board Options Exchange. I got to tell you, there have been rallies in the past. This one was so hated, and I think a lot of that really stemmed from the very beginning of the year. And obviously, when we got to April, we had that huge dip. Everybody was coming on, and analysts as well as many of the folks that are voices on television and radio and everything else. And they were so negative, and I didn't see the negativity. It didn't make sense to me. It seemed to me that it was so hated that it was actually going to cause this thing to make the kind of a move that we've seen, I think, throughout the year. Now, it has not been a perfect line from bottom left to the upper right, but there's been some pullbacks there. That's exactly what a healthy market oftentimes does, as well as I like seeing when markets don't always have the same leadership. It's not always been technology. Technology certainly had a huge influence, but it's been financials. Take a look at what the financials have done this past year. Absolutely outstanding. Then you can shift over at times where it's energy's turn to make the next move. So it hasn't been just driven by a couple of stocks, 7 stocks, whatever you want to say. This has been driven by the full market and just each category of sectors taking their next moment to be able to pull up the markets. And I think it's been very healthy. When I see that, I like what I see, and it's given me the opportunity to kind of lean into it with a much more of a bullish stance.
And along with that hatred also came a lot of fear. We often have these conversations about markets being afraid or markets being overly cautious. But despite that, we didn't see risk appetite disappear. What signals are you watching as we head into 26 that's telling you, if at all, that investors are still willing to take on risk?
Yeah, just watching what we're seeing, especially with the unusual option activity that we see in the options space, where despite what we hear or watch on television, we're just going off of where's the money flows going to. And I'll tell you, on a very consistent basis, whether it's the S&P itself through the spiders, or it could be the individual names, and these are some monster individual names out there, including some of the areas where people are just, I don't want to say that they're hiding, but they're a part of this whole thing. When you look at gold, you look at silver, absolutely unbelievable performance, especially from silver. Silver has doubled the move that gold has moved, and we've seen options just giving us all of these hints that somebody out there thinks that the market is much stronger than a lot of the other folks. And we've seen some pullbacks. We've seen also the volatility index spike up to major numbers. I mean, outstanding numbers to the upside, and then immediately pull back. And I've been talking to a lot of the subscribers that we have at Market Rebellion. It's gotten up to 20 many times, and it's gotten over 20, but it cannot sustain and pulls back, and I think that's been a very bullish side of the story as well. The fact that the implied volatilities of stocks, along with the VIX itself, have been coming down, down, down. I think that's been a very big positive for all of us.
And let's talk about metals quickly. We had 2 consecutive back-to-back days of record highs for both silver and gold. I'd love to know your outlook on the metals as we go forward. I get these huge numbers from some guests and other guests who say, they may stay range-bound in 26.
Well, I can tell you this. Most recently, we have seen some unbelievable, still very bullish activity in the options world, especially with GLD. SLV, silver, has seen it as well, and they're going out a little bit further. They're actually going all the way to April with some of the options that we are seeing that are being bought out into the future. But the GLD itself, boy, we've seen, just in the past week, we've seen some monstrous trades, spread trades. So they're actually, trying to take away some of the risk that they've got on. But we're talking $15 and $20 spreads, 113,000 options being traded in a couple of those spreads. It shows you that there's still an appetite, I think, right now for both silver and gold. Silver's been incredible. At some point, I think we're going to have to see some sort of pullbacks, and this will affect a lot of what's going on in the rest of the markets, because silver does actually, a big piece of what silver is is part of the world of the markets that we talk about day in and day out, semiconductors and so forth. It's something that demand is actually going to be a negative effect, I think, on some of these companies because of the fact that silver has made the run that it has.
Yeah, silver an important part of the industrial conversation as well, of course, with the AI trade. So as you just mentioned that it may more broadly affect the markets too, what's your equities outlook for 2026?
You know, there's certain areas that I absolutely love. One of them for sure is the financials, and we've just watched this growth that we have seen across the board, whether it's Goldman Sachs or JP Morgan. You just see some of these Morgan Stanley. But I'll tell you what, the investment banks are the ones that I like the very most. And I look at somebody like Citi. Citi has been lagging from the standpoint of the price to book level. It's actually at a 1 times price to book, where we see some of those other names, and I love those other names, but they're at 2 times book, 3 times book. So they seem to be, at least in my opinion, a little bit more expensive. I think Citi has the best legs here for the future of 2026. Now, will it last for the entire year? I can't make that call, but I can tell you that I think going into the earnings cycle as we get into January and the first quarter, I think Citigroup is one of those that's going to continue to be just absolutely spectacular, just because of the fact that we still have M&A going on. We still have a lot of different things going on for those financials, especially investment banks, that I think is going to power it forward.
And Citi certainly had a strong year so far, up about 74% in 2025. Now, big tech, what's your outlook on big tech, and do you have a favorite name here for 26?
Oh, I absolutely do. I look at Google and I see so many things. You know, when we got the earnings recently, they were absolutely spectacular. I think people were blown away, and if they weren't, they're crazy, because they should have been blown away by the numbers. And even the fact that you've got double-digit growth still in search is absolutely incredible. And what they've been able to do in other areas of the market as well. I mean, it's just the growth in search, I think, does stand out. I look at the cloud growth as well, which is up 34%. I think Google has got it all going on. I think it's very, very special. It took them a long time on the cloud side of things. They jumped into AI. I think they're starting to make a pretty substantial move in AI over OpenAI as well. So I think they're really sitting in a great spot. And I know that this has been a great year for Google. I just don't think it's over. I think there's still plenty of room in 2026.
They certainly made their way to the top of the Mag 7 in a quick and impressive fashion here, but you're not the first person that's expressed that sentiment about Alphabet either. Let's talk about industrials. We're talking about silver and its importance as an industrial metal, but that space is one that keeps getting highlighted as a potential one to watch. Do you like anyone in industrials?
Yeah, I really do, and it's funny because Caterpillar is one of my favorites, I think, right now. And why is that? Well, because of the effects that AI, what does AI need? Well, they need a lot of heavy machinery. They need a lot of build-out. They need a lot of generators. Well, who are they going to go to for that? Caterpillar. And I think that when you look at this stock and the performance it's had in 2025, it's only going to go higher. This isn't over yet. There's still a lot of the build-out side of it, and that's where I think Caterpillar really shines. So despite the fact that this is another one that looks phenomenal from the start of the year all the way to the end of the year, I think this is another 2026 story that can add on to where we are right now. Yes, the PE is a little stretched, but is it stretched, or when we get the next earnings, are we going to elevate that even more? I'm really impressed with what Caterpillar has done and what I think is going to happen in 2026.
A lot of companies set to potentially benefit from this AI build-out. Caterpillar trading 60% higher on the year in 2025. Pete, we appreciate you taking the time on Christmas Eve to be with us today. That's Pete Najarian, and Happy New Year to you, co-owner of Market Rebellion. And we've got plenty more for you today on Trading 360. Next, of course, we've got the big three: 3 stocks, 3 charts, and 3 trades. Richie Cat will take us through the technicals, and Don Kaufman will join us to take us through the trades for Tesla, Lululemon, and the Silver Trust ETF, SLV. That's next on Trading 360 on Schwab Network.
from the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get up there.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks, 3 charts, and 3 trades. Rick Ducat, of course, joining us to take us through the charts. Here to take us through his trades is Don Kaufman, the co-founder of Theo Trade. Don, great to have you with us. I know last we spoke, you said no Santa rally. Santa comes tomorrow. I'm seeing green on the board. I'd love to get your thoughts on if you're still holding strong that there will be no Santa rally.
Oh, this is mild drifting, if you will, to the upside. Yeah, markets were already at or near all-time highs, but again, I wouldn't read into some of the price action here too deeply. Throughout the course of this week, given the fact that the S&Ps are incredibly light volume. So nevertheless, right now, though, we are squeezing just a little bit higher. It's okay. As I said, it's rather light volume. But hey, look, we're printing these prices, and we're likely to print, if you will, an all-time high. But we've been within a stone's throw of that for a considerable period of time. Tech, though, is not the primary driver in this most recent move to the upside.
It certainly is not, but you do have a tech name to kick off big threes there. I guess you could argue a tech name here, a big tech name. We've got Tesla here coming off of their all-time highs. They've had some very favorable news and some favorable calls to close out the year. Walk us through this first pick in your big three.
Yeah, so, well, here it is. You guys wanted me to talk a little bit about some of the trades, some of the good trades I've had in 2025. First, I have to throw out the disclaimer is, as a trader, I have to tell you, I am not ever geared to want to talk about good trades I've had in the previous year. It's like a bad thing to do in trader lingo. Nevertheless, Tesla. So I have been very bullish on Tesla throughout much of this past year, and most of that actually stemmed, if you will, from some of the chaos surrounding Elon Musk. And for the most part, from $300 kind of on up, I'll just round it. It was the right in that neighborhood where I started to actually take a bunch of bullish call spreads. Look, this didn't have to do with the business model. It didn't have to do with the vehicle sales. It didn't have to do with forthcoming products. It just simply had to do with overall sentiment against Elon Musk, which eventually would fade. And it did fade exactly like that. And again, we were able to take a number of bullish call spreads throughout the course of 2025, riding Tesla nicely to the upside. I mean, look, I don't mind saying I caught it to the downside a couple of times too when the stock was massively overbought. But here we are, the end of 2025, and we're sitting effectively at all-time highs. And if you said that to somebody, 9 months ago, would they have believed you? 9 months ago, Tesla would literally be sitting at an all-time high, and I was told, even this past summer, this is a company that's it's dead, it's buried. We're well under, it was closing in again on a $500 billion market cap, and here we are, Elon once again sitting on top.
It certainly would have been an interesting conversation to tell someone at the end of the year we'd be talking about all-time highs on Tesla. Probably would have had a lot of fervor in it. But, Rick, as we look at Tesla, you can see some of these volatile movements that Don was just highlighting, that it did have a lot of erratic moves. But in the last several months, we have seen this really aggressive move to the upside.
Right, just for perspective, here was our old all-time highs. This was our tariff news shock event about 9 months ago, those lows near, what, 200 or so. And then a very swift move back to the upside. Now we once again sit at those previous all-time highs. We did make some intraday highs beyond that point. Actually, one high closed too. So the level here near about 482 or so, 489, that would be an important upside area to breach. 498.83 is the actual highs though. You can see here that the blue trend line has changed into a much steeper, much tighter white channel here, so we can kind of fit our boundaries between these two parallel lines here, potentially moving toward outside of the channel here today, but we'll have to see. It's, as Don said, it's kind of a light day. It's kind of a weird time for this, the end of the holiday season here. But a push above resistance could result in a more energetic breakout as we cross above those all-time highs. For now, price sits near its weekly 5-day EMA here. Our monthly 21-day EMA comes in near 461. RSI showing a little bit of bearish divergence here and threatening to break below this trend line here. But as we said, the day is still young. We'll have to see what happens heading into this final full trading week of this year. And when we look here at our volume profile study, 420 to 440 is the heavy volume area that really stands out close to current prices. So that could be a key area to watch going forward.
Yeah, and Tesla just in the last 6 months up 41%. So there's that impressive move that we've seen to the upside. Now this next one, I'd love to know where you stand on this one. Lululemon, pretty beaten down in terms of the athleisure business. A lot of competition in this space. Walk us through this one.
That's a big portion of it. So throughout the course of this past year, I have been very vocal about being bearish on Lululemon. So look, I know a lot of people come on here, these are the best trades of 2025. I'm actually going to be a bearish trade in 2025 that's worked out incredibly well. Again, I've been kind of riding this one to the downside with a considerable number of trades throughout a large portion of the year. Most of the downside that I caught inside of Lululemon is 350 and below. You can see a few peaks, a few valleys inside of the chart. It has been just incredibly tumultuous downside move. They're obviously trying to do a little bit of a turnaround. But look, this is the bottom line. Doesn't matter how busy the store may be around the Christmas season. They're getting their market share eaten into, and in a big way, Alo is the brand. It's kind of ironic because I head to the gym and so forth. I can tell you almost on a daily basis, I will see men, women, and otherwise wearing Alo. But Lululemon, for the most part, caters to most women. And I think that is a bit of a, if you will, defeating factor moving forward. Again, that market share is being eaten. You've got NFL athletes right now that are working specifically with Alo. This is what matters moving forward. I'm still bearish in Lulu in the very near term and moving into 2026.
Yeah, year to date on Lulu, they're down about 45%. So Rick, as we look at the technicals, what's the technical setup showing us as we head into 26?
Certainly a difficult chart for the bulls, as you all said. We can see that more recently, though, the horizontal levels are what really stand out because here, near 159, this is where we formed a consistent low point here. 159.25 was our actual intraday lows. Then, if we were to get a little more granular, you can see that we had a consistent high here at our green line near about 208, and then we also had this low point after our gap near 198 here. So to give you some more very tight specific ranges here, that's around where you might be looking because that is where we've had our lows most recently after struggling to break above that 208 point initially here. But for now, we are out of our channel type shape to the upside here, but still sitting on this supportive area after earnings, after we did have some upside movement here that has not really transitioned into a new trend. For now, we are between our 5-day EMA, our weekly EMA, which is our shortest term, and our 251 EMA, so our yearly. 235 is around where that one comes in here, so a close above that level would be noteworthy. The longer term of the moving average, the more significant it is when it's breached. However, RSI threatening to slip below the 70 level and below its own trend line here, so that would be more of a bearish signal if it were to happen. Finally, when we look at volume profile, our point of control, our heavy trading area, all the way down here near 168, very heavy trading at a significant low is often viewed as a sign of strong support here. Also, Right here, more volume near 200, so two very heavy volume nodes to the downside to watch for potential support. To the upside, things start to pick up here on a much smaller scale near 230.
All right, and you know, Lululemon, obviously competition, a big player here down year, in the last year, 45%, so just a little bit better. But this next one, we were just talking to Pete Najarian about silver as well, and he did throw out SLV here too. He's bullish on it. How do you stand, Don?
So, all right, backward looking, you want to go back into, early 2025, absolutely bullish. Right here, now I'm actually bearish. I'm bearish here. This is taking on a whole new theme. Look, whether you want to be bullish or bearish, I want to start with the logic of, you better be defining risk in here. I would use option spreads all day, every day in here. I'm not touching SLV ETF shares at this point, long or short. The risk is, I mean, you can taste it, you can touch it, you can smell it. You got to realize implied volatility right now inside of the SLV is record-breaking. You haven't seen implied volatility inside of SLV like this outside of crisis. We're talking, if you will, the COVID crash in 2020 was one of the last times that implied volatility inside of SLV has actually been this high. Before that, you got to go back into 2011, 12, and 13 when we were in Operation like Twist and we thought we were going back into the financial crisis. That's how high the implied volatility is in terms of SLV. Again, cracking 50%. It makes Tesla look non-volatile right now inside of SLV. So if you're backward looking, 2025, I've been very, very bullish on this. Moving forward, though, unequivocally, I'm bearish. I mean, this thing's exploded to the upside. Retail trade is all over it. It's only a matter of time before the gamma literally flips over inside of SLV, and we start to see some pretty wicked sell-side activity. Again, the outlook on here in very near term, I'm, again, very bearish on it.
All right, so Rick, I see you've got one of my favorite charts up here where you do some side-by-side comparisons of some actions we've seen in other metals and other alternative assets here. You know, what is silver telling us versus others?
Right, as Don said, very strong, very sharp rally in silver. These are the futures products, silver, gold, just the S&P, and then Bitcoin too. I just wanted to throw in too for perspective. Gold and silver were supposed to be the safe ones, I thought, but here we are with rip-roaring highs, 135% for silver here. So when we do look at silver, very narrow, very tight upward sloping channel once again, barely a pause. It's kind of hard to find any support here that was significant, but 61 is about where we closed previously before our most recent leg up. 58.5 was another notable high. If you do look more closely at some of these price levels, you can see these brief sideways to downward consolidative areas here. Those are bull flag, bull pennant types of activity. Those are things many traders are on the lookout for here. For now, though, backing off, we did make new intraday highs, but we are slipping a bit. We're below yesterday's close. So now, if we were to look at our moving averages, well, a very different picture from the ones we've seen before. In this case, they are all diverging far apart from each other. The faster ones are outpacing the slower ones. 5-day EMA right here in blue lines up with 62, 63 or so. That's around where you would see our trend line as well. So that could be a breakdown point. Not seeing bearish divergence or anything either. RSI is still going strong, still making new relative highs in that overbought area here. Pushing near 78 or so for a reading here. Finally, if we do look at our volume profile study, the nodes that we see, not really super big, but there are some more distinct areas here. For example, here near 52 or so, and here near about 56, 57. Those would be standout areas to watch to the downside in terms of this indicator at least.
Yeah, a massive move to the upside in this ETF this year, along with the price of silver, which has had consecutive back-to-back all-time highs the last 2 days, of 143% so far this year. Don, I want to thank you for being with us today for Big Three. That's Don Kaufman, the co-founder of Theotrade, and of course Rick Ducat, our lead market technician, for always being here to break down the technicals for us. Coming up next, we're going to spotlight the housing market as we take a look at how consumers were buying homes in 2025.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, technical analysis, morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network. Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are. Welcome back to Trading 360. I'm Marley Caden, live at our Chicago headquarters. It's time to spotlight the housing market. Joining us to help us do that is Frances Katzen, the founder of the Katzen team at Douglas Element, to walk us through some recent data that we've gotten. Frances, thank you for taking the time to be with us today.
Nice to be here. Thanks, Molly.
Yes, great to have you. Now, at the national level, we've seen existing home sales now have risen, for the past 3 months, the last 3 consecutive months. Do you believe this is the start of a real recovery that we're starting to see? Are buyers just learning to live with these higher mortgage rates?
I think it's both. I think part of what creates the recovery is the acceptance of the new rates, and that as the U.S. general rebalance has been slow, it's getting there. It's 0.5%, still down 1% year over year. But what we are seeing is that slow trend of rebalance has been the theme for 2025, and probably most likely what's going to catapult us into 2026. And I do think it's a little bit about what you mentioned earlier.
And speaking of balance, we are still seeing inventory below a balanced market. We've got many sellers who are still rate locked currently. What has to change for supply to meaningfully come online in a more impactful way?
I think the hardest part has been sellers coming to terms with the fact that they're now going to have to give up that really beautiful rate that they've had, below 3% or averaging 3%. But I think they're willing to meet the market because what they're looking for is a long-term play. And there's a lot of opportunity right now. And I think the buyers that are being decisive, and I think 2026 has shown us by the end of this past year, which has been staggering with an uptick of 34.1% in contracts signed. I think that's an indication that market demand with buyer decisiveness are coming to terms with these rates.
So you just mentioned this uptick that we've seen in the contracts, but home prices are also continuing to rise alongside those higher borrowing costs that we've been talking about. You mentioned demand. Do you think that signals that demand is getting stronger or is stronger than expected, or is it that supply is simply too tight?
Both. I think that we have a lack of supply. We're still only growing our supply by 7.5% over the US, which is really not that high. We have a different ecosystem in Manhattan, which has grown its supply by 32.4%. I think also that, is that we are seeing that people want to get in because it is opportunistic, because the sellers want to meet the buyers now.
And I know you're a New York City luxury dealer, so let's talk specifically about that market. You cited that you've seen explosive growth in contracts that are north of $4 million in New York City. Do you think that this is the return of global buyers? Is this domestic wealth creation that we're seeing? What's driving that?
Global capital has always found New York a magnet. There's no question that the wealthy, financially, intellectually, culturally, all want to be here. They are taking the long game, and I think the long game and long-term appreciation with prestige focused on quality, especially with luxury rental, as long as that maintains, we hope that maintains in January with the new mayor.
And with these new listings rising in New York City alongside of this increased demand that we're seeing in New York because global wealth wants to be there, because it is the headquarters of so many important things, how important is that balance for the new listings to keep rising alongside demand to keep the market healthy rather than it becoming overheated?
Very good point. I think the big issue right now is we've only got 4 to 2 months supply in the US, which is really not what you want. Typically, you want a much more robust supply, which I think is part of what we're dealing with, trying to get. We're still below a balanced market. And so as we start to infiltrate that with more listings, hopefully that will start to initiate more movement. But we are seeing it in the ultra high end, without a doubt.
And as we look ahead to 2026, let's focus nationally here. Do you expect housing activity to broaden beyond the high end, or does affordability keep this as a bifurcated market, like this bifurcated economy we keep talking about?
I think that there is a general demand for shelter and growing need. And I think as long as there is infrastructure, zoning, and family demand for certain locations, you're going to find even entry market trying to get in, because the long-term play is the decisiveness of what we're going to see play out, I think, in 2026.
Francis, we appreciate you taking the time ahead of the holidays to be with us today. We wish you a happy holidays and a happy new year. That's Francis Katzen, the founder of the Katzen team at Douglas Elliman. And coming up next week about the disruptors, we'll be taking a look at Intel after NVIDIA is reportedly no longer testing its chip-making process. That's next on Trade 360.
Stay connected to the markets, the Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
And on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Caton here in our Chicago headquarters. Let's head up to the New York Stock Exchange for a check on the markets and welcome Nicole Catalidis, host of the Opening Bell and the Watch List here on Schwab Network. Good morning to you, Nicole. We're both in our Christmas red. Merry Christmas Eve to you. We're 2 hours into this shortened trading day. What's catching your eye this morning?
And to you as well. A lot of excitement here on the floor. The holidays are upon us. Tomorrow we're off. Today we close at 1 p.m. Eastern time. I mean, first and foremost, record for the S&P 500 today. We were saying how many points away we were yesterday and the last few days, and here it is. The Santa Claus rally, when the real numbers actually start today. It's the 5 last trading days of this year and the 2 first trading days of next year, folks. So today is the day that we start calculating the Santa Claus rally. And if you go back to the 1950s, 77% of the time you do have an up arrow, and that up arrow equates to about 1.4%. So let's see if we get some of that. I mean, already you're seeing we're at session highs on the Dow. I can see that right there. I can see that the S&P is up 23 points. You have names like Nike, Micron, Citigroup, Costco, Dollar Tree, Target, Block, and Pulte Group leading the way on the S&P 500. Nike, of course, getting a nice pop because Tim Cook is doubling down, really believing in the turnaround that's happening at Nike, and put in about $3 million here for his investments into Nike. So that's one name that is on the move there. We saw a nice call on Tesla, though I'm also seeing some issues and recalls and things like that. I'd say the big picture is that this is, among the final trading weeks. It's a shortened trading week. It's been a great one thus far. Today is Wednesday, and we're seeing that the major averages are up about 1%, so people are pretty happy with that. The big picture here is it's mostly green as we are getting ready to hit that closing bell soon. And jobless claims came in, fewer claims than expected. And we got that GDP print, which was stronger than expected, though it was delayed. And mortgage apps, well, those have been falling because maybe there's a little less interest in the housing market.
Yeah, that's the seasonality, right? But let's talk about this Waymo update we're getting from Alphabet-owned Waymo. We saw their news. Tesla hit their all-time high on the backs of Waymo after it experienced this power outage in San Francisco. But they're providing an update this morning.
Really interesting is that Waymo, autonomous technology is trained to know the dark. So if there's a four-way stop sign and it's dark, the Waymo cars and all these autonomous vehicles sort of know what to do. But they do also look for checks along the way. And when we had this big power outage, PG&E power outage in San Francisco, where 1/3 of San Francisco was out of power, and disabled traffic lights, and you had manual, cops and things doing this manually, and there was citywide gridlock. It was confusing, and the Waymo checks just were out of control and brought frustration to drivers. And so Waymo says they will update and implement fleet-wide updates on the software after what happened with this darkness overall. And so this is just one thing that, it's something new. But with so many traffic lights disabled, they weren't able to get those safety checks along the way. So while it can navigate in the dark, it also does that safety check. And so it was missing that, and drivers were asking for more and more checks. And so that kind of confirmation really piled up and caused delays. And then you also saw citywide gridlock. So working on perfecting the world of autonomous technology and autonomous vehicles. And you mentioned Tesla. I mean, we saw the robo-taxis doing so well in Austin, Texas, and now, really probably heading to more than 30 cities in the new year. And so we're seeing a lot of price targets really on the rise for Tesla, too.
That certainly has been, and it also raised some interesting regulatory questions about how many autonomous vehicles should be allowed in a city center area. So lots to discuss there that I'm sure we'll continue talking about into 2026. But thank you, Nicole, for being with us today. That's Nicole Panelides. And now it's time for the disruptors. We've got George Tillis with us, our senior markets correspondent, to talk about Intel. Reuters is reporting today that NVIDIA has paused testing of the company's 18A chip manufacturing process. What can you tell us about this, George, and why is this so significant?
Well, it is significant, I think, in the context of the price action today. I mean, the stock is down over 1% on this news, Marley. But I think the larger picture is, if you think about what NVIDIA has been doing in terms of partnerships with Taiwan Semiconductor here in the United States, obviously TMCS is essentially a major competitor of Intel in the foundry space, but the unique value for Intel has always been that they are a chip designer, but also a manufacturer. And considering, again, that the U.S. government has basically taken a stake of around 8.9% in Intel alongside SoftBank, and NVIDIA also is an investment partner in Intel. Intel's technology from a manufacturing standpoint may not necessarily meet the specifications that companies like NVIDIA and Broadcom really need. So essentially the news is really about, NVIDIA trying out their technology programs or their manufacturing programs is not suitable, at least right now, for their GPU technologies. But nonetheless, I think the value proposition, again, for Intel is that they do produce many of the data center components and CPUs, but also field programmable gate array chips as well. So again, from a GPU standpoint, the specifications in terms of manufacturing that Intel supplies the market may not necessarily meet those, which are very high standards for Broadcom and the application-specific integrated chipsets, circuits, as well as NVIDIA's GPUs. But again, it's a little bit of a pullback for Intel, but not necessarily a game changer in terms of their progress going forward to maintain its boundary position here in the United States.
And George, as we take a look at Intel here, trading down 1% on this news today, if we're going to structure an example trade here, how would you look at it? Because year to date, I mean, they're up 80%. They've had some, pretty impressive performance in the last month, seen a pullback, but outside of that, have been doing pretty well this year.
Yeah, they have, and that's the thing. I think there's quite a bit of value in Intel. It just comes down to how do they reset their manufacturing relative to the demand design of their chips. The other thing you might keep in mind is if you look at a 3-year weekly chart, you'll actually notice last year in July there was a huge move to the downside. That was based on a $19 billion impairment charge. So since then, the stock has been moving higher. And as of late, the stock has pulled back from the highs this year, down about 20%. And it's a very volatile stock, again, because they're still reorganizing their business. So with that high implied volatility in mind, there is potentially a shelf now as the stock has pulled back to the 20-week moving average, which is positive and still rising. Again, because of the daily chart, there's a lot of volatility. So using that weekly chart and that 20-week moving average, I'm going to structure a very simple trade where we capitalize on high implied volatility, selling potentially down to the $34 level that it could pull down to. I'm going to sell a $34 cash secured put in January. 23 days to expiration, you could earn about 75 cents a share or $75 a contract. So in essence, I'm still playing the pullback in Intel right around that 20-week moving average, forgive me, that $34 level, and that 75 cents per share. If you basically look at that between now and expiration in 23 days, is about 2.2% yield to strike price. And that delta on that put that you're selling is about 29, which implies about a 71% probability of profits between now and expiration. So again, the probabilities line up, price action lines up, and again, it also compensates for potential pullback to that 20-week moving average.
All right, George, we appreciate you being with us to break down the latest on Intel and also NVIDIA mentioned here as well, and for that example trade. Merry Christmas Eve to you, and I hope you have a happy holiday. That's George Tillis. Coming up next is our 360 round. Thanks, George. Coming up, we've got our 360 round. We'll take a look back at Meta's performance in 2025 and expectations for the tech giant as we head into next year.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Putting your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Alice Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech and energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock. And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. We really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren planning for their college educations. Someday it'll be their turn.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market, weekdays at noon Eastern, live on Schwab Network.
Big play gonna have to come down to the day.
Welcome back to Trading 360. I'm Marley Caden. It's
Marley.
time now for the 360 round. For that, let's bring in our panel to discuss Meta and the year of this Mag 7 name in 2025. Joining us today, Dave Nicholson, the Chief Research Officer at Futurum, and Ali Mogharabi, the Senior Equity Analyst at West End Capital Management. Appreciate you both taking the time to be with us today.
Right.
Dave, let's start with you. You know, when you look back at Meta and the year that they've had in 2025, what sticks out to you most?
First of all, Marley Christmas. I've been waiting to say that. I think what sticks out most is really the question of this CapEx investment that they've made in 2025, approaching $75 billion, and really the burning question of will that be paying off in 2026? That is the number one thing. Will these investments in AI pay off in 2026?
All right, and Ali, coming over to you, and no pressure on how much I liked that Marley Christmas comment. To either of you, that was great. You know, Dave just mentioned the CapEx spend that we've seen, but they had strong ad performance this year, solid top-line growth in 25, but we're still focused on this massive CapEx spend. Do you think that Meta spent too much too soon in 2025?
Yes.
Yeah, in our opinion, yes, they did spend too much too soon. Obviously, the ROI remains to be seen, but I mean, it's not just this year.
Low blow.
$70 billion that was just discussed, but it's also next
Yeah,
year.
getting job there.
Analysts have it.
Say goodbye.
You know, above $100 billion, and you've got that free cash flow getting cut in more than half. I think reduced by around 60% next year. So, you know, this is a company historically known as pretty much a cash cow. But when you see that drastic, very aggressive investments in AI on the CapEx side, you know, you really want some ROI on that in the near term, and maybe not necessarily, you know, 5-7 years down the road. But on the other hand, as you mentioned, I mean, the Q3 numbers were good. You know, top line growth pretty solid. I mean, they are getting more interaction, more time spent on that platform by the users. Obviously, the AI-generated content is helping them a little bit, but in terms of the ad impressions sold, the average price of ads, all of those up nicely in, you know, double digits. So, you know, if they, in our opinion, if they continue to focus on what they do best, and by the way, AI is actually helping on that front in terms of making the ads more effective, the ad creation, the ad placement, all of that stuff. I think the market will have more confidence in the company, and therefore, you know, you could see the stock go up. But all of that remains to be seen.
And Dave, Ali just highlighted that their free cash flow is expected to fall sharply, potentially down 60%. We're going to see some margin compression, potentially into single digits here. At what point do you think that becomes a valuation problem? And how much free cash flow erosion do you think investors will tolerate in the name of being a long-term AI leader?
Yeah. Great question. I just want to piggyback on this idea of people looking at Meta's success in AI or lack thereof to think about Meta. It's going to make a difference in terms of what people think about the entire AI proposition at large. Imagine you're a company that doesn't have the resources or access to the Aladdin's cave of data that Meta has. And you're the CIO trying to tell your CEO that you're going to make money and save money with AI, but if Meta can't, who can?
Maybe you didn't tell them that.
Yeah, the kind of free cash flow
orthodox blop
that can happen. I think that 2026 is the year of reckoning. People are going to follow those numbers closely. By Q3 of next year, I would say people are going to start making some serious adjustments in their portfolios if they're not seeing real ROI from AI, at least for Meta.
Yeah, it certainly is going to be a metric. I think people are keeping.
That's what I tell my shareholders.
Big names, and Ali, there has been.
Dear shareholders, I gather you here today to tell you that I spent $200 billion in a sector that I knew that wasn't going to be profitable. Now, you know I'm a genius. The only reason I did this is that maybe one day all chips will be equal. You won't be able to tell us by the scent of our burn, by how much we get done. Just remember, it's an investment into our future. Okay, I'm done.
As, let's say, an Alphabet.
Well, that was a good one, Jimmy.
Alphabet has the entire full stack, and Alphabet can actually monetize
Really
its
was.
own AI technology very effectively, in addition to becoming more productive and operating more efficiently, as we've seen Meta do. So that's a big difference. And the effectiveness on the Alphabet side is obviously, the more efficient, less powerful TPUs that these guys are using more, and just how well they've improved on the Gemini 3 front. So I would view, for example, Alphabet.
Well, I have a sense of humor like that.
And just one more thing I wanted to say. We did start trimming. We don't currently have any position in Meta. We did start trimming.
Oh, you don't?
I think it was in late August, and we
people nuts.
In late October completely. But we do have a very good position in Alphabet and Google.
Oh, that's not good.
Looking at the chart, wasn't a bad time to make your exit there for Meta. Taking a look now, talking about, you mentioned Gemini there and the competition in these large language models. Dave, coming
Not
over to you,
good.
Meta was once viewed as the clear leader in this space in terms of open source AI with Llama, but we've seen this competition just intensify at such a rapid pace here. Is Meta losing ground on the model side? And also, does open still matter in terms of a strategic strategy if monetization there isn't immediate?
Yeah, I don't think so. I would echo the comments on Alphabet. Completely different game. I would disagree that Meta was seen as a leader. I think that folks really examining this issue just saw a bit of a dip from the stage on behalf of Google Cloud specifically, and Alphabet. So no, that whole idea of having the complete stack, it puts Meta in a completely
Well, we'll change attitude here. I agree.
The one thing they do have is this idea of an AI interface, and they own all of this data because they know all of these things. So will Meta glasses make some sort of inroads? I think Meta finds itself in between a rock and a hard place position, because it's like, are they an enterprise provider for AI services,
Merry
or
Christmas.
are they a consumer company?
Yes, it is. Merry Christmas.
Unclear. So I think they're going to get squeezed by the Apples and Google Android alliances on one side, and the Oracles and the Alphabets and Google Clouds on the other.
And Ollie, you've both been making clear that 2026 is the year that Meta has to prove that its spend.
I think it has more gas in the tank.
Case, what metrics should investors be watching most closely?
I would say on the capex front and margins, and hopefully maybe a slowdown on the hiring side.
I would say
an arms race, and it looks like Meta has been really the most aggressive on the hiring front, on the capex front. So we do need to see
Gonna be a long day.
Return on investment. That's pretty much it. Let's hope that can be.
We'll trade on hope in our academy here.
A slowdown or a deceleration in that capex growth that we've seen the last 2 years, a year and a half, 2 years. So that's what we're looking for. But yeah, it requires a lot of patience if you're in that game.
Right, Meta this year performing about 14% higher, right in the middle of that Mag 7 pack. But I want to thank both of you for being with us today to highlight Meta's 2025 and also take a preview for 2026. And I'm going to steal Dave's phrase and wish both of you a Marley Christmas, because it's my new favorite holiday greeting.
Merry Christmas to you.
Thank you. And thanks to Dave Nicholson, Chief Research Officer at Futurum, and Ollie Maghrabi, the Senior Equity Analyst at West End Capital Management. I want to thank all of you for joining us today on Trading 360. I'm Marley Caden. You can download our free Schwab Network app, available in the Apple App Store, and you can tune in 24/7 on SchwabNetwork.com. To all of you who celebrate, Merry Christmas to you and Happy Holidays. Stay with us. Fast Market with Diane King Hall is coming up next.
Schwab Bank Investor Checking. the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I programmed 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are. Here on Schwab Network, I'm Diane King Hall. Merry Christmas, everyone. We are now in the final hour of trading on Wall Street here at the New York Stock Exchange as investors wind down a holiday-shortened trading day. Let's get into it with a quick check of your scorecard as we enter this last hour. The S&P 500 has a gain of about 1/3% there. Almost every sector of the S&P 500 is on the plus side. The gains being led by consumer staples, financials, and real estate. Energy is the holdout, for lack of a better way of expressing it. Has been flip-flopping between the positive and negative. We'll see if ultimately all 11 sectors of the S&P 500 finish in the green. The Dow right now has a gain of 0.5%, rallying triple digits up 280 points. NASDAQ 100 better by 0.25%. Russell 2000 has a gain of 0.2%. So Santa Claus is indeed coming to town. Here's the roadmap for today's show. We'll look at example option strategies for ServiceNow. Plus, we'll dive into Lifefolio data on Reddit, and Intel is also on our radar today. Now that we've got the roadmap for today's trading action, it's time to bring in my co-hosts and trading veterans. You've got Tom White in our Chicago studio, and Kevin Ing's joining us. I think he's live at Santa's workshop. I see the tree in the background. All right, we're on record watch in a thin trading day, but the S&P 500 is adding to its gains today. Tom, what's your take when you look across markets?
Yeah, fifth straight day of gains here for the S&P 500 as it hits its all-time
Yeah.
high. maybe in the crosshairs, that 7,000 level going into the end of the year over the next few sessions starting on Friday. But I think one of the things that I kind of wanted to focus on was, everybody keeps on talking about this unloved rally that we're having. Well, I think investors are
about that.
And, there's a lot of good reasons for the rally, whether it's earnings, whether it's the easing cycle that the Fed's on, whether it's some of the data that we
Very loved.
Right? We got jobless claims that came in, down 10 grand from last week, 214,000. Those are low levels on a weekly basis. The GDP number that came in over 1% above the expected 4.3% for Q3 on that prelim read.
Yeah.
And also inflation data, CPI 2.7% below the 3% expected. Core at 2.6%. So there's a lot to cheer on here, and I'm tired of the Ebenezer Scrooges coming out of the woodwork and talking about an unloved rally here, Diane and Kev.
Oh.
No, right? Scrooge and the Grinch need to take a seat. Kevin, what's your take when you look across markets?
She's right.
I think we're ending the year on an extremely positive note because of the fact that despite all the naysayers and despite all the fears about, you name it, tariffs, inflation, all it's just not showing up in the data. And meanwhile, crude oil prices are significantly lower over the last few months. They're firming up here a bit now, but overall inflation outlook is getting much better. And the only worry, like I said this morning, was the labor market. And though we appear to be in a no hire, no fire labor market with jobless claims data extremely low and strong, we're also not seeing robust jobs. That said, hiring is an issue. And so all things considered, President Trump has plans for next year for housing and aggressive moves on housing. And all these things are probably going to start with lower interest rates, and then they're hopefully going to start with, a part of the U.S. economy that has lagged, frankly, for a decade and a half now, since the 2008 financial crisis. There's the next leg of this, I think, economy, and that is housing and home ownership, guys.
Kevin, so with the lighting there, it looks like you're about to have a visit from the three wise men with all the sunlight coming in there. It does, right, Tom? All right, so we got a temperature check. You bring up the economy, Kevin. We got a temperature check on the job market. Weekly jobless claims that coming in better than expected. Tom, what's your take?
Well, I think you take a look at it. It's kind of a bifurcated look at the the employment levels that we've seen. You've got an unemployment rate at 4.6%, but then this weekly number, this up-to-date number that we're getting, is still reflective that the jobs market's still in a good spot. 4.6% unemployment rate, that's still full employment. Now, if we start getting numbers at 4.8, 5% on unemployment, that's, I think, where you're going to have to raise the red flag at this point. But the jobs market, no hire, no fire type of situation that we're in. Wages are
That's right.
Inflation expectations, so that's a good part.
Right.
And if we see that pickup going into 2026, guys, I think that's going to maybe reset maybe some of those jobs data. Remember, a lot of the jobs that we've lost have been in the government, which may be a positive thing in the long run, but that might be, the thorn in the side of why you're seeing that unemployment rate go up. But heading into 2026, if we continue to see these numbers around these levels, I think you're going to start seeing maybe a little bit better environment in the jobs market. I think that's what the Fed's focused on
There's
now,
your second wind.
especially if those inflation numbers continue to come down. But I don't think there's any red flags to raise yet on the jobs market.
I thought something similar goes back to that theme we've been talking about this year, low hiring, low firing. Kevin, what's your take? You had the numbers when they came out fresh at 8:30 this morning.
Yeah, the jobless claims data is still solid, right? The mortgage apps data was a bit weak, but housing has been struggling for a while, as you know. So I think the labor market with the jobs data we got, like I said, People are starting to watch the unemployment rate, but remember, the wages data on non-farm payrolls was lower than expected. Now we got CPI data that was lower than expected. So we're getting some inflation data really favors. And I'm surprised, I told Tom this earlier this morning, I'm surprised that the rate cut odds early in 26 aren't higher than they are. You know, that GDP data pushed some of the numbers back, but as long as inflation is coming down, remember, rates were high because of inflation. If inflation fears are being removed from the market, then rates have more room to come down. That's why they were raised in the first place to restrictive levels. So I think as long as we keep getting, weak jobs data, and remember what Tom mentioned was the U.S. government has lost about 270,000 jobs in the last year. A lot of them showed up in the last jobs report because of the October jobs report, because the long-term furloughed people finally went on the numbers. So that's something we probably knew for a while. So the labor market is firm despite the government not hiring, and inflation is just no longer a concern, guys.
That we're watching in memory shares of the memory store stocks, they are higher today. We do have a light day on Wall Street, but it feels like investors are going to back to things that have worked. Micron is already up more than 200% this year, adding to those gains with a 3% advance. SanDisk also moving higher. Tom, what's your thought?
Yeah, this is the sector of the year, I think. If you take a look at some of the moves, and you mentioned the Micron up 238% this year. Western Digital, the hard disk drive maker, 297% gains so far this year. STX, Seagate Technologies in there. You mentioned SanDisk rallying since that spin-off of that company. So this kind of highlights maybe the inner workings of AI infrastructure build-out, right? The components that, besides maybe NVIDIA, that are doing really well. The demand, the amount of memory needed for these data centers compared to maybe the legacy side of their businesses is much greater, 4 or 5 times more memory needed, sometimes even more than that. So pricing's really good right now. High bandwidth memory. As far as Micron, starting to take market share away from Samsung and SK Hynix. That's a bonus for them because that's a higher margin portion of their business. But then the legacy sides of their business, the DRAM and the NAND, those are exploding as far as pricing because there's not enough capacity right now. So everything working out really well. One caveat in this, in this basic sector of memory chips is that you have to watch out for. It's a very cyclical side of the business, and once prices turn down, that's when you're going to see, big, maybe volatile moves in the stock. But right now, just even from Micron's last earnings event just over a week ago, pretty good outlook here for the sector in general.
Absolutely, huge moves for Micron and SanDisk, the move over there, about double what we've been watching, or more than double what we've been watching in Micron. What's your take as you look across memory and the momentum there, Kevin?
I'm just trying to find some individual unique story on either of these stocks, Micron or SanDisk, and the story was they're up big today, right? I didn't see any specific story, but if you look at the percentages that these are up, Micron started the year in the 60s. And now it's 200, I would not be able to sleep if I was along some of these names, knowing the percentages that they have gained throughout the year. That is some big numbers. And Tom mentioned the cyclicality of this business and the downturns that happen would definitely frighten me if I was long a significant amount of these shares. Doesn't mean they can't go higher. They're reflecting the strength in AI and demand for these products, even maybe more than NVIDIA is, of all things. So yeah, you look at the absolute video game numbers that these stocks are rallying, and you wonder, can they do it again next year? I don't know, guys.
That's a good point because, in terms of how, if you look at it on a longer term basis, several years, for instance, most of the move that's happened for both of these companies have happened not just within the past year, but really within the past few months or so. For both of those, or several months, I should say. So within the past 6 months. All right, let's talk Nike. Those shares accelerating today. We got the news from regulatory filing that Apple CEO Tim Cook snapped up nearly $3 million worth of those shares. Tom, what was your take when you saw that?
Yeah, I mean, I think his total allotment now, he bought, 50,000 more shares. He's got 105,000 shares total now. Paid about just under $3 million for this last set. And if you looked at the price action in Nike since its earnings and probably over the last 3 years, why not, right? Nike's paying you. You're a board member, Tim Cook. So there you go. Another director bought about $500,000 worth, about 8,700 shares. Also, so maybe a little bit of reassurance for investors. That's why you're seeing the nearly 5% pop today. Remember, North American sales resurged a little bit, up 9% last quarter to $5.63 billion. Greater China, that's the concern that every investor out there has been focused on. That market dropped 17% to about 1.42 billion. Tariffs, a negative impact. CEO Elliott Hill really trying hard with this new win now type strategy that's not doing any winning over the last couple of years and ever since he got in office. But this is a big barge that he's trying to turn at this point. But there's some promising signs with the sales in North America up 9%. So yeah, if they can turn around China, that might be the story over the next year or so.
The challenges of staying at levels, not just you mentioned the past few years and how it's been, flailing, but we got to go back 10 years. And if you bought it 10 years ago, I mean, you just marked time, and there were better places to have parked your money. But obviously, Tim Cook has some conviction there. There's a reason for that. Kevin, what's your thought?
I think how beat up Nike is, and remember, the real problem is competition and small companies cutting into their market share like Hoka, right? And owned by Deckers and like On Holdings. These shoes, I'm a gym shoe guy, so I look at the landscape a lot. And a lot of these businesses, they have a lot of shoes on a lot of feet. And remember, Nike's in apparel, but they started out as a shoe company, right? So it's fascinating to watch this. Nike's still number one. Nike's still the largest of the group, but boy, there is some stiff, high-quality competition. And this is a company that under this new CEO or the return of a lifer at Nike, they have to start innovating again. Tim Cook, vote of confidence, remember, like Tom said, he's on the board. So, but a unique show of confidence stacked up about 4.5% on that news. So a good day for Nike, but still only trading $60. You go back 3 years on this, it's up to 131. It's more than half. It's less than half its value. So yeah, firming up here, making a long-term bet on Nike. Interesting.
All right, indeed. All right, let's put a pin in that conversation there. We've got bull versus bear coming up. The guys get their example trades put together for service now. It is seeing shares take a step back today. We'll have more Fast Market after this break.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. A big security bet for ServiceNow. Somebody says it is buying Army, a rapidly growing cybersecurity firm, for $7.75 billion in an all-cash deal. Top brass say the move will strengthen ServiceNow's push into AI-driven security to help companies shore up systems from cloud to connected devices. The deal is expected to close in the second half of 2026. Of course, that's contingent upon regulatory approval. Shares are lower on the news. All right, let's throw on our Santa hats and welcome back in our co-hosts, Tom White and Kevin Hinks. It is bull versus bear time. We need Santa hats today, guys. Before we get to your example trades, guys, talk about your thoughts on ServiceNow amid this deal news. Kevin, I'll start with you. What's your thought?
Growth at all costs is what this sounds like, and it feels similar like the story of Salesforce, where they buy these companies, they overpay for these companies, and the street doesn't like it. And you can see in the price of the stock that this new, the way they're choosing to grow, and it wasn't only the latest, it was also MoveWorks that they bought. And they're risking their profit margin, they're risking their healthy balance sheet, and the street's doubting how a cybersecurity firm is going to fit into their business model. So, boy, for as positive as something like this and the CEO claims it is, the street has real doubts about this, guys.
You are right about that. What a comparison to Salesforce when you think about how Salesforce has performed this year, and there hasn't been forgiveness shown to Salesforce or patience around its strategies. Tom, what's your take?
Yeah, I mean, the stock's been under pressure all year, and then you come out with your biggest acquisition, $7.75 billion, all cash, too. And that doesn't, reverberate with maybe investors at this point. Their last earnings event was pretty good. If you ever listen to CEO Bill McDermott give an interview, it's pretty awesome because that guy's fired up and he's ready for everything. They still expect about 20% organic growth, but this is a lot of capital to outlay. Remember, this death of software as a service. A lot of people are predicting that AI is going to do it. Bill McDermott comes out and says we're hiring more engineers just due to the amount of business that they're getting. Now, their margins shrank last quarter about 1.8%, and that's not, a good thing, and that's probably why the stock has continued to move to the downside post-earnings, and it's off 36% from those all-time highs. But, you got to right the ship, but they're trying to expand their platform, and this security purchase of Armis is one of the ways. And as Kevin mentioned, and you stated, the fact that these companies are continually buying other companies, and that's a lot of outlay of capital. You wonder how fast or accretive it's going to be to their top and bottom lines.
It's interesting that you mentioned Bill McDermott, because obviously ServiceNow still believes in the vision of Bill McDermott. They've locked in his leadership with a contract that's now extended through 2030. Pay tied to performance, so maybe the street will eventually look at things differently. We'll see. It depends on how the performance is. So let's talk about the example trades that each of you is taking. Kevin, what's your approach today?
Yeah, well, Tom and Diane, mine is a paper money trade that reflects bearish tones. And so what I did, I looked at, now, for both my trades today, I'm looking at the January 16th and then the January 2nd. So I'm discounting December 26th and everything this week. And then I looked at a bearish put calendar spread. And what I did is I measured the expected move out till January 2nd. It's currently, I think, about $5 at 480, basically. And what I looked at here was the 148 put calendar. So buying the January 16th 148 put, selling the January 2nd 148 put. Just a 2-weeker, you still have an opportunity to extend duration to that January 9th expiration, but this is one that you look at the chart of the stock, it could be a drift lower over the next 9 days or so, Tom, but I'm focusing on the 148 strike here, Tom.
Yeah, let's break this one down. Just a 2-week wide bearish put calendar to the downside that gives you exposure about that 1 standard deviation move that Kevin mentioned from the current share price. Buying the 148 put in the January 16th monthly options that expire in just 3.5 weeks, about 23 days. Selling that same 148 put in the January 2nd weekly options that expire 9 days. Paying roughly about $1.60 debit. The debit you pay is going to be your risk on this trade. So about $160 per spread to get that downside exposure. Now, you can see here from the risk profile, you want the stock to go at or near 148 over the next 3 weeks or so, but you've got a range probably between about 144 and about 152 on the upside to be potentially profitable. As we get closer to expiration over the next 9 days, you'll have that potential to roll that short option to the next January weekly cycle that expires on the 9th. That'll collect credits, that'll reduce your risk, that'll increase potential profitability on this trade, but it's definitely a slightly bearish trade. Stock's currently trading about 152.80 right now, so you don't need a big move to the downside to start getting in that profitability zone on this type of trade, and it's a low input price. That means it's lower risk on something like this. And think about this, if the stock does start moving lower, from these low volatility levels, we might see a pop in volatility. This is a long Vegas strategy also, so it might be twofold where you can get the expansion of this type of bearish put calendar, but just about 3 weeks wide. So, Kevin, there's a bearish view on this stock. I looked at something a little bit more aggressive, bullish to the upside here, and I went out to that same January 16th monthly cycle. We don't have earnings on this stock until the 28th, so keep that in mind. This avoids earnings but takes advantage of a move higher over the next 3.5 weeks. So buying the 152.5 strike call one time, sell 2 of the 160 strike calls, and then buy 1 of the 162 strike call. So it's an unbalanced or broken wing call butterfly, paying roughly about $275 debit, probably trading $260 right now, so you might be able to get a little cheaper. Price discovery may be warranted on this stock. So keep that in mind also. But the debit you pay is going to be risk. So $275 is your risk on this, and that takes your break even up to $154.75. That's about $2 above the current share price. So on a percentage move, you don't need that big of a move to start getting to that profitability zone. Apex of profitability at or near 160. Kevin, this is a little bit more aggressive, but it gives you time. You got 3.5 weeks in this position. And you're offsetting some of the costs by doing an unbalanced call butterfly.
Measuring the expected move, right? Giving yourself duration, and then setting up an unbalanced call butterfly. $8 on the long side, $2 on the short side. Less than, printing about 260 right now, Tom. So you've got a chance. 260 goes to 8. That's almost 3 times your money. So this is one that's playing for a recovery in this name. The stock is beat up. So, but again, a risk-defying trade looking for a move up towards $160.
Yeah, and some people might go, well, why do you do the call butterfly as opposed to maybe just buying the vertical, the 152, 160 vertical that gives you almost that same look to the upside? Well, that's going to cost you about $3.20. So if it's trading 260 now, you've got more risk on it. But you can see here from the risk profile, even above the 162 level, on the top end of this call butterfly, you're still more than a double in profitability on that. So that's one of the reasons maybe you look at a call butterfly as opposed to a call vertical. You're risking a little bit more on the call vertical versus this type of butterfly, but then your profitability is greater above maybe the 162 level also. So keep that in mind. There are trade-offs on this type of trade, but the WPay on this one is your risk. But this is the bullish side. Kevin gave the bear outlook. There you go, Diane.
Choose your own adventure in our half day of trading that's coming closer to a close. Thanks, guys. We've got cash tags coming up. We've got new data from Lightfolio on Reddit. It's had a strong year this year. Stay right here on Schwab Network. Fast Market. We'll be back after this break.
Hi, I'm Alex.
I'm Dean. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Vardas, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall alongside Tom White in our Chicago studio and Kevin Hayes, parachuting in from the North Pole. It's time now for our cash tag segment. The team from Lightfolio sent along their latest data on Reddit. And when I look through these charts, it looks like Reddit is winning where it matters most, and that's advertiser interest. When I look through that, the ad visits chart, and I know you guys have had a chance to take a look at this data. Reddit's at the top of this list. Pinterest is following it, but by some distance. Tom, what was your take when you saw this?
Well, I think one of the things that stuck out, if you look at Reddit ads, this chart that we've got up that Lightfolio brings, I always like to give the caveat that this is coming off a low base. Remember, Reddit's newly public or relatively newly public at this point. But then you've also got to take into consideration as far as, the reach of Reddit, right? Last quarter, uniques that they call them, daily active uniques, they were up 19%, but their base is only 116 million users. I think that's one of the keys that we have to take into consideration when looking at this stock. It's had a good run so far this year, up nearly 40%. Needham put a buy rating and a $300 price target. They put it on their conviction buy list just yesterday, replacing Roku. But the growth might be there because their user base actually isn't that big. And I think one of the things that they noted was that this is all generated. This isn't generated from AI. It's user base generated information, and that's kind of what they were highlighting.
Yeah, when I go on Reddit, it feels like it's not like when you go on other social media platforms where the ads have completely taken over. So it looks like Reddit is basically lapping the others when it comes to advertiser interest, and that seems to be where it matters most because there's the potential for a growth trajectory here. Kevin, what was your take when you looked across this chart?
I think Reddit's got two stories. Number one, in the U.S., the advertising revenue and average revenue per user are exploding. That's really good news. Their EBITDA margin is now reaching like the best in the industry. That's good news. 30% revenue compound annual growth rate. Massive numbers. However, international, which is probably the next chapter of their growth, they struggle versus Meta with monetizing international. How about these numbers? The average revenue per user for international Meta platforms, $14.46, Reddit, $5.04. So they've got a problem with international that they've got to get better, but that's the next chapter, I think, of growth for them. The U.S., they are firing on all cylinders, guys.
A great point about that user behavior, because I know we have that user chart as well. And so there's a difference there because you have TikTok as a standout there. Reddit's not too shabby, but it's, you see basically massive user engagement on TikTok, up more than 30% there. Pinterest is even beating Reddit on this one. That's fascinating to me. Reddit platform, it looks steady, essentially. Tom, what's your take on that?
Yeah, I think you start taking a look at it. We always talk about that small user base or daily active uniques at 16 million users. I mean, the growth trajectory or runway that they have, if they actually can monetize this, and they don't have a lot of ads, so that's why that other chart that skewed their ads, ramp up, because they don't have a lot of ads yet. As they add more and more, unique users, that's going to increase maybe their visibility. Now the stock's had a great run. You look at that growth rate; it's only 4%. It's right in the middle of the pack here. That doesn't scream out that they're actually growing their user base enough. That's what I think one of the questions that you have to take a look at with this company. Can they continue to grow? Remember, or will they become the next Snapchat, where Snapchat's got 400 million, over 500 million users? They just can't seem to monetize their business as well as Kevin mentioned, as Meta maybe is able to. And that's going to be a concern, I think, for investors moving forward if you've only got a slower growth rate than maybe TikTok, Pinterest, and Instagram.
Question too about which camp will they ultimately land in, because there were all these lofty expectations about Snap and it hasn't materialized to the degree that was expected. At the same time, Reddit does seem to reach a larger crowd, and I think that's one of the things that makes these other platforms sticky. The reach, for instance, of Meta platforms, they've got both Facebook, Instagram, so they're reaching from young folks all the way up to boomers. And then, of course, you've got TikTok, which is young people's lane, but other people are engaging on there. Kevin, what's your take? You called out the user chart here. Tom, referencing the ad chart, which that really stood out to me, the advertiser engagement, because that's the early cycle, potential for monetization. What's your thought?
Yeah, I think the most important thing you have to realize about Reddit is they're a young company, right? They just went public, and they're still learning how to monetize all this data that they get, their user data. The good news is their margins are high, but as you know, you can watch from Snapchat and these other companies. They've got to figure it out. They've got to be, Meta is the platform. That is what everyone's aiming for, right? They've got so many people, and they seem to target ads so well. They monetize their platform so well. Everyone is trying to figure out a way to do it. Reddit's got to figure that out. So far in the U.S., they're doing extremely well. So that's going to sustain them for a while, but eventually, if they're going to grow past the U.S. borders, they've got to get the monetization down international to grow. So yeah, I just think the most important thing is this is a young company, very early in their life, in their legacy. So I think there's still a lot of time for them to get it right, but they still need to get it right.
Then from Lightfolio, we also have the chart showing web business versus stock price. Tom, earlier you mentioned how shares have performed this year. They've had a good year. They've outperformed the S&P 500 so far this year. And, you know, you see some sympathetic resonance between the web business and the stock price there. So, you know, I'm curious to know your take. Is this a, like, fundamentals leading price kind of setup from your point of view?
Yeah, I think it lines up. You're noticing on the far right here that they've seen an uptick as far as those web visits on the 90-day moving average, which has supported the stock move that we've seen. Their earnings last quarter, revenues were above expectations. They reported EPS 80 cents versus 52 expected. Revenue came in at $585 million versus just under $550 million they expected. They raised guidance a little bit. And you can see here from this graphic that Lightfolio gave us, hey, everything's trending together, and then maybe we're at an inflection point with the stock at this point, with it being up 39% so far this year.
Kevin, what's your thought before we jump into the example trade?
I just think that this is a stock that's really at, like I said, the beginning of its life, and they're still figuring out, and there's the worries, there's the doubt, there's the uncertainty here is, can they monetize this and continue to do it? Remember, right now as it sits, their margins are the peak in the industry. So they're the highest. So they're doing well. They just got to keep getting bigger and figure out the international part of their business.
I don't know, based on what you said, which direction you're going to go with your example trade, Kevin. Good job keeping me on my toes here. So take it away. What's the approach that you're going to take?
I like the fact that it's the stock broke down below its 50-day moving average and now has come back up over it, but it's still got room on the upside. It's trading 227 and change. It's got a recent high of 280, so it's significantly off its recent highs. Therefore, Diane, I did something in the bullish camp. And so I did the same dates as before. I kept it real simple. Buying January 16th, selling January 2nd. But this time I did the call diagonal. Buying the 225, right where the stock is at right now, in that range, slightly in the money. Looking for the January 2nd, about $15. And then I sold the January 2nd, 240. So buying January 16th, 225, selling January 2nd, 240. For a debit, I paid about $11.60, trading about $12 now. So it's drifting a bit higher as we firm up here late in the day. So a bullish Paul diagonal, recovering some of the room it's lost down from that 1,100, what is it, $282 was their high, almost 283, Tom.
Yeah, let's break this one down. Same option series that Kevin used on his calendar. So let's break this up. January 16th, monthly options that expire in 3.5 weeks. Buy the 225 strike call, and then in the near-term options on the January 2nd weekly options, sell the 240 call. So bullish $15 wide call diagonal, paying roughly about $11.65 debit that we've got up here. As Kevin mentioned, the stock's moved higher, so that's going to expand the price of this call diagonal to the upside. But the debt you pay is going to be risk. So if you pay $1,165 per spread on that, anything above about the 230 level is going to be potential profitability on this. As you get closer to expiration over the next 9 days, remember, there's 2.5 days that we're not open. The markets aren't open. So over the next 9 days, 9 days, as you get closer to expiration, you'll have that potential to roll that short 240 call into the next weekly cycle and maybe even into the January 16th cycle. That creates credits, that reduces risk, that increases potential profitability. But you definitely need to move to the upside of about $3 to get above into the profitability zone on this one. Apex of profitability, right at or near that 240 strike. The option market pricing in about a plus or minus $15 move. This kind of sets up with that, what Kevin was going after on this bullish example trade here, Diane. So setting up with some of the positive data here that Lightfolio gave us in Reddit.
Indeed, all right, and it does seem to be more positive data than, kind of cause for concern when we look at that data on Reddit. Thanks, guys, appreciate that. Coming up, we've got the breakdown. We are taking a look at Intel today. The stock's been under some pressure. We'll tell you why on the other side of this break.
Stay connected to the markets, the Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage means expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Welcome back to Matt Martin here on Schwab Network. I'm Diane King, all live on board the big board. Before we get to the breakdown, let me get you a check of where markets stand as we get closer to the end of the trading day, which ends at 1 p.m. Eastern time here at the New York Stock Exchange. The S&P 500 has a gain of about 1/3% still. All 11 sectors on the plus side currently. Energy has been a flip-flopper, though. Dow right now is gaining 0.6%. rallying 290 points. NASDAQ 100 higher by 0.2%. Russell 2000 has a gain of 0.25%. Meantime, shares of Intel have been under some pressure today following a Reuters report that NVIDIA has halted testing of Intel's 18A chip production process. NVIDIA was reportedly considering the process to manufacture its chips. Now, keep in mind, shares of Intel are up more than 30% since NVIDIA announced a $5 billion investment in the chip maker in September. Time now for the breakdown. Joining us now, we want to welcome in George Sillis, Senior Markets Correspondent, with a fundamental look at Intel alongside myself and Tom White. All right, George, let's get into this with Intel. Intel's under some pressure today, but it's not being dented too hard. What's your thought here when you look across this?
Well, clearly, I think this news is putting some underlying pressure on Intel, but I think if you look at the overall trend for the stock, which is still higher by over 75% in the last 52 weeks, it is pulling back since approximately the $44 high about a month or so ago, and that's in context with the rest of the semiconductor stack, with NVIDIA, Broadcom, also trading below their highs as well. I think this is interesting. I think the overall value proposition really for Intel as a business in transition, and a business that not necessarily just designs their own chips, but also manufacture them. So that's essentially a very unique value proposition Intel provides the entire marketplace. Going back to last year, 2024, where the stock actually gapped lower in July of last year, that was based on an annualized impairment charge of $19 billion on manufacturing asset write-downs. But nonetheless, if you look at the last year, there's been a lot of prompts. We know that the U.S. government, Trump administration, alongside the CHIPS Act, has made an investment around $8.9 billion. You mentioned the $5 billion NVIDIA investment. If you look at SoftBank, also an investor in Intel. And right now, the supportive nature of manufacturing for Intel is there, both policy, both capital investment. And Intel, as a manufacturer, looks like they're here to stay. The news today, again, is creating some challenging price action today, but it might just be a short-lived, declining price action when we consider the aspects of the news. NVIDIA is basically testing manufacturing alongside Intel to supply their GPU chips. Now, Taiwan Semiconductor is the predominant supplier for NVIDIA in terms of manufacturing. Their specifications are extremely high, and it's going to be tough for Intel, just in a nutshell, to compete with Taiwan Semiconductors for the technology stack that NVIDIA and even maybe Broadcom demands. So it looks like they're still in collaboration together as business partners, and of course NVIDIA is an investor, but it may not necessarily be a manufacturing collaboration to the highest degree that perhaps NVIDIA needs. And I think this is, again, news, which isn't bad, but it's not as bad, essentially, as maybe one would suggest based on the headline overall.
After this, the Commerce Department, an official there stated that the U.S. stake that they've got in Intel, nearly 10%, gives them a shot at success, but not a leg up, and Intel is not too strategic to fail. That doesn't seem very supportive, but at the same time, if the administration wants to bring back some of that manufacturing, they're going to give Intel every chance at this point, and I think that's maybe what the optimism for the stock is, that maybe CEO Lip-Boutin, right?
Yes, look, there's a lot of optimism in Intel, but there's also, just looking at the price action on the daily, a lot of volatility. So that implies that the company is still struggling to find its footing. So you have to be mindful of that. Obviously, the government is supporting Intel because the government is supporting domestic manufacturing of high technology. And even looking at GDP, just to add on something else, the trade deficit is narrowing. So you're starting to see this really manifest into U.S. export resurgence. Intel may be part of that, but when it comes down to the specification NVIDIA requires, extremely high. So Intel may not necessarily be that company, but when it comes to data center, cloud computing, and server technologies in the stack, but also the field programmable array technologies, Intel will be a predominant player, a competitive player. They just may not necessarily be the top-end player or manufacturer with the specifications that are needed by companies like maybe Broadcom and NVIDIA. That's basically the declaration I look at that's happening today. NVIDIA still states they're collaborating with Intel, but again, they may not necessarily be the go-to company to manufacture NVIDIA's technologies.
So still a cozy relationship, but not exactly bedfellows now, George. That's what you're
That's right.
Okay.
Exactly. So they were going through the testing, the manufacturing testing. This was announced a while ago. It looks like they declared right now, as what we know, that they're not going to be utilizing, of course, Intel as a competitor to Taiwan Semiconductor, but they can use them in some complementary way. So I think that's the moral story.
All right, thank you, George. That's George Sillis, our senior markets correspondent. And Merry Christmas if you celebrate, George. All right, let's get Kevin back in here for the example trade purposes in this one for Intel. So, Tom, this time you've got the example trade in Intel. George made some great points, right? The stock is not getting hit as hard as one might expect by at least what the headline looked like, because when you dig deeper, it's not like the relationship is completely deteriorating. So what's the approach that you're taking?
Yeah, it seems like, this stock was down over 5% when this was announced earlier this morning in pre-market. We're down, less than 1% now. It's over $1 off of its session lows at this point, so maybe that's giving a little bit of credence here. So I looked at the strategy, pretty straightforward. They got earnings on the 28th of January, so I want to avoid that, while maybe still giving myself some opportunity to take advantage of maybe a rebound rally. Remember, this stock was above $44 a share just a few weeks ago, so it has that ability to rally. So looked at a bullish call vertical here. I went out to the January 23rd weekly options that expire in 30 days. Gives you a month in this position, but it avoids that earnings event, which might cause some added volatility. But you can take advantage if the stock does move higher. You can take advantage of it with this type of potential strategy.
Intel, huh?
Find the 35 call that's in the money by $1. That's the bullish portion of this trade. Then against it, offset some of the costs on that bullish call purchase. Sell the 40 strike call. Bullish $5 wide call vertical, paying roughly about $1.65 debit. It might be about a nickel or a dime higher than that right now. The stock has moved higher. The debit you pay is going to be your risk. So if you pay $165 per spread, that can expand to $5 if we get above that $40 level, Kevin. So pretty straightforward on this one with a break even of about $36.65 to the upside.
Today.
You don't need that big of a move to get above that level.
Nope.
30 days duration in this trade, Tom, and you're right.
Oh, gosh.
The damage done to this stock is all pretty much faded away here. It's down about 0.6%. So if you get that move between $35 and $40, you give yourself a month to get that move, Tom. The only risk you have is the debit paid.
And for max profitability above that $40 level, that's less than $4 above the current share price in there. So if you're bullish on a name like this, straightforward bullish call vertical, and remember that implied volatility levels, current IV percentile rank, only 12%. So implied volatility levels relatively low on this bullish example here in Intel, Diane.
What needs to happen over this timeline for this to work? Tom, is there any event risk you have to watch out for in this time period?
Well, that's why I set it up on the January 23rd weekly options to avoid that earnings event. Now, Intel's not immune to any market moves. You got to keep that in mind. No stock is really. So keep that in mind. If we get a pullback at the start of next year, that could negatively impact this trade. But you do have 30 days in it, so you have some duration.
All right, thank you. Great stuff there on the example trade. We're going to take a quick break and wind things down here on Wall Street. We'll have a wrap-up of the day right after this break.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I've seen something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest in trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Welcome to Schwab Network, where real-time market coverage means expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I've seen something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest in trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Welcome back to Fast Market. We are seconds away from the closing bell on Wall Street. There you have it. That's it. The gavel has struck. That's the sound of the closing bell on Wall Street. Laptops down, pencils down. It's a wrap for a holiday shortened day. You've got a record for the S&P 500, finishing better by about 1/3% there. This is the 39th record of the year for the broadest benchmark of U.S. stocks. So Santa certainly comes early to Wall Street. The Nasdaq 100 has a gain of more than 1/4%. The Dow Jones Industrial Average is higher by 0.6%. Russell 2000 finishing with a gain of a little bit more than 1/4%. So we have gains across the board. You can hear the applause on Wall Street, not just for the gains. It's a holiday shortened trading day. And that indeed is going to do it for us today on Fast Market. I'm Diane King Hall, coming alongside Kevin Hings and Tom White. Download the Schwab Network app. It's available in the App Store. It's 24/7 on SchwabNetwork.com. Happy holidays and Merry Christmas to all who celebrate.
Schwab's 2026 Market Outlook. I'm Marley Caden, and I'm thrilled to be here for what has become one of the most important conversations of the year for investors. If 2025 taught us anything, it's that markets are remarkably resilient, even in the face of extraordinary uncertainty. We've seen swings in inflation expectations, shifting global trade policies, tightening financial conditions, and geopolitical tensions that continue to reshape how investors think about risk. All while equity markets continue to move to new all-time highs. Tonight, I'll be joined by Schwab's team of market experts. Schwab Asset Management CEO and CIO Omar Aguilar will join me shortly to take a look at the state of global investing. Liz Ann Saunders will be here to break down the domestic economic outlook and what's in store for equities. Michelle Gibley will weigh in on what to watch in global markets. Kathy Jones and Colin Martin will cover what's in store for fixed income in 2026. And Joe Mazzola will join me here in Chicago to set up what traders can expect next year. Then we'll wrap up with a lightning round featuring our panel of experts answering your questions. Joining us now is Omar Aguilar, CEO and CIO of Schwab Asset Management. Omar, thank you for being with us. Let's start big picture here. We had a volatile but a resilient 2025. What is your overall outlook for 2026?
Yes, thanks for having me. We are fairly constructive on what 2026 may look like. I think when you look at any outlook, you always try to balance what are the tailwinds and what are the headwinds. And on balance, there seem to be more tailwinds than headwinds. When you actually think, the areas of, easing monetary policy with the Federal Reserve expected to continue easing policy, a very accommodating fiscal policy that's taken into effect. When you think about the increases in productivity, the high levels of capital expenditures on artificial intelligence, when you see a rebound and a very resilient, consumer and investor.
SPY is getting close to the VWAP.
A little more stability. Overall, it looks like tailwinds for a potential.
You see it, Randy?
Moderate growth in the U.S. economy will continue into 2026. Of course, there's always headwinds and there's always risks that people need to consider. You have geopolitical risks, we still have trade policy risks. I think the biggest risk to the overall economic picture ends up being the dynamics between an inflation
that's the only thing I see right now.
Still has the risk that they potentially could go. And this concept of what we call the K-shaped, consumer, where the lower end of the consumer, is probably strained.
Market's closed.
Potential concerns that may impact, the credit market.
Oh!
And we continue to have this discussion.
It sure is.
Or K-shaped economy that we're in. How would you describe the state of investments today, and what does that mean for growth going into next year?
Well, when you think
about
the
SPY.
The top part of the K, so those high-income earners, they've been, clearly, been enjoying the wealth effect that have come with the market over the several years.
All right,
Strong
well,
balance sheets continue to
let it be said.
Very, sustainable and repeatable consumption that continues to drive GDP growth. And in general way, that wealth effect has overshadowed
I'm gonna have fun.
potential inflation concerns that have come their way. On the other hand, you
So-
have the lower end of the consumer, that ends part of the consumer that is
Yeah, it's
more
7
sensitive
after.
to
7
inflation
after.
changes, to oil prices,
1 o'clock
changes
Eastern.
in any parts of food prices that may actually go up. And also at the same time, it's at the mercy of the potential labor market dynamics. So, the bigger part of what you see over there that may impact the overall picture of the economic and the financial,
Take a little fun away from it.
is that to the extent that credit component starts to deteriorate further, and we're starting to see more defaults, credit card issues that may affect financial institutions, and things that are starting to go into less liquidity, that actually could potentially.
Merry Christmas.
And we have
Thank
seen
you
the
for the
credit
best
markets be
Christmas
incredibly
present
attractive
ever.
to the focus
There's the
on the
VWAP.
consumer, but we've seen a great deal of
SPY just like boom.
financing for data infrastructure.
Here's my nose.
build-out that we're seeing in this AI boom.
Where's the paper at? Let me have some.
Or does this introduce new risks?
This is a new part of the credit market that I think we will be all watching
So-
in 2026, and certainly will play a role in just
later
looking at how
dates.
these different transactions will work, because just this year we reached close to 100 billion
100 billion
financing for AI infrastructure and in the whole ecosystem of AI, not just data warehousing, but overall utilities, overall power, and overall the public and the private markets are actually now in the center of financing that extreme levels of capital expenditures, specifically for these hyperscalers. So when you actually look at how that works and how these dynamics will go, there are certain companies that have never gone into the debt market to actually increase their capex. Is going to be new for them, and therefore the dynamics on how they create that financing and how they monitor and the quality of those debt creations is going to be something that will play a role going into next year.
And when we're talking about AI investment has become a major force, not just in the economy here in America, but in the global economy on the whole. How big of a driver do you think that AI and infrastructure spending will be for markets in 2026?
We have discussed this in many forums that the AI structure and cycle is in the early innings. It's just the beginning of going from the source, which started with the hyperscalers, to now going to different parts of the economy.
Yes, in Springfield.
Where you see companies in the majority of industries starting to make that adoption of AI and investing in AI. So the capital expenditures that have been, for the most part, concentrated in those hyperscalers, mega technology companies, is starting to now just to go down to areas where the majority of companies, when they report earnings, they actually now have an item that actually has to do with capital expenditures for AI adoption. I think the biggest, trade-offs in this area is, to what extent the cycle starts to hit into the profitability of those capital expenditures. And I think that sort of friction between the size of the capital expenditures with the profitability of AI is certainly something that is going to